That much, certainly relative to the rest of its European peers. The IBEX is already open. We're down by 0.4% there. Keep an eye on what is happening with euro dollar today. I think the bond market and the foreign exchange story could be interesting as well. 600's down by around 0.2%. We'll see whether that drops a little bit more once we start to get the CAC opening up this morning, and in particular what we see coming through from the DAX. But at the moment, it's a negative setup, Kriti, as we start the day here in Europe Friday, but we're really anticipating what the picture is going to look like next week. I think a lot of people are going to be looking at a lot of risk next week and wondering whether or not they actually want to sit on their hands today.
Absolutely. And of course, you see risk sentiment across the board. When we're talking about breadth in this market, it is certainly to the downside, Guy, down about 366 stocks and counting. So you can see more red than green, but a little bit of that defensiveness showing up in this market. Utilities, telecom, health, and even the property sector seeing a little bit of outperformance, but broad declines across the board when you see some of these other moves as well, specifically the technology space and the banking space as well. Now, the banking story might actually be a little bit of that read-through from the inflation data we just got out of France. We're also just seeing it out of Spain as well. I'll give you the numbers now. The Spanish preliminary March harmonized CPI rising 2.2% year over year. The estimate was 2.5%. So again, seeing a drop similar to what we saw in the French CPI, below what the estimate actually was. And that's going to be something that is reflected in the bond market as well, accelerating perhaps the bid you are seeing into the global bond market, not just on this side of the Atlantic. Let's talk about some of the individual equity movers as well. We talked about Ferrari ahead of the open. It is your biggest index contributor to the upside. This is coming, of course, off of that Barclays upgrade, saying there's a little bit of tariff resilience baked in there. So you're seeing a move about 2.5% and counting to the upside. That's going to be one that we've got our eye on. Novo Nordisk, I believe, is ex-dividend today as well. Those shares higher by about 1.6%. They've got a slew of technology names on the back foot.
Ubisoft is up, though. 8%. It gapped higher first thing this morning. It's coming off that initial high, but that stock is certainly having a very good morning on this carve-out story that we brought you a little bit earlier on. Tom McKenzie's going to be joining us very shortly, actually, to talk us through that one. So it is having a very good day on the back of that. We saw that pre-market as well. We have got some Spanish data as well, which I think is worth mentioning. The numbers come in soft again. But they're significantly north of the French numbers. Yeah. It is interesting that we are seeing inflation maybe tracking a little bit softer than maybe the market has been looking for. But let's talk a little bit about the broader market and how this all folds in, because euro dollar, it was interesting to hear that call a little bit earlier on from Paribas at 120 potentially next year.
Yeah. Well, we're dealing with a very interesting environment, which is very normal for a Friday, which is you sell off into the weekend, you sell off against the tariff risk. Perhaps you're seeing a little bit of buying on Mondays. You're seeing that in the equity market. You mentioned the Spanish CPI. We talked about France earlier as well. When you look at the bond market, you do see a little bit of movement, and that's putting it lightly, an almost 5-6 basis points move across the continent. Compare that to what you're seeing in the States, and it's not as dire of a sell-off, but certainly that risk-off mentality is turning into a cross-asset story, and those weaker than expected inflation figures not necessarily helping.
No, I think that's the catalyst. Well, it's certainly helping the bond market this morning. That's the bid where we're seeing. But I also wonder whether there's a safe haven bid in amongst all this as well, in terms of people looking for somewhere maybe to hide out a little bit. Joining us to talk about that is Valerie Jenin, Head of Investments at Barclays Private Bank, Monaco. Good morning.
Good morning.
Nice to see you.
Nice to see you too.
Should I find somewhere to hide out at the moment? We've got an awful lot of risk coming across the table in terms of the tariff story, what's happening with the growth narrative around all of that. How do you see the market at the moment? Should I be defensive? Should I be looking to buy dips? How are you setting us up?
Well, in terms of hiding places, you've mentioned this morning that the gold is rising again, and this has been a long-standing trend now, so this is one place to hide, of course. But I think the best place to hide is just to create a well-built, well-diversified investment portfolio. And you want to diversify in terms of across asset classes, of course. So you want to go and tap into those private debt, private equity, hedge funds, asset classes, but also within asset classes. You know, for example, equity. So you want to diversify away from the US and build up a little bit the exposure to the rest of the world. And in terms of sector, talking about US equity, you want still, I mean, we still like very much the tech, the growth stocks, the quality growth stock in the US, but you want as well to go into the less cyclicals and defensive stocks. You want, you know, some healthcare and utilities, for instance. They've done really well year to date, so you want to be well positioned.
Right. How different is my portfolio now, how it should look versus the last few years? The last few years, all I've needed to do was buy US tech to do well and outperform. How different does it look now? And how defensive do I need to be?
Yeah. So, yes, the US tech play has worked out really well for the last few years. I think for the time to come, for the next few months and years, you need to diversify further. And we've seen the momentum in European stocks. We think that this is, you know, represents a fundamental shift. This will be here to last for the next few years, even though it's going to be very gradual, but it is a very positive shift for European equities. So you need to diversify better.
Well, you like to make the point that if you diversified in this market, you'd underperform the broader market,
if you were
right?
out of tech over the last few years, you have underperformed. So a diversified portfolio hasn't worked.
Absolutely. So let me put that to you, though. Now, we talk about diversifying, but it's the trick here as we're dealing with the tariff volatility, the geopolitical volatility, to actually look inwards, to find companies and countries that actually don't have international exposure, which is the exact opposite of the traditional diversification method.
Diversification doesn't always work. However, you can sleep at night, right? That's the value of it. It adds a lot of money points to it.
Not on this shift.
Exactly. And look at it in terms of equities and fixed income, for instance. You know, right now in the US, the fixed income market remains very strong and resilient, whereas US equities are being hammered. So, you know, this is the value. This is exactly what you want. This is the value of being diversified across asset classes. And then you add to it FX and you add to it, you know, alternative asset classes.
What is the driving factor when it comes to investment right now? And I say that almost superficially in that we keep talking about tariffs, but I'm curious if the real canary in the coal mine or red flags for investors is actually the monetary policy more than it is the fiscal.
I think there are two driving factors right now. First of all, the weaker consumer prints that we've seen from the US. I think this is spooking a little bit investors. You know, the soft data that we got so far are a little bit weaker than expected, even though the hard data remains very strong and very resilient. And therefore, we are not at Barclays worried about a US recession as a base case. And of course, all the noise about tariffs is creating a lot of fears in the market, not just the level of the tariffs, but the way they're implemented as well. So in terms of level of the tariffs, it seems like investors are just digesting now that tariffs have lose-lose implications for all parties. You know, when Trump got elected, there was this massive momentum and bullish spin on US equities, even though we knew that it would put tariffs on, right? And now we realize that everyone will lose out of that. We just recently halved our US GDP growth forecast for this year from 1.5% to 0.7%, so they will lose as well.
So there's a lot of uncertainty.
Yes, that's for sure.
Yeah. So why don't I just sit in cash? Isn't that the logical place to be right now until the uncertainty clears? You're still getting a decent yield on cash. Should cash balances be higher? What are you advising in terms of how cash fits back in? You look at money market funds, every month I'm astounded by how much money continues to pour into them.
Yeah, and you've got $6 trillion sitting in money market funds still today. Cash was a very attractive alternative for the last 2 years, pretty much. It still is as of today. However, we think that rates will be cut significantly over the next few months. So if you stay in cash, you will miss out the opportunity to lock yields and crystallize the higher yields that you can see right now.
But do you sleep at night?
So in terms of cuts, we see, you know, 2 cuts from the Fed this year and 2 more next year. We think the ECB will cut 4 times this year to get to 1.5%. And 4 from the Bank of England as well. So, you know, if you stay in cash, you lose out. This is a cost of opportunity.
So what do you do in terms of playing some of these, though? I can hear you on the diversification.
Yeah.
The last time we were in a trade war like this under the first Trump administration, people viewed diversification as having exposure to commodities or having exposure to currencies you wouldn't traditionally have exposure to as well. Does your definition of diversification include, in some ways, be kind of a macro tourist to other assets, including perhaps private investments, or including perhaps traditional commodity markets that aren't maybe accessible, or emerging markets that aren't traditionally accessible or as liquid as previously expected?
Yeah, alternative asset classes make up right now for a substantial portion of the investment portfolios of institutional investors, sophisticated professional investors, up to 25-30% in some cases. So this is significant. And in terms of liquidity, in terms of addressing that, we've seen some opportunities lately come out as semi-liquid. Therefore, you're not stuck, and you don't have to buy and hold for 10 years. You have today other opportunities whereby you can be a little bit more flexible around that.
Can I just ask you about the relationship between European equities and US equities? Can they go in different directions? And if so, for how long? The US market has been the gorilla in the room for a long time, and everything has orbited around it, and it has set the pace. Is that still the case? Can I invest in Europe, see the US market go down, and not expect to be hit as well? I appreciate there's a kind of relative trade that could be on, but so far the evidence this year is that can be the case. Can it carry on being the case?
So it can be the case, yes, because we're seeing that right now.
Yeah.
In fact, the divergence is quite substantial and has lasted now. It's a few months that it's been lasting. However, probably that gap will narrow at some point. There is this old saying that when the US sneezes, Europe catches a cold, and I think that stays true. So if we were to see potentially a US recession or a stagflation in the US, I doubt that European equities could remain strong and resilient to that.
Been great to see you this morning.
Thank you.
Thanks for stopping by to see us. Valerie Jenin, the head of investments at Barclays Private Bank, Monaco. Thank you very much indeed. Let's take a look at the core six this morning and look at what is happening here. We've already mentioned a double upgrade for Ferrari. It is having a reasonably good day. Obviously, the auto sector was firmly under pressure yesterday, but Ferrari bounces back today. There's some weakness in the tech space, some weakness in the kind of peripheral AI story. ASML, Schneider, both seeing some weakness as well this morning. I think Novo's gone ex-dividend today. It's tracking higher, which is certainly nothing to sneeze about. LVMH, though, is down by, as you can see, circa 0.5%. Let's check in on some of the individual stock stories that aren't on that board. Joe Easton's got the details.
So we have got some movement, Guy, in the sportswear stocks at the moment here in Europe. So Adidas coming off a little bit, down around 0.8%. Puma coming down 1.2%. This, of course, a read across from Lululemon last night, which gave a really downbeat forecast on the US consumer, and also does seem to be some data on the mall visits, according to analysts, saying that is a negative for sportswear and apparel retail in general, and therefore seeing that read across coming through as the yoga wear maker hits that sector today. Then in terms of the one for the gamers, Ubisoft is a big mover over in Paris, spinning out or carving out that business that includes Assassin's Creed and all the big punchy names in terms of their titles, and getting a big investment, a few $1 billion coming in from Tencent as well. So that is a positive one. In the French markets, we're up 8% on Ubisoft, not quite as big as we saw in the US yesterday, but nonetheless a decent move for that one. Then staying in France, a sector not doing too well is the meal vouchers. This has been a big thing for the French market traders, and there is a report out in Les Echos in France overnight saying that the government potentially going to be reining in the fees that these companies can charge. And we were seeing Edenred, that was the worst performer at the open of trading here in Europe today. Pluxee as well, that one's slipping, both of those dropping on a report, as I say, in Les Echos around meal vouchers and the potential regulation on those. Then Deutsche Bank, a CFO standing down, and he might be, well, a little bit pleased, I guess, to see the stock lower on his departure. That stock falling 3%, and analysts saying that he's done a really good job, and it is a surprise that he's stepping down. They've got a new guy coming in from Morgan Stanley, the deputy CFO, moving over from the US to Deutsche Bank. But it is a shock for the investors that the CFO standing down, and therefore the stock down 3%. Talk about shocks. WH Smith no longer going to be on the high street. I actually had a job on the till there when I was about 15 years old, and now here I am reporting that the company will no longer exist on the high street as its main business, the retail on the high street arm, sold for only around 75 million quid. We've got around 500 stores, so that is not a very big amount of money, but the stock dropping around 1.5% at the moment. WH Smith will only be available in your airports and trade stations going forward. Then finally, touching back in on Ferrari, as Guy mentioned earlier, 2 upgrades for this stock. One of them is at Barclays. They are overweight on the stock, of course, after a big drop, but Barclays saying that this is a very resilient company to the tariff issues, and that's exactly what Kepler-Chevreux also said in the same kind of report this morning. So they both upgrade the stock, Kepler and Barclays. Ferrari rising at 3% in Italian trading this morning.
Joe Easton from our equities team, we thank you so much walking us through some of the early movers. Coming up on the program, Germany's largest bank unveils a series of leadership changes with CFO James von Moltke set to be replaced. We're going to dive into the details next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session. Some of the risk sentiment that was off 18 minutes ago has kind of paired some of its losses, at least when you're looking at the broader stock 600. But the underperformance remains very much in the auto sector, and it feels like that's where a lot of the pain is when it comes to the DAX, even the CAC run as well. The FTSE 100 coming back up, perhaps escaping some of the gloom and doom.
Yeah, I don't feel like the UK is escaping much gloom and doom at the moment, but we'll park that conversation for another day. Deutsche Bank says Morgan Stanley's Raja Akram will replace Chief Financial Officer James von Moltke as part of a raft of leadership changes at Germany's largest bank. Akram, Morgan Stanley's deputy CFO, will join Deutsche in October. Arno Schützer joins us now to discuss. Arno, why? Why is James leaving? Why are we seeing these changes coming through?
Right. So James has been in this role for 8 years. It'll be 9 years next year, and apparently he's up to doing something new. Yeah, he decided to leave the bank, and because they're bringing in somebody new, Raj Akram from Morgan Stanley, from the outside, they've decided to do this sort of long transition period of Akram joining the bank in fall and then taking over sometime next year, probably, well, I don't know, maybe around this time of the year, to be seen.
Well, Arno, talk to us a little bit about the environment that the CFO is going to be, or the new CFO is going to be inheriting here, especially in the context of the playbook that European banks have been using around buybacks. It's almost this massive momentum that you've seen. Deutsche Bank, for example, this morning announcing they're starting up to 750 million euros of a buyback as early as April 1st. Put that into context for us for Deutsche Bank.
Yeah. So, James van Moltke and Chief Executive Christian Zeving are credited of having turned the ship around. When they started, so Moltke actually started sort of a year before Christian Zeving became CEO. And at the time, Deutsche Bank was in a terrible state, and the two of them have actually turned the bank around. They were doing quite well of late. Much like most of the European banks, to be honest. And yes, they have committed to returning a lot of capital to shareholders. And generally speaking, the management team at Deutsche Bank seems to be in a pretty stable state. So also announced last night, sort of Christian Zeving is staying on for another 3 years. The investment bank head, Fabrizio Campelli, is also extending his contract by 3 years. There's one person who's leaving, Stefan Simon, the head of legal, who had last year they had a big legal provision relating to an old legacy case around Postbank, and he had a big bonus cut, and now he's leaving the bank. But otherwise, the management board of Deutsche Bank seems to be in good shape, and so that's where Akram is going to join in.
Yeah. Arno Schutzer joining us this morning to walk us through the leadership change coming for Deutsche Bank. We thank you so much. Let's go from the banking sector to the technology sector, the video game sector, whatever sector it falls under. Ubisoft gaining in Paris after the video game maker said it will carve out a unit, including Assassin's Creed, Far Cry, and Tom Clancy's Rainbow Six, into a subsidiary with an enterprise value of about 4 billion euros. Tencent also due to invest about 1.2 billion euros to acquire a 25% stake in the new entity, which will hold licenses for the intellectual property of the games in exchange for a royalty. Bloomberg's Tom McKenzie is all over the video game beat, I think.
Guy Johnson's smiling because in his cavernous basement, these are some of the titles that he plays at the weekend. So yes, this is significant. Look, Ubisoft has been misfiring in terms of releases of games. It has a big debt pile. It's been under pressure from activist investors to either go private or be sold, or for Tencent to take a bigger stake. Tencent already has a 10% stake. Now a bit of a lifeline coming through from Tencent then, with this unit, putting in close to 1.2 billion euros. And with that 25% stake. So the analysts, one analyst has already upgraded the stock. You're seeing the move, of course, in the session today. It addresses some of those concerns. The CEO coming out saying this is a foundational step in changing the company's operating model, enabling us to be more agile and ambitious.
The development costs are extraordinary, aren't they?
Yeah.
Absolutely extraordinary in terms of the cost of developing some of these titles. And I'm wondering also whether or not we're looking at a changed world for developers too. How does AI change the narrative? What happens going down the road? Does this feel like a sort of pivot at a crucial moment to take the business off in a new direction?
I mean, AI is a really interesting question in terms of whether that creates efficiencies and erodes some of the costs.
Presumably it must reduce, in terms of some of the coding costs must come down, you would have thought.
You would have thought. If they're not seeing it now, then you'd expect them to see that at some point. Yeah. And you can code obviously at a relatively basic level using, for example, ChatGPT's latest models and others out there, and that coding is possible. You can build simple apps, but whether or not you can kind of get the sophisticated gameplay, for example, of things like Assassin's Creed, the technology seems to be quite far away from that. But there are probably cost efficiencies that they can put in place, at least in the medium to longer term, around that. There is that huge sink of costs when it comes to developing these games, and it's always a bit of a gamble, a bit like building or putting in place funding, I should say, for making a film. You never quite know if it's going to hit and be a hit. Their most recent title, which was delayed, they released it, so Assassin's Creed Shadow, they released it earlier this year. They were hoping to release it last year. It was delayed. Seems to have been quite well received. The other point to this is that Tencent has that huge pipeline, and Tencent will be helpful in getting these games out and more quickly, and also for the mobile devices as well that Tencent is specializing in. And it's also an interesting tell. Tencent essentially acted like a venture capital firm for so many years, investing in dozens of game makers across the world, and then it had to pull its tentacles in on the technology crackdown in China. So it's also indicative of a changing regime in China as well.
I remember this quite clearly. I used to cover video game stocks back in the glory days at
there
Bloomberg.
We go. So you're the expert.
This should be all you.
I'm definitely not the expert, but I do remember, I think it was like 7 years ago when we were talking about Ubisoft, it was the same story of kind of franchises, and they have this issue in the step pile that they haven't fixed in the 7 years I've been at Bloomberg. Give us a little bit more insight on the Tencent space based on your background in covering China as well. You talk about this regime change as well. Very quickly, walk us through any other players that may be interested in diving in.
In diving into Ubisoft, in diving into developing
games. Given this regime change you're starting to see.
Look, Tencent is head and shoulders above the rest out of China. It's one of the major and largest game developers, if not the largest globally, with that pipeline, with those global investments. It has the AI that's investing as well, so it builds out its own models. It's got its application, of course, the WeChat app that's kind of the multi-tool of all apps. But in terms of what this signals, again, I think, look to Tencent basically to put more cash to play in the gaming space going forward in Europe and in the US, because the shackles seem to have been taken off, at least to some extent.
New Switch is coming out this summer, isn't it?
Are you putting in an order for that?
No, not yet.
But it's a big. That's a big play for Nintendo.
Yeah.
And in terms of a big bet for Nintendo, is that going to rewrite their fortunes as well?
All right, Bloomberg Daybreak anchor Tom McKenzie really getting into the video game beat. And speaking of games, let's talk about Bloomberg.com. They have a brand new game for you as well. Pointed, the new news quiz for risk takers. You can use strategy and savvy to navigate our handcrafted trivia questions about the week's news in markets, politics, luxury, culture, and more. The more you know, the higher you score. It's already, I can't. This sounds exciting.
Tom really gave this some beans earlier on.
I'm not doing it justice.
And I do wonder whether he's been out there and sort of smashed it. And
we need to have a head-to-head, and I'll be duly humiliated by Guy Johnson's prowess and critique
always cites herself as being the sort of the A+ student, so I would imagine that she does quite well on these kinds of things.
We'll see. We'll see if that all happens. Well, maybe as we avoid the tariff story, we can digest the video game story. Coming up, we're going to dive into that theme next. Stick with us. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. 30 minutes into the opening trade here in Europe. And as you can see, we've got red on the screen this morning. In terms of where we're seeing the movement, in terms of the stock areas that we are watching, certainly you do have a fairly eclectic mix in terms of the percentage losses that we're seeing coming through. There's a real kind of obvious trade, though. In terms of the points, Nestle is the biggest points gainer this morning. Safety, defensives. On the other end of the spectrum, you've got some of the tech stocks, ASML, SAP, Siemens, these kinds of stocks. That is where the weakness is coming through. So a fairly kind of obvious split in terms of what we are watching in Europe this morning. In terms of the split, though, it's fairly even, ups and downs. So you've got 294 up, you've got 299 down, 10 unchanged. So actually a fairly even market in terms of the story that we are seeing this morning. The market, though, all markets, it appear, are waiting for what happens next week, the tariff narrative. How much risk is actually priced into so many of these stories that we watch so carefully on a day-to-day basis, Critty?
Everyone's on guard. In theory, to your point, you see it in the equity markets. You sort of see it in the FX market. We keep talking about this volatility. Let me show you one place where maybe it's not showing up, and that's in the high-grade credit space. This is the U.S. high-grade spreads that on a 5-year basis look pretty low. So if we're talking about that volatility, we're talking about that panic. Where is it? Because we are right here on levels that we've seen all the way back into 2021. This red line that you're seeing that's kind of across this chart is the 5-year average. So right now, spreads are trading below the 5-year average, which tells you maybe things are calm on the surface if at least there's panic underneath. But Guy, I think this is crucial because JP Morgan came out with a call in the last 24 hours or so, basically saying that if you were trying to price in tariff risk, that needs to show up in the credit spreads. Basically, investors need to be kind of compensated for that extra tariff exposure. And this goes into the conversation we've been having with equity strategists, even bond market strategists around the world, that said maybe you look at countries and assets that have less international exposure, not more.
Yeah, it's interesting what's happening with credit spreads, though. If you don't get a recession, do you just continue to clip the coupon and take the high yield? Or do we need to fold in some of that tariff risk to broad assets? Peter Cheer is here to answer that question, head of macro strategy at Academy Securities, joining us around the table in London this morning. Nice to see you. Have we priced in enough risk to the tariff story? That's the question, basically, Critty fundamentally is asking this morning. What's the answer?
I think the answer is no. I think there's still a lot of complacency. You know, you keep hearing, oh, you know, Liberation Day we'll have certainty, and then we can rally on the back of certainty. I think the exact opposite is going to happen. Maybe we try and briefly rally, then people are going to start looking at this and saying, wow, this is actually certain, and we have not come close to pricing this disruption. And I think it's going to feed into the credit markets as well. So I think spreads widen, and I think we have to start pricing in a real recession risk in the U.S. I think there's at least another 10%, maybe 20% down in U.S. stocks.
What's the extreme? How far could they go?
You know, if this continues, I see real deglobalization. And again, most companies were set up to be relevant to the, efficient across the globe. So if that destroys, I think we could see a further decline, and I think it could take a long, long time to recover. To me, the biggest miscalculation that I think I'm seeing so far is maybe these tariffs would work if there was a ton of excess capacity in the U.S. There is no excess capacity in the U.S. They're very limited, right? We kind of demanufactured the U.S. over 30 years. Slapping a bunch of tariffs on is not going to create a steel factory in the next 2 months, right? These things are all going to take 3 to 7 years. Even auto plants, right? They're going to be relying on robotics. You got to get the orders in for the robotics. So I think we are really miscalculating. This deglobalization is continuing, and what I see is kind of a change in the American brand, and I do believe that the U.S. has potentially made a mistake and hasn't benefited the intangibles of what we were in the U.S. and is trading trade flows for capital flows. So I do think the rest of the world is going to outperform versus the U.S., but I think it's going to be in a downward market for the next 2 to 3 months.
You took me right where I want to go, which is the last time we saw the first Trump administration put on these tariffs, specifically against China, not necessarily the rest of the world, the mentality, the roadmap was, when in doubt, buy America. You see it in bonds, you saw it in equity markets, you even saw it in the dollar. The idea here being that the U.S. has that excess exposure and the excess capacity that you lay out. Does the domestic policy layoffs, some of the kind of volatility that you're seeing in terms of not just federal layoffs, but then also the politics within the various states and countries undermine the safety of that bid?
Yeah, I think completely, right? We kind of have almost wars on 3 fronts, right? We're dealing with Russia, Ukraine, NATO. That seems to be causing friction globally. We're dealing with DOGE, cutting jobs in the U.S., cutting spending. That's going to cause some problems. And then the tariffs are causing problems. And then the other thing, I think it's really key that you mentioned China and Trump 1.0. I think countries have figured out a little bit how to negotiate with Trump very differently this time. If you think about Trump 1.0, tariffs, China immediately comes to the door, begging for trade deals. Trump gets to say this. 10% tariff, China says nothing. Another 10% tariff, China says nothing. Trump negotiating mineral deals with Russia and Ukraine, China says nothing. I think they're waiting for Trump to keep coming back to the table, upping the ante, and see what happens. So I think world leaders have figured out how to play him differently this time, and I think that's going to cause problems for the U.S. policy.
So there's a common saying, our guest earlier in this hour has said this as well, that if the U.S. sneezes, the rest of the world catches a cold. It's an argument that the Trump administration is using, and that in terms of capital flows, in terms of assets, in terms of reach, at least in the short term, the U.S. has still more, not only bargaining power, but financial power than the rest of the world. So why would the rest of the world outperform in this scenario?
One, because I think it really has been the American brand attracted capital to the U.S. You're starting to see that. And if you look at the bond markets, right, 2 years ago, you could not get 2% in 30-year JGBs. Now you can. You look at bunds, right? They're almost 10% or 3% in 10 years, right? That creates some alternatives to come out. I think people are actually very concerned about how the U.S. is going to treat capital. Again, if you told me 3 months ago Germany was going to spend hundreds of billions of dollars on military equipment, I would have expected the U.S. manufacturers to soar. They're not, right? Because they want to be very careful where they spend that money. This lack of trust, this American brand, I think was a real thing. We had a lot of intangible benefits. I think some of that's going away. And a little story that I think is interesting and kind of plays out. Last week, the USDA, so the Department of Agriculture, had to give $10 billion of emergency aid to farmers. They have to give the aid to the farmers because their costs have been rising. Guess what a big component of their cost is? Potash and fertilizer from Canada. So you're already seeing impacts, and I think you're seeing a very careless policy, right? They're not thinking these through right away. I am Canadian still. I haven't seen any 51st state announcement. Yep. But if I was going to play this, I would have used Canada to build the manufacturing, right? You need energy. You need all these things. You've had supply chains in the U.S. set up to use heavy crude. I would have been probably nice to Canada, suck them into the rebuilding, and then maybe screwed Canada. By doing this all at once, I think they're forcing people to turn away. And, the other thing, your previous story talked about 10 cents back, right? Jack Ma is all of a sudden back. You're seeing China start to rebuild on the world stage. I think what they did with DeepSeek is they showed, hey, we can be entrepreneurs again. I think China's the huge beneficiary of this, as every country who's facing these tariffs with U.S. now turns to China and says, what do we want?
So to back to Chris' point, though, if we do see the U.S. markets coming down 10, 20, 30%, does Europe come down? What does Europe come down in that kind
I would say roughly half. That's kind of my assumption, and I think China can
relative outperformance.
Very much outperform.
What does China do?
Maybe down a little bit, but I think they actually start rising. I think their companies have been undervalued, and if they start coming back and making these deals, people will gravitate to Chinese stocks. So you're going to have to close your eyes. You're not wanting it, and this is something I kind of view China as a trade. Are they becoming investable? Probably not. Still more a trade, but something has to change, and I think the relationship's going globally, or that becomes a trend.
So that bet on China, though, is really a bet on the Chinese government and the fiscal impulse that you're seeing from the Chinese government, the backstops you're seeing in the market. It's interesting to me that you, from a kind of voting with your money standpoint, are more in favor of that bet on the Chinese government than perhaps that bet on the American government.
Again, I'm seeing a very disjointed policy. I'm seeing things that don't seem to work, and it's almost this trifecta, right? You've got this NATO, Russia, Ukraine negotiation that seems to be confusing a lot of people. And then you've got the Doge cuts. And again, I don't think the U.S. economy was in great shape to begin with. I look at the quits rate a lot. I think that's kind of, to me, almost a, crowdsourcing data, because people know at the lower income whether they can quit their job and get a new one. That's already been ending, so I think you're going to have problems on the job front. And all these tariff ideas, yes, if there were 3 to 5 year plans to implement them and rebuild manufacturing, great. I don't see that happening. I think we're going to be scrambling. There's going to be inflation in the U.S. They're going to, I just see this breaking down globally right now.
Retailers continue to buy. The mentality of buy the dip still exists right now. How long do you think it takes for that to disappear? Because every time the market in the States has come down, it's bounced back almost like in a V-shaped recovery. Is that abnormal? 29, you get 1929. It takes 25 years for the Dow to bounce back. Is that going to be what we see this time around? Just which way around is it going to be and why?
I think that's a great point. The one thing, everyone says how bearish everyone is. You look at the ETF flows. There have not been major outflows out of the ETFs. And if you look at, to me, some of the, degen sort of ETFs, like TQQQ, which is a triple leverage QQQ, it now has its highest number of shares outstanding. So people have been buying these dips. And again, we really haven't bounced much. I think all that dip buying mentality gets wiped out. I think it's already been hit once or twice in this round. I think that keeps going down until you actually see true capitulation, like you saw during GFC, like you saw a little bit even during the European debt crisis. There's been a lot of bearish talk. I have not seen that follow through with bearish positioning. I have not seen any degree of panic. I think this is something that has to get hammered home, and maybe next week, if we get a little bounce after Liberation Day or whatever you want to call it, and then we start selling off, that could be the end of the buy the dip in the U.S. And I think Bitcoin, unfortunately, too, gets sucked into this, or fortunately gets sucked into this. And as that comes down, it drags all risk assets with it.
All right, Peter Cheer, head of macro strategy Academy Securities, probably like the most bearish person in the U.S.
Not much cheer this morning.
That I've seen. No, not much cheer this morning, but we thank you so much, of course, walking us through the volatility that we are seeing around these markets. Let's stick with that story, because when you talk about the volatility, the consistency around the tariff messaging is also a key piece, especially when it comes to how Europe will react. I spoke exclusively with the former Commerce Secretary, Wilbur Ross, under Donald Trump's first administration about that impact and what they can do. Take a listen.
If a Mercedes is bought in Germany, there's a VAT on it. And in most countries, it's around 25%. But those same countries rebate the VAT on export. So without tariffs on our side, a Mercedes would literally cost less in the U.S. than it does in Germany. Whereas in contrast, since we don't have a VAT or anything else that we can rebate on export, a car shipped from the U.S. pays the VAT. So an American car shipped to a VAT country costs more in that country than it does at home. So VAT is a component of the disparity.
Back to your first point about increasing manufacturing within the borders of the United States, critics of that strategy would say the volatility surrounding the tariff announcements is enough to disincentivize any sort of credibility that a long-term investment in the United States is a good idea. If the economics of tariffs work, do you think the execution of them is a concern?
Well, the execution is a concern, and to my mind, the simpler and more broadly based he makes them, the better.
Well, Secretary Ross, the way Donald Trump is also potentially addressing the deficit and some of the costs around the U.S. government has also been, in addition to tariff revenue, talking about reducing the federal workforce. You've seen Doge as one example of pretty swift actions in reducing that workforce. Is there anything you would do differently in terms of perhaps the end goals that Doge has?
Well, they know they have to act very quickly. And the reason is this: some of the measures probably will end up needing congressional approval. And by September of this year, all that the Congress will be focusing on will be the midterm elections. And that means they will be very unlikely after that period to do anything that's controversial. So part of the reason there's a great rush here is the political cycle relative to the congressional election. And that's why you're seeing him try to come very quickly with cuts. Now, going that fast undoubtedly means there will be mistakes. Then some of those people will have to be rehired. But that's an unfortunate consequence, but it's inevitable when you're having to travel at the speed that they are.
Wilbur Ross speaking exclusively to Bloomberg, the former Commerce Secretary under the first Trump administration. Guy, to me, what stood out from that conversation was that he's not pulling back or not even throwing any cold water on tariff policy. That's not the concern from him. It's the execution risk. It's the volatility around the messaging. And it's also the swiftness that you're seeing, not just internationally on the tariff front, but even in terms of the DOGE efficiency front, which I thought was relevant ahead of not just Liberation Day, but payrolls next week.
The market just looks for a clear path. It wants to understand what is happening. The on-off kind of strategy around DOGE, around what is happening with tariffs, is what appears to be causing concern. Because if you're a CEO, you want to make a big investment. Yeah, if I know what the land looks like, I can make that decision. But at the moment, I don't, so I can't. And that seems to be what's holding back the U.S. economy so much at the moment.
And that's exactly what Peter Cheer just referenced, right? Yeah. That ultimately, if you know how you can navigate this market, it's way, way easier to do it. With that same vein in mind, that investment in the United States in mind, let's take a quick look at that pre-market, because one of the major movers this morning is actually U.S. Steel, which is now looking and getting a little bit of a sign-off of a massive Nippon Steel investment as well. This is the company in Japan that has basically been barred from investing and taking over U.S. Steel as a whole in the United States, but it's still looking to make an investment of something like $7 billion. So that's pushing the shares higher by about 7% this morning. Lululemon also taking quite the beating. That is a tariff story. That's a Canadian activewear story as well, down about 10%. So they're going to be one on the front lines of that. And then, of course, Apple and Meta looking at fines from the European Union going into next week, so already selling off as well.
Yep, tech under pressure. It's going to be interesting to see. Those fines, I think, are fascinating. How far does Europe go on them?
Yeah.
Because it could be just another kind of catalyst to get the Trump administration riled up. And you do wonder whether or not, therefore, there's some politics around the scale of those fines. We'll find out about that next week. We are going to return to Europe in just a moment. We need to talk about what is happening in the bond market this morning. European yields under pressure, as you can see. So the bond market catching a little bit of a bid this morning. We're seeing very soft French CPI data, Spanish inflation data coming below expectations as well. What does it all mean for the ECB? Well, the market's certainly pricing in greater chances of cuts now. We'll talk about it next. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Minutes past the hour. Let's call it 50 minutes past the hour. This is what European markets look like this morning. The FTSE 100 is actually in positive territory. Some of the drug stocks are doing well. Astra's giving certainly a big push to the upside this morning, adding the most points by some considerable margin. Defence stocks and oil stocks are actually where the weakness is coming through, alongside a few banks as well. The banking story takes us to what we are seeing with the bond market this morning and what we're seeing in terms of ECB pricing. So traders lifting ECB easing bets, something slightly wrong about that. We've lifted easing bets. Anyway, there's going to be cuts, potentially more cuts coming through from the ECB. We've seen French data this morning, Spanish CPI data coming through, softer than anticipated. The French data really soft. Meanwhile, markets, of course, are waiting at US PCE data a little bit later on as well. So we're going to be talking about US inflation as we head into next week, when we're going to be talking about tariffs and jobs. So we've got it all covered around the table this morning, I absolutely promise. Valerie Teitel is here, and we've also got Bloomberg's Western Europe economy editor, Zoe Schneeweiss. So I'm going to start with you. So the data this morning, France first, then Spain, both soft. The market is repricing the ECB as a result of that. But how long is this going to last? We've got German data Monday. Talk us through the kind of the volatility we're seeing in market pricing expectations.
Yes, so the ECB repeatedly says that all they care about is data, that they're data dependent.
Don't we all?
So as we all. These inflation numbers, the ones today for Spain and France, and then on Monday, Germany, Italy, and on Tuesday, the euro area as a whole, those are the last big data point we get before the April 17 rate decision. So really, these are the numbers that should be moving things. These are the numbers that should be deciding, do we cut or do we hold? Now, the issue, of course, is that next week we have tariff week. We have the week that April 2nd, what is it called, Liberation Day, as Trump terms it, where the ECB, where this barrage of tariffs will be hitting across the world. And now the question is, will the ECB retaliate? Because if they do, that is inflationary, and that, again, could change the whole trajectory of what they do next.
All right, so Val, dive in here, because ahead of that Liberation Day, we still have a little bit of data to digest, including the PCE today and a few other figures into payrolls next week. How does that all fit into this picture?
Yeah, at least for the Fed side of the equation, we've seen a market reaction to the soft data in Europe today with Bunds rallying. I don't think we're going to see quite an outsized market reaction to PCE data today. That being because we've heard from the Fed that they are on a path of caution, a path of wait and see. And with this data reflecting CPI and PPI from February, I just think that the market is going to be in a more of a wait and see mode. They really want to see the impact of tariffs, and we're not going to see any hint of that today. But we could see perhaps a surprise when it comes to personal spending, maybe another hint on the consumer, with consumer confidence declining, and retailers, from Lululemon, from the likes of Walmart, from the big box retailers warning on the outlook for the consumer. Maybe we get a hint of that today, and that's what the market tends to focus on instead of the inflation hint.
But we've got payrolls coming. Payrolls are coming next. The whisper number at the moment is 77. if you get a weak number, it says below 77. How does the market react to that? Because that's going to change Fed pricing. We talked about ECB pricing. That's going to change Fed pricing.
Exactly. I think the labor market is what's going to change the Fed pricing. You know, if we look at what's priced in for May, the market does see the Fed being on pause again in the May decision, but a weak labor market print could really change the dynamics of that. We know that they're going to wait and see mode on inflation, but if we get a very weak payroll print, let's say a negative payroll print, you know, that's really going to start pushing up the ECB bets, or sorry, the Fed bets on easing
probably
in May.
ECB bets as well.
Yeah, maybe.
Well, Zoe, you dive in there on those ECB bets, right? I mean, if the U.S. is so focused on this kind of labor story more so than the growth story, Europe doesn't have that same problem.
Exactly. We don't have a dual mandate. The only thing we care about is inflation. Obviously, economy does play in, because if the economy is weak, then that at some point that will feed through to prices. Overall here, we have the situation, though, that central banks across, it's not just the Fed that's in hold pattern right now. Central banks across the world are holding. We just had Norway hold yesterday. Yeah. We had Sweden hold last week. The Swiss sort of did this one security cut last week, but still, overall, everyone's on hold. So the ECB doing anything is quite brave, really, and it would really be required here is that inflation is quite weak. And overall on that, one of the things that we need to look at there next week will be the services number. That's more important almost than the headline number. The headline number we know has been creeping towards 2, but the services number is still about like 3.7, which is quite massive.
Well, so it's interesting because services could be targeted by the European Union.
I was just about to say that, but Zoe, let's bring it back to that that point, and that is the ECB. I know they can't say this officially, of course, on the record, but at some point does the ECB not only have to factor in Liberation Day and the tariff impact as well, but perhaps what the Fed is doing, given that they have been on the same page in the past?
Exactly. That's what we call it, the gravitational pull of the Fed, that whatever the Fed does, all other central banks look to the Fed, and the ECB can't completely ignore what the Fed is doing. So that's the question also with if the Fed starts holding, or even if there's suggestions that continues holding, and if there's suggestion that it might even hike, although I don't think anyone's betting on that right now, that just does change the whole trajectory for the ECB.
Susan Collins was talking about this is kind of on hold all year, so there's the kind of very cautious stance being taken. They don't know yet, so they're going to wait and see. Okay, Valerie, thank you very much indeed. Zoe, thank you very much indeed. Busy week coming up. What are you doing at the weekend?
What am I doing
at the weekend?
Oh, that's challenging. Well, I've got a couple of options. I hear a solar eclipse is on the radar.
Only a partial one.
A partial, still. A solar eclipse. I hear it's Mother's Day.
Only in the UK,
Only in the UK. This is true. American Mother's Day doesn't happen till May. And then I think some stuff that's on your radar. March Madness, the Rugby Sevens.
March Madness, less so. I think that's basketball, isn't it?
Yes. Sure. I think. Sounds familiar.
I think your bracket there somewhere.
I've got my bracket, it's on my Bloomberg. The Rugby Sevens is good. So Hong Kong, new stadium, this fantastic new stadium. It has started. We've all been waiting for this. Hong Kong Sevens is an amazing thing. So you can watch that on TV. Sevens is such a great game. Had Rosalind Park this week. That was fantastic as well. So, there's some great sport coming. Look, that's the video.
Someone was telling me that there's a singer in the stadium coming up. Is that right? Is it Coldplay or someone is performing? A singer.
Coldplay. I have very mixed feelings about Coldplay, but that's neither here.
Coldplay is. I'm struggling with culture on this Friday morning.
My wife is a fan. Anyway, that wraps things up for us. Have a great weekend, folks. I hope you enjoyed this week. Next week is going to be quite the week, so make sure you tune in. The Pulse is coming up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
A powerful earthquake rocks Myanmar, shaking buildings and triggering evacuations in neighboring Thailand and Vietnam. A draft document obtained by Bloomberg shows the US is pushing for control of major investment deals in Ukraine. Plus, China seeks to woo investors. President Xi Jinping promises improved market access at a meeting with global business leaders. Let's check in on the European equity story then. US stocks, the S&P 500 set for its worst quarter since 2023. A little bit more subdued in Europe as we wait for the inflation data out of the US. Some upside coming through for the UK though. The FTSE 100 gaining 0.3%. It's the retailers, it's the likes of M&S and Sainsbury's in the mix. They're higher so far in the session. Over in Germany, the DAX down 0.3%, though the pressure has somewhat eased on the auto sector after the significant sell-off yesterday on the back of those 25% tariffs. The CAC over in France down 0.3%. Let's flip the board and have a look across asset. The inflation story front and centre. There's more action in the bond markets and the equity markets of Europe, at least for now. Bonds are bid. Treasuries, German bunds as well. Yields lower, price up on softer inflation out of both France and Spain, with bets now being pulled forward for the ECB. April very much in play, potentially up to 60 basis points of additional cuts this year is what traders are currently expecting. S&P futures then currently pointing lower by 0.2%. Euro dollar at 107. A little softer on the single currency on that inflation print, down 0.2%. There's the move then in the benchmark German bund. Yields down 4 basis points, 273. Gold at fresh record highs, 3,072, up 0.5% in the session. A reminder of the risk-off tilt that we're having in terms of that safe haven bid for the yellow metal, up 40% just in the last 12 months. So for the conversations that matter and the insights you need, let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Let's start with a developing story. A strong earthquake rocking Myanmar, shaking buildings and triggering evacuations in neighbouring Thailand and Vietnam. A second tremble was felt soon afterwards. Let's get the latest then now with Bloomberg's Vietnam Bureau Chief Francesca Stevens, who joins us out of Ho Chi Minh City. Francesca, thank you for joining us. What is the latest?
Yeah, look, it's been strongly felt across the region, this earthquake in the Thai capital. People fled out onto the streets. We understand that at least one person is dead and around 50 people are injured after a 30-story building collapsed in Bangkok. That's according to emergency services there. That building had been under construction and one person is believed to remain trapped under the rubble. The Thai Prime Minister has now declared a state of emergency. The stock and futures exchange has halted trading and Thailand is setting up a 24-hour emergency centre. In Bangkok, the Transport Ministry has ordered all public transport services to suspend services immediately. And the central bank there says it's monitoring the situation closely, but has confirmed that payment services and financial services remain fully operational at the moment. The impact on the industrial parks and manufacturing hubs, that's yet to become clear. Now, as I said, the tremors were felt across the region. Here in Vietnam, our building in Ho Chi Minh City shook and our office on the 14th floor in the centre of the city was evacuated a short time after. In Hanoi, hundreds of people rushed out of high-rise buildings after feeling the tremors there. What's not clear at this stage is quite how bad the impact is in Myanmar. A state of emergency has now been declared in Mandalay and the capital Naypyidaw, as well as some other regions. But of course, details are still trickling out across the region about the extent of the damage.
Okay, an important update. Bloomberg's Vietnam Bureau Chief Francesca Stevens in Ho Chi Minh City. Thank you very much indeed. Let's get to a Bloomberg scoop now, because we have learned that the US is pushing to control all major future infrastructure and mineral investments in Ukraine. A draft document grants the US first claim on profits transferred into a special reconstruction investment fund and requires Kyiv to pay for all US military and economic support since the start of the war. Bloomberg's EMEA News Director Ros Madsen joins me now for the latest. What more then, Ros, do we know about this document?
Well, as you were saying, it's quite an extensive document, and it is about really the parameters of this so-called partnership, or really what they call a reconstruction fund, and the terms of that. And we can see that the US is saying that under those terms, they would have first right of refusal on all investment projects in not just critical minerals, but in infrastructure. So we're talking roads, railways, ports. We're also talking, of course, oil and gas, not just critical minerals, the ones that Donald Trump talks about quite a lot. So it's a very extensive level of US oversight of investment into Ukraine as a whole, and of course a slice of the profits there, and saying that the money that the US has paid in military and economic aid to Ukraine since the war began is essentially the US equivalent of the investment in this fund, and therefore it's all on Ukraine now to pay the rest. So ostensibly a vehicle for Ukraine to repay the US for the money that it sent in economic and military aid. So certainly a lot of advantage there for the US over how money is going into Ukraine, where it's going, and where those profits end up, squeezing out Europe from the reconstruction picture potentially, and a lot of opportunity for US companies. The question is it a deal that Ukraine can accept, or is it a deal that Ukraine has no choice but to accept?
Yeah, and we know, I believe, that Ukraine has sent a counter-proposal. So we watch for movements on that front, how much progress there is towards signing that potential deal, if signing it is what comes to pass. Meanwhile, we've been hearing from the Russian president himself, Vladimir Putin, and making what seems like a new intervention in terms of how he thinks things could be resolved in terms of the governance of Ukraine. This, of course, coming from the Kremlin.
Well, that's right. So Vladimir Putin has lots of views about the government in Ukraine, and it's a long refrain from him questioning the legitimacy of the administration of Volodymyr Zelensky. Of course, a government that was democratically elected in peacetime. This is not an emergency government cobbled together for war on a temporary basis. This was a government that was elected well before the war, but it's a familiar refrain from Vladimir Putin. This government's not legitimate. There needs to be a way to evict it. He really doesn't like Zelensky personally. So it's not that new from Vladimir Putin, but it's the sort of thing that you can imagine him getting in Donald Trump's ear on when they talk, because Donald Trump has also questioned why are there not elections in Ukraine? Why is Zelensky refusing to have elections? Of course, he can't under martial law, under the Ukraine constitution. He cannot hold elections right now, but you can imagine that maybe Putin getting that narrative again to Donald Trump, and then Donald Trump perhaps further questioning, again, the legitimacy in his eyes also of the Ukraine government. And that's really the risk in all of this, is the narrative between Vladimir Putin and Donald Trump on it.
And you touched on something really important, which is that we have seen in recent history evidence of the Trump administration essentially echoing talking points that originate in Moscow, in the Kremlin, and then picked up by the Trump team. So maybe this is a tactic, as you say, by Putin to do just that once again. Meanwhile, European leaders trying to contend with the shifting sands around this. Macron hosting a summit, of course, in Europe, in Paris. They have ruled out, the Europeans ruling out, certainly the French have, in terms of easing back on sanctions on Russia. Let's listen into the French president.
En termes de soutien de court terme à l'Ukraine, nous avons aussi
We unanimously agree that the time is not right for lifting of sanctions, whatever they are. There shouldn't be a policy of lifting sanctions before peace is clearly reestablished.
Okay, the French president speaking there. So, Ros, where does this leave the question of sanctions and the question of Europe's role in continuing to impose those sanctions?
Well, that's the question. Because you can see from the US, clearly the trajectory is towards easing off on Russia. We saw that as part of the initial agreement for this ceasefire in the Black Sea. The US saying we will find ways, to ease up the insurance burden on shipping, for example, on fertilizer and agriculture on Russia, and ways to quite improve the payment system, which is really code for SWIFT, the international payment system. And so the US is going in one direction, Europe in another. And Europe may say that we'll keep sanctions on. Of course, those are penalising Russia, including in the banking system. But it's very hard for them to keep that line against the US. So you're going to see potential tension there. I mean, the one thing that could be interesting is that SWIFT is actually headquartered in Brussels, not in the US. And so there is some decision-making involved there from Europe about SWIFT. So perhaps that's going to be really the point of tension between the EU and the US, is where does this leave the SWIFT payment system, which is really important for Russia to get back into the tentacles of the financial network globally.
So that divergence once again between Europe and the US when it comes to how far to tighten or loosen those screws on Moscow. Ros Madsen, thank you very much indeed. Of course, Bloomberg's EMEA News Director with the update there. And we stay on how this is tying in to China and Beijing's calculus, the eroding of that transatlantic relationship between US and Europe, and the way that China can play a role in maybe taking an opportunity here, because China's president has been meeting with global business leaders in the Chinese capital in an effort to boost international investment. Xi Jinping sat down with representatives from more than 40 companies, including FedEx, Standard Chartered, Sanofi and AstraZeneca. He promised to improve market access as US tariffs raise uncertainty.
In recent years, foreign investors in China have also been affected by geopolitical factors. We have always believed that maintaining the stability, health, and sustainable development of China-US relations is in the fundamental interests of the peoples of both countries.
Okay, joining us for a wider look at the markets on what has been, of course, a significant week again on the tariff story, and we lead up to April the 2nd and what Trump is calling Liberation Day with those quote-unquote reciprocal tariffs. Let's bring in then Ekla Felder, then the EMEA CIO at Lombard Odier. Good morning. Thanks for joining us in the studio. Lovely to see you. How are you thinking and how are you modelling the tariff impact? Is it still underpriced by the markets, or is the adjustment now being made?
I think it's still not fully priced by markets. We have found it very helpful to understand what reciprocal means. It means country by country because the starting positions are different. We have found it useful to distinguish the countries that where the US is running a high trade deficit versus the others where it's not so much the case, and also where there are big tariff differences. And out of that, you can chart basically three groups of countries with different levels of average tariffs that could pan out. From that, I think that there is also room for negotiation, and that has been a way to distinguish how countries are likely to be affected. At the moment, certainly there are markets that are not really pricing fully in the stance, the responses that countries have taken. Some of them are more confrontational, looking at retaliatory measures, and others are much more on a negotiation path.
Well, certainly the repricing has been happening in the auto sector this week, hasn't it, on the back of those 25% tariffs. So it's expected to kick in on April the 3rd. The benchmark in terms of the Stoxx 600 Autos Index, it's down, I believe, about 25% in the last 12 months or so. It's looking pretty cheap in comparison to the Stoxx 600, almost a discount of almost 50% on some metrics. When do you look at the auto sector of Europe and think this is a buying opportunity?
I think it's perhaps a little bit early there, and I would also say that auto sector is one, but the next sector that might be affected is pharma. This is why I'm thinking that at the moment there is not yet a full picture, because to be honest as well, there has been a lot of noise and back and forth. So I feel that come April 2nd, there might be still some adjustments to expect.
Well, that's really interesting. On the pharma sector then, as an investor, do you want to be looking at the way that the auto story has evolved this week and pricing appropriately? Is this a case study that needs to be applied to the pharma sector now?
Well, we have to differentiate a little bit, because in pharma it may not be a blanket tariff that is imposed. I do, however, think that a number of indices, for example, take the Swiss index, which has a lot of pharma in there, might actually go through the same adjustment. Since the beginning of the year, both the European indices and the Swiss, for example, have had a wonderful upside, and a lot of good news is reflected in there. Perhaps some of the bad news that was difficult to see through is not fully there. Okay, so maybe some complacency in the Swiss market around the potential pharma impact. We look ahead to earnings. Is the earnings story, the next round of earnings, is that where we get a little bit of clarity on the fundamentals? Is that when you want to start putting in place significant positioning? Is it earnings that we need to get through before we have a bit more clarity on this? I think earnings are going to be a good reality check, for sure. And there are a number of strengths that, for example, some U.S. sectors are coming to the fore. We find, for example, that now after the underperformance in communication services, there's probably going to emerge a good buying opportunity. And we look forward to earnings actually giving some of these confidence back into investors' flows. On the question of the spend from Germany, the fiscal impact, there's the infrastructure piece, there's the defence piece. Some of it will take longer. There are shovel-ready projects in some areas, not in other areas. Arguably, defence is more of an open book in terms of how much Germany can now spend. Are the markets underestimating how much money is going to be put to play in some of these sectors? Again, on the pricing around the fiscal impulse coming through from Germany, where do you sit? I think the fiscal impulse, for example, in 2025 is probably not yet going to be very big, to the point that some of these spending is going to take time before it really feeds into the economy. Most of that is going to be visible in 2026 and probably 2027. So if you think about how the market has reacted, I think that some of these good news is already priced. For example, GDP forecasts are being upped a little bit in not only Germany, but in the rest of Europe. But I feel that a lot of these news are actually fairly into market expectations. Okay, Nanette, thank you very much indeed. Always smart analysis on these markets. Maybe Switzerland seeing a bit of complacency, maybe some opportunities in the communication space, and looking ahead to earnings as well in terms of the proof being in the pudding on some of these questions. Nanette Eckler-Verderbe, EMEA CIO at Lombard Odier. Thank you. Coming up, we're going to head to Brussels to speak with the Director General of the European Auto Manufacturers Association following that 25% tariff on autos. That conversation coming up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. Happy Friday, everyone. Let's check in on European automakers after yesterday's pretty remarkable slide, of course, following Donald Trump's announcement of a proposed 25% tariff on US auto imports. You can see some pricing pressure coming through, again, for the likes of BMW, Mercedes-Benz down 0.8%. And, of course, you have VW down at the bottom, dropping almost 2% after the sell-off. So continuing the sell-off, the pressure continues on the automakers, particularly with the focus on Germany. We'll wait, of course, both European countries and car makers, how they intend to respond to those levies. To explore some of their options, we're joined now by Sigrid de Veer, who is the Director General of the European Auto Manufacturers Association. Sigrid, thank you very much for joining us. How damaging are these auto tariffs likely to be for your members?
Potentially very damaging for our members, but also for transatlantic relations, for the economy as a whole. There's a lot of tension, obviously, globally, this comes on top of already very challenging times. We're at a watershed moment for industry in the midst of a huge transformation and fierce competition, this is very disruptive, and we really hope this can still be averted.
If it's not averted, Sigrid, give us your expectation of just what that damage looks like. We've seen the factory closures. We've seen job losses already at these major auto makers, particularly in Germany. Do you expect to see an acceleration of job losses? Do you expect to see further factory closures if these tariffs are imposed and not removed?
Yeah, I mean, just maybe to start putting the magnitude of all of this a bit into the picture. The US are the second most important export market for European manufacturers, just after the UK. And the value of cars exported to the US represents about 40 billion euros. It concerns close to 800,000 vehicles crossing the Atlantic into the United States. That was 2024 figures. Now, that comes on top, of course, of operations that our members, European manufacturers, have in the US, where they also produce well above 800,000 vehicles each year. So this already, I think, signifies also the deep and intertwined supply chains and industrial relations built over decades to serve local markets, to serve customers well, to build interesting vehicles, advanced vehicles, and just the magnitude of that and the numbers I just gave you tell you something about, okay, at 25% tariffs, that represents a huge amount of money with impact that needs to be digested. It will have to be digested on the US side. Prices may go up, inflationary pressure less consumer choice, perhaps, if manufacturers would make the choice to import not all of their models any longer. And this is just one option, and I can't speak for any of them. They will make their own strategic portfolio decisions. But indeed, also in Europe, it will have an impact, because if export opportunities are dampened, revenues will go down, there will be pressure on employment. The value chain, the supply chain will suffer. Again, also that will have directly and indirectly an impact on all of the economy over here as well.
Okay, given that impact, what do you want the EU response to be?
We'd like to see a balanced response, within all the constraints, and as far as possible. We understand that the EU must take an assertive stance, be firm in its attitude, and we've seen that also in the immediate responses, quite stark and vocal commentary coming out of the EU, the European Commission, but also several member states. So yeah, they need to respond. We're now waiting to see what actual measures they may take. But we also insist, and we also hear that back from them, that the door to further conversations, to a negotiated solution, should remain firmly open, because an escalating trade war is in no one's interest. And we hope that this realization will sooner than later also sink in on the other side of the Atlantic, and that there will talks about how can we resolve, what are the actual underlying issues, what are the concerns, what are the needs, and how can they be resolved in a way that doesn't do any damage.
So, I mean, so far there's little evidence that message is cutting through to the Trump administration, to the president himself. So what is your level of confidence, Sigrid, that this can be negotiated away?
No, you're right. It doesn't look very promising at the moment, but we should stay firm on that course and demonstrate also with facts what the impacts might be. And we can hear it left and right coming from industry, from analysts, from policymakers. So yeah, we need to keep investing in that dialogue, in that conversation. At the same time, I think not just on the business side, manufacturers will take measures to do damage control, to mitigate their risks. But we also need to look at Europe. I mean, you can't really influence what's happening elsewhere in the US or elsewhere in the world as much as you might want to. So you need to have your own house in order as well. And that means for Europe to make sure that it becomes stronger, more resilient, more competitive. So that's a great place for businesses to invest and to maintain their operations. And I think that's a huge task that Europe is facing now as well.
Sigrid, does that involve, are you lobbying for more support for the auto industry?
Well, I think it's too early to say, because we don't know what measures exactly will take effect and for how long, and what the impact then would be. But we do believe, and also with the strategic dialogue that Commission President Ursula von der Leyen has set up on the future of the automotive industry, and recently announced an action plan also, I think there is a real realization that competitiveness, economic security altogether are really important, and that the auto industry is a strategic, critical industry to have within the boundaries of, in this case, our European economy. And that's where a lot of focus needs to be, and whether then support measures, but they can take many shapes and forms, whether they are part of that. I think that's a realistic discussion to have. But in the end, it will be a broad package of measures that can be taken, and that will be necessary.
Are Chinese automakers the ultimate winner at this point?
Well, I don't like talking in winners and losers so much. I mean, it simplifies things so much. And I think that goes beyond the point. I think there's a lot of competitive pressure currently, of course, for the transformation towards electrification. Chinese manufacturers are very well set up, and they also control very important parts of the value chain, of the supply chain for battery, from raw materials to refining components.
Sigrid, we really appreciate your insights. We've run short on time, but thank you. Sigrid de Vries, the European Auto Manufacturers Association Director General. Coming up, more, of course, on President Trump's so-called Liberation Day. Stay with us. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Myanmar struck by its biggest earthquake in a century, shaking buildings and triggering evacuations in neighbouring Vietnam and Thailand. A draft document obtained by Bloomberg shows the US is pushing for control of major investment deals in Ukraine. Plus, China seeks to woo investors. President Xi Jinping promising improved market access at a meeting with global business leaders. Back to the tariff story now, where Prime Minister Mark Carney says Canada will fight back against President Trump's trade war, but declined to outline specific actions. Carney says his government will respond based on what the US does next Wednesday, when Trump plans to announce so-called reciprocal tariffs. Canada has already imposed retaliatory levies on over $40 billion worth of US products.
We will fight the US tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. We will protect our workers and our industries during this difficult period.
Okay, let's bring in opening trade anchor Kriti Gupta then for more on this week's tariff salvo. We also heard from the Prime Minister of Canada saying that the US was now no longer a reliable partner for Canada. Kriti, where do we stand in terms of the tariff story? It's been another week where it's been whiplash, rhetoric changing, the action on 25% around the auto market. Where are we now, and how does it set us up for April the 2nd?
So the auto tariffs are the most definitive action you've got from Washington when it comes to tariffs, simply because, to your point, we have seen this kind of tit for tat or even threats being imposed, and not an actual start date of these tariffs or what these numbers actually are, not to mention what they actually apply to. So these auto tariffs that we got this week are the very first time that not only markets, but CEOs, investors, economists, and even analysts are saying, actually, well, now we know what that looks like, and we know the kind of second phase of that, which is not just autos, but the auto parts industry as well. So it's easier, in theory, at least, from a kind of cost management perspective to say, all right, well, the supply chain looks like this. Here's how we can manage around it. So that is one piece of this equation, but there are more coming, as you point out. And I think that's where it's really crucial, because with auto tariffs and the early indications that he would issue them, he also mentioned things like pharmaceutical products. He's also mentioned things like really every other sector except for the energy infrastructure. And I think that's a really key point when it comes to what Mark Carney had to say about the Canadian response is, one, they're waiting for what a reciprocal tariffs actually looks like, which we're going to get next week on, quote, Liberation Day, but also what levers they have to pull. Canada has a massive energy infrastructure that would have as he says, maximum impact on the United States and minimum impact on Canada.
Yeah, and you touched on the pharma sector. We had the CIO of Lombard Odier, Nanette Eckler-Ferder, on with us at the start of the show, saying that the pharma sector is not fully pricing in the potential impact, and maybe look to what's happening in the auto sector this week for a guide on that. We started the week with some positive mood music, suggestions that maybe those reciprocal tariffs come April the 2nd will be more moderated, will be more targeted. Where do we stand now when it comes to April the 2nd, quote-unquote, Liberation Day?
Well, the math is still so tricky, and I know I'm kind of saying the obvious here, but it's also because not only are we looking at sectoral tariffs, which is what this week has all been about, but it's also been a thing of how do you quantify non-tariff barriers, things like EU regulation, which of course we're expecting fines on Meta and Apple from the EU Commission going into next week, things like VAT, for example. These are some of the things I put forward to his former Commerce Secretary, Wilbur Ross, in an exclusive conversation yesterday. Take a listen.
Non-tariff trade barriers are in many cases even worse impediments to our trade than the tariff barriers. If a Mercedes is bought in Germany, there's a VAT on it, and in most countries it's around 25%. But those same countries rebate the VAT on export. So without tariffs on our side, a Mercedes would literally cost less in the U.S. than it does in Germany. Whereas in contrast, since we don't have a VAT or anything else that we can rebate on export, a car shipped from the U.S. pays the VAT. So an American car shipped to a VAT country costs more in that country than it does at home. So VAT is a component of the disparity.
So Wilbur Ross, the former Commerce Secretary over in the United States under the first Trump administration, he also made the point in that interview that he's worried about execution risk. So he says tariffs are the sound policy. They make a lot of sense, as he just talked about. But the swiftness, the volatility of not just tariffs, but potential layoffs within DOGE and the domestic policy, that's where you could see some mistakes potentially being made.
Okay, some important insights then from Wilbur Ross, brought to us by you and that interview. Kriti Gupta of the Opening Trade, thank you very much indeed. Now, concerns around the US economy are fueling a rally across emerging markets. The shift is being led by expectations that President Trump's tariff policies will weigh on US growth and force traders to look abroad. It's pushed portfolio managers into scooping up everything from Latin American currencies to Eastern European bonds. For another perspective, let's bring in Julia Pellegrini, lead portfolio manager for emerging markets fixed income at Allianz Global Investors. Julia, thank you very much for joining us in the studio this Friday morning. What are you seeing in terms of flows into EM fixed income at this point?
It's been an interesting year again. We come from about 3-4 years now of negative flows to the asset class, about $70 billion in terms of outflows from the asset class from institutional investors. This year started again in a subdued manner in terms of flows from institutional clients. However, we have seen interesting new trends coming up. We have a growing base of local investors, i.e. investors in emerging markets that are interested in buying their own euro bonds, their own dollar-denominated bonds issued by their government. And also China stepping up purchases of emerging market debt, particularly in jurisdictions like the Gulf and other investment-grade rated emerging market opportunities. So it's a mixed bag. I think what will be important to see is how we go from here in terms of the policy outlook. We've got the big reveal next week, President Trump's Liberation Day. Very important to watch, most importantly for, again, the policy certainty outlook. Will it improve it or will it keep it rather unsettled?
Is the domestic buy that you're seeing of those euro and dollar denominated bonds a signal? Is that a canary in the coal mine for international institutional investors to start shifting in terms of significant flows into EM fixed income? Or what is it that triggers that? You saw the outflows, as you said, in the last few years. What triggers significant inflows from international investors?
I think what will help the asset class getting new flows from institutional investors is definitely, again, policy predictability on the part of the DM world. We're seeing a lot of improvements in terms of fundamentals on the EM world side. Certainly, rating agencies agree with us because now 10 years of improving fundamentals, despite the hit we saw with COVID, have produced an asset class that is 50% investment grade rated, which is an improvement in fundamentals. Of course, as investors, we're sort of forward-looking students of the market, so we want to position in those stories that still have a way to improve further, that pursue economic reforms, etc., where you can see more work being done and those price dislocations, something you can take advantage of. But I would say, by and large, emerging markets have done some of the groundwork. What we need to see is more policy predictability, particularly on the DM front, some stability in terms of US growth, that outlook being a bit clearer. And I think flows will come back to the asset class because yields are appealing. Yes, valuations are not all out cheap, as you were noting. We have gone a long way, but there are many opportunities because we're talking about a very diverse asset class. We're talking about 80-plus countries, half of it, again, investment grade rated, excuse me, but in general, a lot of opportunities to pick from.
How does softer dollar play into that? The Bloomberg Dollar Index is down about 3% year to date. Local currency bonds, is that where the greater impact is felt when it comes to softer dollar in terms of the lift that could come through there? How are you thinking about the dollar trajectory through this year?
Yes, we've seen definitely a couple of good months for us, especially at the start of the year, where that dollar dominance was called into questions after Mr. Trump's first pronouncements at the White House. So we've seen emerging market FX doing much better than expected. Again, valuations are now more a fair value. So going forward, what you'll have to do is pick out what you think will be the winners. Tricky to say, we've got tariffs coming up, but there are pockets of value. We're seeing central bank in Brazil, really keeping up with its tightening in order to control inflation. We're seeing interesting opportunities in South Africa, even in Turkey, despite the recent bout of volatility. So there's a lot going on, but for active investors in emerging markets, if you can select those opportunities, you've got a lot to play with.
Well, you touched on Turkey, and for good reason, obviously, given all the headline news and the political risk that some would associate with that country now. Where's the opportunity in Turkey?
Well, what we're seeing is that the central bank has really stepped up in its role of essentially price stability guarantor. It's done a lot of work in recent months to start that disinflation process. It has had a very successful run. The recent bout of uncertainty triggered by the arrest of Istanbul Mayor Imamoglu has obviously led to a number of foreign investors exiting their positions, their long lira positions. Now, the central bank has stepped in by saying, I'm ready to support the currency with FX intervention. FX intervention has been significant in the last 10 days. We've also seen a tightening liquidity with a series of measures. It's got more tools at its disposal, so it can do more if needed. We've seen the situation stabilize. Obviously, what will be key is to monitor two things, we think. The first one, not to see an intensification of popular protests that we've seen in Turkey on the back of Mr. Imamoglu's arrest, and most importantly for international investors, also a nipping in the bud of any potential dollarization trend. We need to see locals maintaining their confidence in their own currency. If that is the case, you've got most likely lira stability ahead of us, and hence an interesting investment opportunity.
Okay, really interesting in terms of the factors to look for in Turkey before you want to maybe expand your exposure or even dip your toe into that market. India, I know, is a market that you're active in as well, as of relatively recently. What is the Indian opportunity, if there is one? How are you thinking about India in fixed income?
Yeah. India is an interesting one. The currency has been an opportunity that we played. It's had its round of ups and downs, but by and large it remains for us an interesting opportunity. India is a growth story despite some hiccups more recently. We will have to monitor very closely what happens next week. Indian officials have been at times rather vocal, saying we have a special relationship with the US. We are cultivating that relationship. We do not expect significant tariffs coming our way. We are not so sure that will necessarily be the case from the White House viewpoint. It's really hard to say. None of us has a crystal ball, but I think it'll be important to see how Mr. Trump then develops that relationship from his side of the story towards India, and that will have an impact on asset prices.
Okay, it's the gravitational pull, isn't it, of Trump's tariff regime, April the 2nd, April the 3rd. Really fantastic analysis across the fixed income market and how you can still find opportunity, particularly in the EM space, euro bonds and dollar bonds as well. Juliet Pellegrini, lead portfolio manager for emerging markets fixed income at Allianz Global Investors. Thank you. Now, this week's weekly documentary looks at the rise in India's stock market. Staying on India, tens of millions of Indians have invested in stocks for the first time. But more recently, markets have stumbled. Is it a blip or a sign of something bigger?
In today's India, trading can be a real song and dance.
Over the last few years, we have seen a significant rise in retail participation in India's booming equity markets.
Up until last year, growth in India overtook major markets across the world. Here's the S&P 500, and here's India's MSCI index outpacing it. But recently, the market's taken a turn.
India's stock market is headed for the worst month in a couple of years.
Well, stocks in India have wiped out, though, over $1 trillion from their market value.
Despite the volatility, retail investors in the world's most populous country are still pouring money into the market.
I'm not worried at all about India's current market downturn. In fact, I see it as a very, very good opportunity.
The country's expanding middle class traditionally saved in real estate, precious metals, or cash. But now,
Indian households are preferring to put their earnings in better yielding instruments like equities.
This has regulators on edge, especially as unscrupulous opportunists exploit those new to trading. So, what's led to this boom in everyday investors in India, and why is it making regulators worried?
And you can see that Bloomberg original documentary in full at Bloomberg.com and on the terminal. Elon Musk says he's aiming to cut government spending by $1 trillion by the end of May. He told Fox News he believes the Department of Government Efficiency, DOGE, can achieve the savings without affecting critical government services.
They may characterize it as shooting from the hip, but it is anything but that. Which is not to say that we don't make mistakes. If we were to approach this with the standard of making no mistakes at all, that would be like saying someone in baseball's got to bat 1,000. That's impossible. So when we do make mistakes, we correct them quickly, and we move on.
To the UK now. Analysis by Bloomberg Economics suggests that this country and the Chancellor, Rachel Reeves, has already had her fiscal headroom halved. Some of that's being readjusted today because you've seen a bit of a bid for gilts, just days after saying she'd restored it in full to £9.9 billion. According to the calculations, financial market moves since the OBR shut its forecast window last month have wiped about $5 billion from the buffer, underlining the fragility of Reeves's fiscal plans. That's pounds, of course, not dollars. We still remain wedded to the pound here, at least for now. Now, Anthony Albanese is seeking to become the first Australian Prime Minister to win consecutive elections after calling a vote for May the 3rd. It's expected to be a closely fought election campaign focusing on cost of living pressures and a housing crisis. Liberal leader Peter Dutton kicked off his campaign asking voters if they feel better off now than they did 3 years ago when Labour was elected. Coming up, European yields drop amid softer French and Spanish inflation data. We're going to dig into the numbers. What does it mean for the markets? What does it mean for the ECB? That's coming up. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is the Pulse. I'm Tom McKenzie in London. Ubisoft shares gaining in Paris. That's after the video game maker said it will carve out a unit, including Assassin's Creed, Far Cry, and Tom Clancy's Rainbow Six, into a subsidiary with an enterprise value of about 4 billion euros. Tencent will invest 1.16 billion euros to acquire a 25% stake in the new entity, which will hold licenses for the intellectual property of the games in exchange for a royalty. And CoreWeave in the US has raised $1.5 billion in a heavily downsized IPO. The cloud computing provider was at one point looking to raise $4 billion at a valuation of more than $35 billion before the stock market slump. CoreWeave was an earlier adopter of NVIDIA's graphics chips and is building out data centers to offer AI-linked computing. Now, to the Eurozone and the story on inflation. Traders lifting ECB easing bets as French and Spanish CPI came in softer than expected early this morning. Meanwhile, markets await US PCE index data, of course, later today, a key gauge for the Federal Reserve. For more on this, let's bring in our markets reporter Valerie Teitel and Bloomberg's Western Europe economy editor Zoe Schneeweiss. Zoe, let's start with the inflation story in Europe then. Good news for ECB policymakers. Where does it leave the trajectory for the European Central Bank?
Well, good news for ECB policymakers who are on the dovish side. Sure. Those who want to cut in April, and that rate decision is on April 17th, they just got a bit of ammunition to say, yes, the inflation is slowing. As a reminder, euro area inflation, and we get the number for March, not until next Tuesday, but in February the number was at 2.3, which is a slowdown, but again, the ECB has a 2% target. So the hawkish side of the ECB has said, we still are considerably above 2%. We need to cool it. This would be an opportunity to actually hold here. In a way, these numbers now, the ones we got today, we'll get more of a perspective of them when we get the German numbers on Monday and then the euro area numbers on Tuesday. But of course, the big thing that could throw everything is the tariffs that will probably hit sometime mid next week from the US.
So the tariff story could derail the assumptions around an April. The next cut being April for the ECB.
Yes, completely. Especially if there's retaliation. Any retaliation will be inflationary, and that then would be an opportunity for the ECB to say, let's just pause for now and see how the cards fall. Because April is very soon. I mean, the rate decision is very soon after those tariffs actually would be announced.
Okay, let's bring Valerie Teitel, our markets watcher, markets reporter, in on this as well. The inflation story of the US front and centre later today, with the PCE gauge, of course, coming out. To what extent are we going to get any sense of the tariff impact in that PCE mix? To what extent is this backward-looking? How much of a focus should the markets put on this number?
Yeah, you're right. It is a tad backward-looking. It's the last of the big 3 inflation indicators for the month of February for the U.S. Economy. And to that, guys, I think at least for the central bankers who are watching this print, it's really more in a wait-and-see mode. They need to see some clarity of the tariff impact and inflation. I don't think we're going to get that in the month of February in this print. What we could get a hint of, though, Tom, Tom, is in the personal spending data. Remember, we're kind of on tetherhooks, waiting to see when some hard data of a maybe consumer spending pullback does show up. We've seen it in consumer confidence and the more softer surveys, but perhaps the market reaction could hinge more on the personal spending bit of the PCE data today, which could give us some hint on the consumer.
Yeah, and you flagged for us earlier that the Lululemon results were soft as well, disappointed, and that stock dragged on some weakness that they are seeing, at least when it comes to the US consumer for their goods. The market's right to be thinking, if you're a market participant and you're looking at April the 2nd next week as maybe an opportunity to kind of clear the decks and at least get some clarity on the tariff story, is that the right way for markets to be thinking about it, if indeed that is your perspective?
Well, I think the markets are starting to question, are we past peak policy uncertainty coming out of the Trump administration? We know that the tariffs have been part of his agenda, right? And if he is going to be announcing, more of his end game next week, perhaps, that does open up the way for a risk asset rally if some of this uncertainty is behind us. But again, it opens up the question of retaliation. If this continues to be a long, drawn-out negotiation that could perhaps even weigh more on the consumer, this underlying or overhanging uncertainty be drawn out for longer. So maybe two sides of the argument there, one for further clarity, one that it keeps dragging on. But there is some chat out there in the market that maybe he announced the auto tariffs early because that was the more hawkish side of the tariff announcement. And maybe he wanted to make Liberation Day a day where equities could rally. And in that sense, the tariffs could be lower than we
Okay,
think.
that's interesting. So that would revive the idea that the S&P 500 is something of a guardrail for this president, which has been, that thesis, of course, has been challenged this time around. Zoe, when it comes to what is the understanding amongst economists that you and the team speak to about the impact of the fiscal spend coming through from Germany on defence and on infrastructure, and to what extent that shelters or at least offsets some of the tariff pressure?
If there weren't that huge German spending package, obviously the situation would be a lot worse. The problem is the German spending will take quite a while to kick in. We don't have no idea how much they actually will spend on military spending, on defense spending. They basically have carte blanche on that. We do know on infrastructure they'll be spending $500 billion, and that $500 billion, though, is over 10 years. And the issue here is that Germany, we know they don't have enough. The labor market is starved. They don't have enough people to do all these, they don't have enough workers, so it will take a while to kick in. In a way, it protects them to a certain extent. The economy shouldn't do as badly as it would have just from the tariff impact. But still, it's one of those, we need patience. And at the current, and if you're faced with rate decisions every 6 weeks, patience is something that's sometimes difficult to explain to markets.
Well, yes, certainly. Some pockets of the market is not having a huge amount of patience. Valerie, before we let you go as well, this is your area of expertise, the bond markets in particular. There's a rally for bonds. That seems to be really the kind of asset story of the moment. Yeah. How much of that is down to softer inflation out of the Eurozone? Is there something else going on here? What do you make of the moves today?
The moves today, I think, are driven mostly by the softer CPI data. I think for the U.S., the bond market really hinges on any hints we get from the consumer, right? If you want to think about a big Treasury rally, it would be because the U.S. consumer is softening and we start to get that in hard data and maybe think that the Fed is about to react to it. They're more likely to react to kind of downside hints on the economy, like, for instance, next Friday's payroll. If we get a big soft print there, maybe we'll start speculating that the Fed could cut in May.
Okay, excellent. Valerie Tantal, thank you very much indeed. Our markets reporter, of course, but also Bloomberg's Western Europe economy editor, Zoe Schneeweiss, giving us the analysis and the context around the inflation data out of France and Spain, and looking ahead, of course, to April the 2nd next week with a focus on tariffs. Now, as we head into the weekend, here's one for you, maybe, and friends. Bloomberg.com has a new game for you. Hurrah! It's called Pointed and is described as the news quiz for risk takers. Players use strategy to navigate trivia questions about the week's news in markets, politics, luxury, culture, and more. Hopefully, we've answered some of those questions for you. The more you know, the higher your score, and you can play for the first time ever at Bloomberg.com/pointed. Up next, Bloomberg Surveillance.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area where the regulators said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Trade and tariff cannot be taken lightly.
The administration is moving forward with fairly aggressive tariffs.
We have now the highest effective tariff rate we've had since the 1940s.
What is the probability that beyond next week we're putting completely to rest the tariff issue? That probability is probably very, very low.
April 2nd is not the beginning of the end. It's the beginning, and there's a long way to go before that end.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday with another company ringing the alarm on the consumer. Lulu shares plunging after the company delivered a disappointing outlook for the year, voicing concerns about consumer spending. The CEO flagging, quote, a dynamic macro environment that's contributed to a cautious consumer, leading to a material impact to traffic across the industry. Add that to a growing list of concerns from consumer-facing companies, concerns captured by weaker consumer confidence in the face of much, much higher trade tariffs. The White House seemingly aware of those concerns. The Journal reporting this morning, quote, when President Trump convened CEOs of some of the country's top automakers for a call, he issued a warning. They better not raise car prices because of tariffs. And guess what? Raising prices is exactly what people think they will do.
They have no other choice. If they eat it, it's a multi-billion-dollar hit to their bottom line. You could say, well, they should just make less money. But if they want to invest in factories, et cetera, and actually bring production back to the United States, it becomes very difficult to do so. I will just say the corporate speak for tariffs are hurting consumer sentiment is quite amazing. You indicated what it was, and that seems to be what we're going to hear. The macroeconomic environment that is dynamic is what's causing people to maybe pull back just a little bit. You're starting to hear CEOs directly address the elephant in the room.
They're talking about Trump without actually naming Trump, but they're talking about his policies and the impact the policies are going to have. And as we head towards April 2nd, Liberation Day, as the president likes to call it, there are a number of questions that remain to be seen, but already we're seeing play out in corporate America, most notably when it comes to these consumers. And clearly, I think that Wall Street Journal report shows that this administration actually understands that consumers may get that inflation spike, even if it's a one hit, because of the tariffs.
We've seen it several times through the week that this administration is increasingly sensitive to that story. This market is too. At 8:30 Eastern Time, another read on inflation. Then later on this morning, Lisa, another read on consumer sentiment.
Does the University of Michigan sentiment survey matter? At a certain point, you can make that debate into your rallying cry around whatever partisan group that you want. The more important thing to me is if you take a look at inflation expectations in the market, they are creeping higher. For the next 2 years, inflation expectations have risen to the highest level since March of 2023. Over the next 10 years, you're looking at an average market implied inflation rate of 2.4%. Not catastrophic, but it's not exactly the 2% the Fed's looking for. And if you take a look at what people are pricing in and what Fed officials are saying, there is a lot of skepticism, as we were talking yesterday, about just how transitory some of these inflationary headwinds really are going to be.
Gold this morning, all-time highs. Equities this morning, negative by 0.2% on the S&P. Coming up this hour, Victoria Fernandez across mark with stocks on a two-day losing streak. Brian Gardner of Stifel as the Doge team plans $1 trillion in cuts. And Angelo Zeno of CFRA as CoreWeave downsizes its IPO. We begin this hour with stocks steady ahead of fresh inflation data at 8:30 Eastern Time. Victoria Fernandez across mark writing, we have witnessed a definite shift from the animal spirits driving markets to a new all-time high just a few weeks ago to now an increased probability of recession becoming the topic of conversation. Victoria joins us now for more. Victoria, welcome back. A week away from Liberation Day, early next week, that's going to be the big focus for this market. It feels like you've changed your view on things. What's changed?
Well, I think it's actually kind of what you guys were talking about. It's that sentiment of the consumer. When we look over the past year, we kept saying there's so many red flags that tell us we should be in a pullback, we should be in a recession, but the consumer was always there. We talk about a Fed put or a Trump put, but really it was the consumer put for the longest period of time. That's what has changed now. We see the consumer, and you guys have already talked about it this morning, all those companies coming out on their earnings, on their conference calls, talking about the concern that they're seeing, Lululemon being the latest example. I mean, I thought my kids alone would help support the numbers at Lululemon with their purchases, but apparently it is not enough. And the consumers are starting to pull back, and you get in that negative feedback loop. As the consumers start to pull back, revenues come down, margins start to get affected. What happens 9 months after margins get affected? Companies start laying off. And we've seen that with the Challenger layoffs in the last month. And so I think it's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
How much is this company's kitchen sinking it, though? You mentioned Lululemon, and your kids would single-handedly cause this share to go up. But a lot of the kids are actually getting baggy stuff right now, and that was something they addressed, that actually the styles are moving past that sort of trademark legging spandex look. I'm just wondering, how do you parse through how significant the hit is and how big of a slowdown you have to price into market expectations?
Yeah, I mean, it's going to be different for every company. And the companies that have been out there talking about the slowdown have been along a wide range. It's not just apparel, right? We saw Best Buy as one of those. Yes, there was Nike and Lululemon, but you see Walmart, which is a different cohort of a consumer. And I think part of the issue, Lisa, is that it's not just the low-income and middle-income consumer anymore. We've talked for the last year and a half on that high-income consumer really supporting that economy and continuing to spend, even if they shifted their spending habits. They went maybe from a higher element kind of store, now shopping at Walmart. We saw Walmart gain a lot of share, but now they're talking about even the high-end income consumer pulling back. So I think you have to take that longer-term approach and say, as we go through this year and consumers start to pull back as they're worried about their jobs, and we see that in the quits rate coming down, we see it with hiring rates slowing, that's the element you have to look at to determine what does growth look like if that consumer engine is not there driving it.
Peter Cheer earlier told Bloomberg TV that the U.S. is trading trade flows for capital flows, and the rest of the world is going to outperform. Do you look to the rest of the world ahead of Liberation Day because you're really unsure about what is going to happen here in the United States?
Yeah, I think the rest of the world, we've heard from plenty of leaders around the globe talking about the concerns and already trying to make steps beforehand. We've seen it come out of India. We see it come out of some of the European countries where what can we do and before the idea of reciprocal tariffs come to lower that rate? What can we do to help our consumers? We saw inflation this morning out of Europe actually come in lower than expected and ECB rate cuts moving higher. So you have to, look at it and see what are rates going to do between the two. What does it look like on exchange rates? International has done much better because of the concept of growth continuing, especially in Europe, with the steps that Germany is making in defense. But has some of that already run out? Is that already priced in to the European market? So I might wait for a little bit of a pullback on international before putting my toe in the water if I haven't already, and let that consolidate a little bit before going there.
Victoria, this is not the only headwind for markets. In fact, the dominant headwind has been the pain trade, and the pain trade's been tech so far in 2025, stateside. Let's think about the shots that's been fired at tech over the last week or so. Reports that Microsoft is pulling back on data center spending. Alibaba firing shots about overcapacity and bubbles, and then overnight, a heavily downsized IPO from CoreWeave. How constrained is the AI trade at the moment?
Yeah, I mean, no one likes that word bubble, but there is a lot of questions now going into hearing all of the money, the CapEx spends that companies were going to do in regards to AI, seeing some of that pull back. You mentioned Microsoft as a perfect example of it. And what does that mean going forward? I think, look, tech, as we went into this correction, tech had already pulled back. They haven't become leadership during this correction period that we're in. So I don't think we should look to tech to be the leaders coming out of this correction. I think they're going to continue to struggle because of some of the headlines that you've mentioned. Maybe you start to look at some of the secondary companies that will benefit from productivity enhancements from AI, and not necessarily the tech names, the data warehouse components of it that people were really looking at. We've seen utility sector pull back a little bit as well because of the headlines that you're mentioning. So I think we continue to see some struggles in tech, and you're probably going to have to look at places like healthcare, maybe certain types of materials, financials. These are the sectors I think that will lead us coming out of the correction that we're in. That's where you should probably focus.
Can you walk us through how all of these prongs of sentiment hits have translated into your view shift over how you should allocate your assets? And I ask this at a time when gold is at record highs and people aren't sure whether to go into bonds or whether to go into healthcare.
Yeah, well, I mean, look, you're talking to the bond girl here, so I would always recommend having some bonds in your portfolio. But people want to hedge what they're seeing. And when there's concerns around growth, gold is the hedge that people go into. When that's not the concern, when growth is actually looking like it might pick up, then you see people go more into industrial metals or things like copper. Copper's actually down this morning after having a pretty good run. Gold continues to move higher. So you see there's that concern around growth. We look at sentiment, and it's always important to break sentiment down and say what's driving that number. Is it the more volatile component of sentiment that's the expectations part, or is it the present situation that's driving it, that's usually more focused on jobs and fundamentals? We saw both elements come down in the last sentiment number. So there is maybe a little bit of support to that stagflation argument that people are talking about, as we have concerns around the growth component, which supports gold, and still have concerns around inflation and how sticky that's going to be. Obviously, we have PCE later today, but I think you have to look at sentiment and say this feeds into the story of a pullback, of the consumer pulling back, of growth concerns, of GDP concerns, at least in the first half of this year.
Since you're a bond girl, can you really say that bonds are going to have the same kind of buffering effect that they have traditionally at a time where inflation expectations are actually rising?
Yeah, I don't think you're going to go into fixed income right now and say, oh, wow, spreads are going to tighten. I'm going to get, a lot of a price return coming out of that part of the market. I don't think that's what you're going into fixed income for right now. I think you're going into fixed income to lock in some steady cash flow components in your portfolio. Some people may like to do that with dividend payers in the equity market, but that's a little more volatile. If you can lock in some steady cash flow on the short end and the long end of the treasury curve, it gives you a little bit more buffer in your portfolio, as we think we're going to continue to see volatility at least for the next 6 months in the equity side of the market.
Hey, Victoria, appreciate your take on things going into the weekend. Victoria Fernandez at Crossmark, going into a big weekend next week, April 2nd, just around the corner. Lisa mentioned the bond market. Yield to lower this morning by just 2 basis points, still north of 430. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Canadian Prime Minister Mark Carney says his country will fight back against President Trump's trade war. He declined to outline specifics, but did say his government will respond based on what the U.S. does on Wednesday when Trump plans to announce his so-called reciprocal tariffs. Carney said he expects to speak with Trump in the next day or two. Meanwhile, Bloomberg has learned that the U.S. is pushing to control all major future infrastructure and mineral investments in Ukraine. A draft document grants the U.S. first claim on profits transferred into a special reconstruction investment fund. It also requires Kyiv to pay for all U.S. military and economic support since the start of the war. And Elon Musk says he plans to slash $1 trillion in government spending by the end of May. Musk told Fox News he doesn't think the savings will affect critical government services. The Doge website so far lists about $22 billion in contract savings, while claiming $130 billion in unspecified cost reductions. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later on this hour. Up next on the program, the Doge Agenda.
Our goal is to reduce the waste and fraud by $4 billion a day, every day, 7 days a week. And so far, we are succeeding. America will be solvent. The critical programs that people depend upon will work. And it's going to be a fantastic future.
We'll talk about that fantastic future in just a moment. We'll catch up with Brian Gardner of Stifel on the other side from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Two-day losing streak coming into Friday. Equity futures at the moment just a little bit softer, but off session lows. We're down by 0.1% on the S&P. On the Nasdaq 100, softer, negative, down by 0.2%. Under surveillance this morning, the Doge Agenda.
Our goal is to reduce the deficit by $1 trillion. So every day that passes, our goal is to reduce the waste and fraud by $4 billion a day, every day, 7 days a week. And so far, we are succeeding. When we do make mistakes, we correct them quickly, and we move on. America is going to be in much better shape. America will be solvent. The critical programs that people depend upon will work, and it's going to be a fantastic future.
So here's the latest this morning. Elon Musk aiming to cut 15% of government spending by the end of May, amounting to $1 trillion. Musk's Doge team claiming about $130 billion in savings so far, downplaying government layoffs and saying no critical programs will be affected by cuts. Bloomberg's Tyler Kendall joins us now for more from the White House. Now, Tyler, critical programs in the eye of the beholder, I guess, and that's important. What are the views on what's happening with Doge and whether we can, quote, get those critical programs to be dependable for the people of America?
Yeah, good morning, John. Well, it's a pretty ambitious timeline as well as those top line figures that you're talking about. The bulk of government spending is really focused on those mandatory programs such as Medicare and Social Security. Elon Musk trying to reassure the American public that the money that they get in their pockets isn't going to change, but it's hard to see how the figures he is talking about he's going to reach those by just focusing on alleged waste, fraud, and abuse. So big questions there about the actual implementation of what he is going after here. We have to think about the broader government spending conversation, particularly as Congress looks at some of these programs to try to get through their fiscal agenda and that reconciliation package through both chambers. Now, we mentioned the figures, the timeline here, also considered to be pretty ambitious. The end of May, Elon Musk is a special government employee. That means he's only supposed to be on the job for 130 days out of the year. 130 days from the inauguration would bring us to May 30th. That's not to say, though, that he's not going to still be involved or the effort's not going to continue, although Doge is supposed to sunset by July, so another date for your radar. But this really has been billed to us as a whole of government approach. We see Elon Musk, for example, sitting in on those cabinet meetings to get updates from department heads. Of course, John, this all goes into the heightened concerns, too, among federal workers. So spending on one end, but also job cuts on the other. Elon Musk saying that up to this point, quote, almost no one has been fired. We should point out that just yesterday, HHS announced that it was cutting 10,000 jobs, and it's important context to keep in mind. Only about 20% of federal workers are here in the nation's capital. This is going to have some broad-ranging impacts across the country.
Tyler, you mentioned reconciliation. How do the Doge efforts square what they're trying to get done in Congress?
Right. Well, Amory, it's pretty interesting to see how they're both kind of working in tandem here, perhaps, but Congress wants a bigger role. There is reporting that just yesterday, key Senate Republicans met with some top White House officials, including NEC Director Kevin Hassett and the OMB Chair Russ Vought about what's known as a rescission package. This would essentially let Congress codify some of these spending cuts by allowing them to vote to pull back some money that might have been allocated but not appropriated yet. So that's one line that's going here. It remains to be seen if the White House is willing to give Congress that part of this discussion. And then the other end, of course, are the spending cuts. We know yesterday our Bloomberg News reporting that the Senate package is looking at lower minimum spending cuts in order to kind of quell some of the concerns among Republicans about what it could mean for the future of Medicaid. But again, Anne-Marie, bringing up big questions. If there are less spending cuts perhaps on that program, what does that mean for those fiscal hawks that need to see larger spending cuts to make up for some potential impacts to the deficit and raising the debt ceiling?
Hey, Tyler, thank you. More from Tyler later on the program in the next hour to extend the conversation. Brian Gardner of Stifel. Brian, just to pick up on some of this, can Washington agree on which programs are critical?
No, I mean the short answer is no. I mean, critical is in the eye of the beholder. There are definitely members up on Capitol Hill that are going to see most programs as absolutely critical. That you know it's a jurisdictional turf fight battle. So. It gets into the question that you had earlier on the savings of Doge. You know, how big is it? How transparent is it? And how much waste, fraud, and abuse is it? Well, waste, fraud, and abuse is in the eye of the beholder. So critical programs, the same thing, kind of in the eye of the beholder.
When it comes to critical programs, could Republicans meet their goal of cutting $880 billion under the committee of the Commerce Committee in the House without touching Medicare?
The math doesn't work. I mean, if you go through a list of options that various groups can put out, the House Budget Committee had a document out. The Congressional Budget Office has given options over the years. And you look at the jurisdiction that Energy and Commerce has, well, it really is Medicaid. There are not enough programs under its jurisdiction to get to 880. The math just doesn't work. So if you give that committee that target, at the end of the day, it gets to Medicaid. And we can debate, you know, what the value is of Medicaid. Not so much what the value of Medicaid is. Excuse me, that's a poor way to phrase it. but how to make it more efficient, how to get savings out of the program. But 880 is going beyond just waste, fraud, and abuse. That's getting more towards the bone of the actual program, not just the fat around it.
So where do you see Senate Republicans coming up on this issue, given the fact that they're in the midst of writing their bill right now for the budget, and potentially we could see a vote next week?
Yeah, I think they're trying to have it both ways. We're kind of signaling that there may be some flexibility on one side of Capitol Hill, less flexibility on the other side of Capitol Hill. You know, create a budget resolution that's it's somewhat illusory and kicking the major questions down the road to the actual reconciliation bill, at which point members will be jammed to vote for or against the bill that you're going to claim, you know, the leadership is going to claim if you block it, you're blocking the Trump agenda. So I think they're trying to come up with an artful way of you know, splitting the baby in half to give some deference to the House, to recognize that the big issues in the Senate need a different approach. But there are two camps, right? You have the budget hawks, who, you know, want much deeper cuts, Mike Lee, Ted Cruz, and a few others, Rick Scott of Florida. And then Josh Hawley, who, you know, I think most people would view as a conservative, but is, you know, in the populist conservative camp and is expressing a lot of concern over the level of cuts in Medicaid. And so you know, there's going to be an interesting debate next week on the Senate floor. And we'll see if the vote actually happens. I think John Thune is at a point where he's just trying to force senators to decide in order to get to an actual vote. You know, it would not surprise me to see that vote punted.
Brian, how much are Congress members, Republican Congress members, counting on revenues from tariffs and really helping give them an easier time in getting something passed?
I think there's such a lack of transparency and specificity of what those numbers look like. So I think conceptually, Lisa, they're saying, yeah, we're going to have revenue coming in from tariffs. No one can really give a solid number of what those numbers look like, and within the reconciliation package, you're going to have some level of specificity in order to score it. Maybe there's some way to codify these numbers, and so they actually do get some budget savings, and then it's the art of actually writing legislation. But you know, it's such a gray area, and there's so many claims being put out there, you know, on the tens and hundreds of $billions of revenue that are going to be brought in by tariffs. But, you know, we also don't know what the timing of those revenues are. I mean, I think part of the revenue discussion is that the Trump administration is looking to really restructure the American economy. And they believe that there's going to be a massive inflow of capital into the United States and an economic boom that's going to result. Well, those revenues are going to be in the out years, and how that gets scored into a budget reconciliation bill is anybody's guess.
Hey, Brian, good luck to them. As you said, art, not science. Brian Gardner there of Stifel. I don't see how you come up with a number, especially the president said earlier this week that he's willing to negotiate with China, drop the tariffs to grease the wheels for a TikTok acquisition. So how do you come up with a number?
Taking it a step further, how do you come up with a number when the whole goal is to bring production back to the United States, which ostensibly
you don't want them paying the tariffs.
Remove the revenues that would come from some of the tariffs. So this is a very tricky thing, and it raises a question of how much of an offset it is to what the Republicans in House are trying to do.
Got a lot to get through this morning, that's for sure. Equities right now, just about unchanged. Lulu's down by 13% in the pre-market. We'll pick up on those consumer concerns a little bit later. In the next 30 minutes, we'll also be talking about a big downsizing of a big IPO. We'll talk about that in about 20 minutes' time. Up next on the program, Winthin of Brown Brothers Harriman on his outlook for the dollar as tariffs drive huge uncertainty. From New York, this is Bloomberg.
in case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures here slightly softer. We're down by 0.1%, going into the weekend on a 2-day losing streak, but poised for a second week of gains. We'll see if that holds. On the Nasdaq, we're down by 0.2% also. Let's get some morning movers for you. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. A really painful pre-market move when it comes to Lululemon. Down nearly 13%. If this holds, it would be its worst day in about a year. It is about their earnings, a downgraded outlook to come forward, warning on the consumer, saying that the macro uncertainties means that they are tightening their wallets and they are pulling back. Is it about that, or is it about strategy? Lululemon has been falling behind as we change to looser fitting type clothes. They also noted that tariffs, it will slightly impact their margins. Now, speaking of tariffs, we're still looking at the automakers. Ferrari up 1.5%, getting an upgrade from both Kepler and Barclays, saying that they are in a unique position to do okay. And that is basically that they have a luxury customer, that if they do indeed need to raise prices, that they have customers who are being willing to pay up. Now, speaking of that, a really interesting Wall Street Journal story out this morning reporting that earlier in the month, Trump had held a phone call with the U.S. car makers saying, do not raise your prices as a consequence of tariffs or else you will be punished. Now, is that moving GM, or is it just continued dourness over the tariff story? Either way, those shares, John, down again in the pre-market after falling 7% yesterday, down nearly 0.6%.
Hey, Danny, thank you. We'll get to the pricing story a little bit later. My favorite story in the market yesterday, Hertz. Did you see that?
I did. Shares
Stock
surging.
Rocketed on this assumption that this is going to make used cars more expensive, which makes their fleet more valuable.
It wasn't just Hertz. It was all the auto rental cars, because remember, their shares absolutely plummeted when the price of cars was going down and the used car sales market was slowing down. This is just gives you a sense of the market response, regardless of what President Trump is telling car manufacturers to do or not do at their prices.
You know, the surface, things are calm, stable, almost over the past few days. Beneath the surface, we've seen some big moves. On our radar this morning, setting the tone for this market, CoreWeave, raising just $1.5 billion in its IPO. The cloud computing provider cutting back its plan to raise as much as $2.7 billion. The downsized deal reflecting how stock market volatility is hurting demand for IPOs also speaks to the jitters we've seen in this theme so far this year.
Yeah, just to make sure that we understand the context here, more than 3/4 of its revenue last year came from 2 customers, including Microsoft, major hyperscalers. This is a company that has highly leveraged this trend of building out massive data centers for artificial intelligence training, and it is going to be the ultimate litmus test of how much people maybe are getting ahead of their skis in terms of what the pricing is for this. It came in at the very low end. It's being anchored by NVIDIA, and it raises questions about the tenor for other IPOs that could come to the market later this year.
CoreWeave, a customer of NVIDIA.
Exactly.
NVIDIA, an investor in CoreWeave.
Basically, this is just a leveraged aspect of both NVIDIA and the hyperscalers of trying to allow them to have extra capacity capacity without committing to it. So this is what's going on, and right now we're seeing a lack of demand for that.
It's been quite a week and quite a year for this part of the market, hasn't it? Started with the DeepSeek revelations, really upended the equity market. This week alone, Alibaba coming out and warning of overcapacity in a bubble. We saw from TD Cowen, I believe, they warned about Microsoft pulling back from projects in both the United States and in Europe too. This whole sector has been really challenged for the last several months.
And China has piled on, and it's unclear how much is truth and how much is actual innovation that's going to transform the need for a certain level of capacity, and how much is them saying to the U.S., all right, we'll see your tech sector excellence, and we'll raise you innovation that's going to eliminate the need for some of that. Look, there is some kind of truth in between here, and people are trying to find that right price.
Angela Zeno of CFRA joining us in just a moment to talk about that right price. I want to turn to this story. Danny mentioned it, Lulu delivering a disappointing outlook for the year ahead. The CEO pointing to a, quote, cautious consumer. Due to geopolitical uncertainty and high inflation, the company's first quarter revenue outlook also falling short of expectations.
This is just another pile-on of companies that have come out and said the uncertainty among consumers is causing a retrenchment from some of their spending concerns. I love the way that they say it. I mean, the corporate speak, the macroeconomic uncertainties out there are causing a retracement. I mean, look, they're concerned about this. The question I have here is their biggest growth area, China. How do they deal with the fact that China and the U.S. are embroiled in this battle at the same time that's the one pillar of hope right now for this brand?
And when it comes to China and the United States, that trade war can only deepen. It might get worse, the tit for tat. What I thought was so interesting also about Lululemon, they're already seeing the traffic starting in February when really you saw tariff rhetoric start to heat up in Washington. They're seeing the traffic decrease in the United States. That's going to be very challenging as we head towards Liberation Day.
Let's get to Liberation Day and the tariff reaction. They will because they can. Ferrari planning to raise prices for some of its cars in the United States by as much as 10%. It's the first European automaker to update investors in response to President Trump's new auto tariffs. The stock is up this morning by 1.5%, truly priced inelastic. In economics, if you ever get to study it, it's called a Veblen good. Basically, the value of that good goes up as you raise prices. People want more of it. And that's what's going to happen with Ferrari too, you'd imagine.
And here's my violin, and here I'm playing it. And all those people who are paying, $500,000 to buy their Ferraris, at the very least, they're going to have to pay an extra $10K. My question isn't really for the Ferrari owners. It's for the rest of us mortals. And this question of what the average price of cars is, yes, the price and elasticity there is notable. The price elasticity, or the fact that demand will fall off for some of the more sanely priced cars, is going to be a much bigger issue. And that's where the focus really is going to turn.
I like what Bernstein had to say. Actually, if you own a Ferrari, you might welcome these tariffs because it just means the Ferrari you have in your garage is actually going to be worth a lot more now.
It's like Hertz on steroids. Very, very different story. Look, this is a very, very different story. If you think about the environment, I think we have to think about this. How fertile is the environment for runaway inflation? Now, if you talked about that from a labour perspective, people would say the labour market's just not as tight as it was 2 years ago. I think if you think about it from an industry perspective, just consider where this industry has been over the last couple of years. They've had to cut prices. They've had to get people to buy these cars because people aren't willing to come to the lots anymore and pick up an electric F-150 or whatever it might be, the Lightning truck from Ford. That's the issue they've faced at the moment. So if they put prices up, demand's going to drop. And that's the problem for them at the moment. That's the stagflationary theme we've been discussing.
Here's some numbers on that. Right now, the average price of a new car in the United States is $50,000. That's not including interest rates that you would pay if you take out a loan. There are only 20 models right now that are selling for $30,000 or less. And right now, at least half of them will experience a price increase of about $5,000 a piece if those tariff prices are passed along. You start to talk about a lack of ability to buy a new car, which is the reason why those car fleets are going up in terms of valuations for some of those rental cars, and the reason why Donald Trump is telling car manufacturers, don't do it. Question is, who's going to bear the hit, and how is that going to be felt in the economy?
And it was sticky high inflation, softer growth. It's the stagflationary fears that I know a lot of people have got right now. Equity futures on the S&P just a little bit softer, down by not even 0.1%. The FX market in focus with the dollar at risk as Trump tariffs play out. Win Thin of Brown Brothers Harriman saying next week will be key in confirming or denying the end of US exceptionalism and dollar dominance. Win joins us now for more. Win, welcome to the program. What's special about next week, and what are you expecting on April 2nd?
Hey, first of all, thanks for having me. I miss chatting with you guys, and it's always a pleasure to come on the show. Well, it's a big week in many ways. We've talked about so-called Liberation Day with tariffs next Wednesday, but we're also getting a lot of key data for the U.S., ISM, and other jolts, but culminating in the jobs data Friday. And I think it's key because, as you know before, the tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect. And the market's attention goes back and forth. At first, we focused on the inflationary part. Now we're focusing on the stag part as we see business confidence, consumer confidence fall. So it's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. Everyone bullish on U.S. equities, the U.S. dollar, and really we kind of hit a wall. And it's really just due to this policy uncertainty. I'm hoping that perhaps next Wednesday will be the beginning of the end of some uncertainty, but I'm not going to bet the house on it.
Meanwhile, we've seen dollar destruction or value destruction over the past year until recently, when you've seen the dollar strengthen just a bit versus some of its competitors, some of the other G10 currencies. I just wonder, at what point do you see this as a pivot where suddenly people start to think, okay, maybe the U.S. isn't going to be the epicenter of pain for some of these tariffs, but the rest of the world is going to get hit just as hard, and that's going to lead to further dollar strengthening.
Yeah, absolutely, Lisa. Look, if the U.S. goes into recession, the global economy is in trouble. We've been in the global driver of growth for the last several years. Yes, the Eurozone is kind of picking up a little bit. Maybe China has some stimulus up its sleeve, but really the U.S. has been the only game in town. So, if you're in emerging markets, the last thing you want to see is the U.S. go into some sort of downturn. So that's the problem with tariffs. A lot of the policymakers, I believe, in the U.S. are looking at it in a very partial equilibrium kind of view, like, well, we're going to do these tariffs and everything will be hunky-dory. But there's retaliation, there's second-round effects. There's all sorts of distortions and uncertainty being introduced that I think once you let the genie out of the bottle, it's very hard to get back in. So I think that's why markets are so nervous right now across all markets, fixed income, equities, FX. Markets hate uncertainty, and yet we are right deep in it. As Fed President Barkin said yesterday, we're in this deep fog. Pull over to the side of the road and put your blinkers on kind of uncertainty. And I totally agree with that.
I love it. It's a deep fog, put the blinkers on, pull over, and people come to you and say, what do I do? What do you tell them?
Well, look, it is interesting. The Fed is sort of in that same fog as we are. I'm trying to look through the noise. The tariffs are certainly a big spanner in the works. I think a long-term view, which is for FX markets, maybe a couple of months, longer-term view in a couple of years, I would say. I think the U.S. dominance is still there in the sense that the innovation is here, the AI, all the sort of things that you want are still here. So looking through the noise, I still remain positive on the U.S. economy. But I have to be honest, this is probably the most nervous I've been about the U.S. outlook in a good year plus. And again, it's all policy related. It's just this uncertainty. No one likes this.
Even more nervous about the outlook than we saw during COVID?
Well, okay. Well, that's COVID is obviously
a lot of surveys, people are saying that. That's why I'm keen to get your view.
Yeah, I know you're right. Some of the confidence surveys are back to the COVID lows. Look, right now we've been fortunate that the hard year has not quite reflected this huge drop off in sentiment. And that's always the question: are people really going to pull back all their spending? Are they going to delay it? Or eliminate it altogether? That's the big question. And the retail sales in January and February were a little bit soft than expected. Part of it could be weather related. Again, this goes back to that fog. We had the cold weather, we had the wildfires, all that. So again, I'm going to go back to Mr. Bostic of Atlanta Fed. He said, look, this uncertainty, I may not know until late spring, early summer. And again, that's for the market, that's an eternity. So a lot can happen in weeks, but in the next couple of months, I think we'll have a better idea of really how the U.S. economy is faring with this. The only good news I have is that we went into this, with a lot of momentum. We're at full employment, inflation is elevated but coming down. So we're in a strong position, but it's really a tricky time right now for investors and households and firms.
Each week feels like an eternity, Win. You know that. It's good to catch up with you. Good to see you. Win Thin there of Brown Brothers Harriman. The summer feels like an eternity away. We've got to get to April 2nd first. We've been building up to April 2nd now for what feels like months.
And we can keep building up, and we'll build up afterwards to May 15th or whatever the end date's going to be, because we're not going to get much clarity. Tom Barkin yesterday of Richmond Fed coming out, and we were talking about that with Win, saying the policy changes have created, a quote, a sense of instability in the business community. This has something that a lot of people have gained attention from. It is the uncertainty alone that is starting to cause some, maybe not permanent damage, but real question marks around how long this can go on.
Consumer-facing companies are telling you it's not great. rate, several of them, and we heard from another one, Lululemon, in the last 24 hours. The sentiment survey data is telling you things are terrible at the moment, but the hard data, payrolls next week. I don't think you can overstate the importance of the hard data from the labour market through next week. It's not just about April 2nd.
The hard data lags behind the soft data by about 3 to 6 months. So people can keep pointing to that as, look, everything is just fine. And people who track the data will say, really, we have no way of knowing that. So that's kind of where we are.
That's what the Fed chair's doing, isn't it?
Pretty much.
Everything's all right.
Everything's
still
all
look
right.
healthy. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Herkes. Hey, Yahara.
Hi, John. U.S. Attorney General Pam Bondi is suggesting she won't seek an investigation into the Signal group chat that saw Trump administration officials reveal sensitive military plans to a journalist. Bondi says the episode was a mistake, but no classified information was discussed. She added the mission was successful, making the world safer. Meanwhile, the Wall Street Journal reporting President Trump in a call this month warned auto executives against passing on costs to consumers. That was ahead of his announcement. A 25% tariff will be placed on all imported vehicles and parts starting April 2nd. Trump reportedly told them they should be grateful for his elimination of President Biden's EV mandate. And President Trump is withdrawing Representative Elise Stefanik's nomination to serve as the U.S. ambassador to the United Nations. In a Truth Social post, Trump said, with a very tight majority, I don't want to take a chance on anyone else running for Elise's seat, adding there are others that can do a good job at the UN. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara later. Maybe it was hubris, overexcitement in the immediate aftermath of the election, but I think we're all surprised about that pick to begin with.
I think a lot of people are surprised it took them this long to realize there's another Republican in the House. They cannot lose if they want to get their agenda across the finish line.
We'll catch up with Congressman French Hill about that agenda in the next hour. Up next on the program, big tech under pressure.
Markets are down. It's not just a rotation underneath the surface. If you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got, kind of a perfect storm or an imperfect storm.
We'll catch up with Angelo Zeno about that imperfect storm. He joins us from CFRA in just a moment. From New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never.
Go.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Going into the weekend with equities just about unchanged on the S&P 500, the Nasdaq down by 0.1%. The Nasdaq 100 still off the highs, down by more than 11%, or around 11% from the highs of the year on the Nasdaq 100. Haven't recovered at all, really, for that index. Under surveillance this morning, big tech under pressure.
Markets are down. It's not just a rotation underneath the surface. If you layer on the positioning, the DeepSeek news, and the valuation where it was, you just kind of got, you know, kind of a perfect storm or an imperfect storm. What equities want is certainty, even if it's bad certainty.
So here's the latest this morning. Concerns over AI demand evaluations for big tech weighing on the most anticipated IPO so far this year. NVIDIA-backed CoreWeave raising $1.5 billion with a starting share price of 40. The firm initially seeking to raise as much as $2.7 billion ahead of its first day of trading later on today. Angelo Zeno of CFRA joins us now for more. Angelo, welcome to the program. What kind of signal do you take from this heavily discounted IPO?
Well, you know, first off, thanks for having me. But when we kind of look at this, I mean, we're not necessarily surprised by the discount here. And I don't think most in the market are necessarily surprised kind of in light of recent events and what we've seen over the last couple of weeks from just overall sentiment on the tech side of things, just, you know, really kind of going sour. Overall, you've got these tariff macro issues out there and the implications that they're having on, you know, tech. You've got these, you know, obviously the DeepSeek concerns out there and the implications on the tech side of things there. I think also as far as CoreWeave is concerned specifically, when you kind of look at that business model and kind of, you know, how they handle the financing side of things, kind of being more of this kind of GPU infrastructure-backed lending type of company, I think that's a business model that really doesn't kind of, you know, bode well with a lot of investors out there, especially amidst a period where kind of we've got a risk-off trade for AI right now.
It's a huge risk-off trade and has been ever since the DeepSeek revelations, Angelo, so let's build on that. It's not just that. Alibaba out this week, the chairman came out and said maybe there's some overcapacity, perhaps even a bubble. Then we had a report from TD Cowen that suggested Microsoft was pulling back from projects in both the United States and in Europe too. It's a question we asked earlier this hour, Angelo. Just how constrained is this trade at the moment?
Listen, I think when you kind of look at the sentiment out there, I mean, it's pretty negative. I mean, we kind of look at the hyperscalers out there from the likes of Microsoft, Oracle, Meta's out there declining anywhere from 15 to 25%. When you kind of look at the AI semi names out there, they've kind of declined more notably, kind of in the 25 to 50% range out there. So a lot of kind of the uncertainty out there, whether it's kind of what you alluded to as far as the Microsoft situation is concerned. And I think that'll be the most important event this earnings season is that earnings call from Microsoft. We really need to hear from them, find out exactly what their intent out there is. I mean, our view is it partly has to do with that OpenAI relationship, as well as the fact that, hey, listen, maybe and they clearly articulated the fact that they are going to shift more towards their server side of things and less towards the infrastructure side of things, which we think makes a lot of sense. We do like the Microsoft trade at this point in time, given the pullback. But there's a lot of uncertainty as far as all that is concerned out there. We think a little bit kind of to an extreme, and we do think a lot of those valuations are kind of baking some of that stuff into it.
To build on that, I'm kind of whipsawed here because it was just a couple months ago that we had people on here who are saying that truly these hyperscalers can't invest enough in infrastructure and that frankly the energy system and the infrastructure currently out there is nowhere near what's necessary for the AI build out as people imagine it. So which is it? How do you understand how much what we're hearing from China is fact versus fiction in terms of just how much technological advances transforms that story?
Yeah, no, I think that's a great question. And I don't know if there's an actual way to answer that, to be honest with you. But when we kind of look at it, right, I think DeepSeek did change things more than people kind of want to acknowledge out there. I think you kind of take a look at China, look at the efficiencies that they've kind of accomplished on their end of things. And then you kind of look at what's happening in the U.S. And I think kind of that's the bigger issue out there, because if you kind of look at the pace that these kind of hyperscalers are investing at, and now at a point in time, right, where we do have these tariff concerns out there, we do have those growth concerns out there, at a point where we could potentially see some pressures on the top line, whether it be, come from some deceleration on the cloud side of things, whether it be, some challenges on the digital ad side of things. That puts pressure kind of on these hyperscalers out there, not to mention these tariffs out there also increase the cost of kind of installing these servers out there. So these hyperscalers are going to have to, look to be a little bit more efficient in nature. And in many cases, what we've seen here over the last couple of months is really going to force them to do that.
Is CoreWeave a litmus test for other potential companies that want to IPO this year in the tech space? Or is it idiosyncratic, and I hate to use that word, but special because of its connection, particularly to some of these areas that are part of the peak uncertainty?
Yeah, I mean, we personally wouldn't be using them as a benchmark for other potential tech IPOs and other IPOs in the market out there. Again, this isn't the name that we would potentially or would like to see as kind of that first name being thrown out there in this tech IPO market, kind of, since the Trump administration has taken over. But that said, this is what we've got out there. It is going to be somewhat of a test out there. We'll see what the sentiment looks like. But in our view, no, it shouldn't kind of be used as kind of this test longer term or over the next 9 to 12 months in terms of, what the sentiment looks like for tech longer term.
So, Angelo, for you right now, top pick, what is it?
It's a great question. I mean, we've told investors over the last couple of months to continue to shift towards software over semiconductors. Now, we'd acknowledge that neither side have really kind of worked that well, but we'd say the lesser of both evils right now is still on the software side of things. We remain believers kind of on the side of things where you are going to see more M&A on that side of things. We also believe that kind of the fundamentals are also going to hold up better on the software side of things. And for us, a name like Microsoft at these levels is a name that I feel pretty confident recommending to investors. I think Salesforce is another name which has seen a notable pullback as well, which is a name you can kind of be looking at these levels.
Angelo, appreciate the input. As always, thank you, sir. Have a good weekend. Angelo Zeno there of CFRA. Hardware's had a tough run. Let's take the NASDAQ, for instance. I mentioned it was down close to 11% from the highs of the year. We're down more than 25% on NVIDIA still from the highs for 25.
Microsoft down more than 7%, even though its revenues are something of a small country. So at a certain point, you have to wonder, do you just go back to the names that people love and have owned, or do you start to invest in some of these upstarts that have a lot of potential question marks hanging around them?
We'll see how that trades a little bit later. Equity futures right now on the NASDAQ at least down by 0.25%. The S&P 500 just a touch softer. No real drama. In the second hour of Bloomberg Surveillance, your lineup looks like this. Bruce Kasman of JP Morgan, Michael Azizas of Morgan Stanley, Congressman French Hill of Arkansas, and Earl Davis of BMO from New York City. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative for us as a business.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
What equities want is certainty, even if it's bad certainty.
The difference between uncertainty and volatility is that volatility can be priced while uncertainty can't.
You can plan for risk, but you can't plan for uncertainty.
Doesn't feel like Liberation Day is going to be Clarity Day, and so I think a week from now we're still going to have a lot of questions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's check out your scores. Equity futures just about unchanged on the S&P 500. On the Nasdaq, softer by 0.2%. We'll talk about a very disappointing CoreWeave IPO later on in the program. Outside of that, we need to talk about a very disappointing outlook from Lulu. That stock is down and down hard in the pre-market. Another consumer-facing company takes a hit from a falling consumer sentiment read in the United States of America. That just continues. We'll get another read on that later on this morning when we get consumer sentiment from the University of Michigan. What are they worried about? Higher prices. Core PCE later this morning.
And let's see how much people start to consider the University of Michigan some sort of leading indicator once again after Fed Chair Jay Powell dismissed it. Look, what we're hearing from companies, and you mentioned Lulu, and arguably earnings season this time around will be more important than the soft data and the hard data, because what we hear from corporate executives might be the cleaner read, frankly, on the quickly moving consumer appetite. What we heard were these scathing comments from the CEO. We are operating within a dynamic macro environment that's really contributed to a cautious consumer, where we've seen a material impact to traffic across the industry. Look, they are seeing U.S. consumers pull back. They are seeing consumers elsewhere not have the same kind of trend, and they are concerned.
Are you suggesting they're worried about telling the White House how it is directly?
Well, how else can you interpret that? I mean, these words are not English. They are corporate speak. They are another brand offshoot of English, a way of saying there is a real concern about tariffs and people aren't shopping as a result. But that's the way it comes across.
You know how this works. You put all your complaints into the computer, spits it through one of those McKinsey chatbots, and you end up with what Lisa talked about.
Because you want benign language, maybe some corporate jargon, because you don't want to really go after what's actually going on to not have the ire of the President of the United States, who I think the Wall Street Journal reporting today on the front page shows that this White House is acknowledging that tariffs might mean prices are going to rise, because apparently when this phone call with auto executives, the president said don't raise your prices when I announce my auto tariffs.
Don't raise prices. They're not in a great position to raise prices, and I think that's the problem at the moment for some of those automakers. If they have to take it on margin, they're not in a position to expand either. They're between a rock and a hard place.
Which is the reason why Dan Ives came out and said this is absolutely catastrophic for the auto industry. A lot of people would agree. Yesterday, it seemed like this market was slow to come around to just potentially how damaging some of these tariffs could be. Initially, the losses weren't that significant. As the day went on, I believe GM was down by more than 7% just on the day alone. People trying to understand, how do they get out from around this at a time when the president is saying, this is it. These are permanent. 100%, these are not going away.
People are like, are they? We'll see you April 2nd. We'll see you in a month from now. We'll see how permanent they actually might be.
Dan, I've said the same thing.
Jim Reed of Deutsche Bank had this quote: the more you listen to the current U.S. administration, the more you appreciate that they are prepared to sacrifice near-term market performance and economic growth if it's required to meet their longer-term objectives, which I think says to me, at least at Deutsche Bank, they're taking this for what he's saying. These tariffs are real.
It's the market. More economic data coming up later on this morning. Coming up this hour, Bruce Kasman of JP Morgan as trade concern continues to weigh on markets. Mike Zezas of Morgan Stanley as Canada vows to retaliate against Trump's tariffs. And Congressman French Hill as Republicans work to pass Trump's tax agenda. We begin this hour with stock steady. Investors counting down to core PCE at 8:30 Eastern. Bruce Kasman and the team at JP Morgan raising their recession forecast to 40%, writing rising concerns about a trade war are combining with elevated U.S. policy uncertainty to weigh on sentiment. Bruce joins us now for more. Bruce, welcome to the program. It's a change for you and the team. It's not 0, it's now 40. When does it become the base case, Bruce? What do you need to see?
Well, we'll reassess next week, and I think the other thing here is to realize that what we're getting is a drag coming from tariffs, a drag coming from immigration, a drag coming on the fiscal side, which are bigger than we anticipated at the start of the year. But those are not drags which we would think fundamentally threaten a healthy economic expansion, which is the way we would describe the U.S. I think it's these magnifying effects, and I think there are 3 of them that are quite important here. One, and perhaps most importantly, does the market, does the business sector shift its view to this being a business-unfriendly administration, at least in terms of near-term growth and performance? That could deliver a very big drop in sentiment. We've seen sentiment start to slide. I don't know how far that's going to go. The second point is the consumer. We know we're going to get hit by higher inflation here. It's going to eat heavily into income gains in the next 3 to 6 months. Consumer can cushion it. It may not want to cushion it in the environment of the uncertainties and concern about inflation. And then finally, the way you're implementing policies here are particularly disruptive for North American sectors on the immigration, on the tariff side, and other ways. And I think you have the risk that there's more disruption in the U.S. economy. So we think the risk of a recession is high. It's a fluid situation. We're going to adjust it on policy. And I think it's these soft issues around sentiment, around disruption, around consumers cushioning purchasing power that are probably going to be more important here than the actual size of the tariffs we see and hear next week.
Bruce, coming into 25, you said the big risk was countries retaliating disproportionately. Do you still see that as the big risk?
No, we came into this year, I just want to emphasize, saying the risk was sentiment. The title of our year ahead outlook is in a sentimental mood. But having said that, I do think you're right that there is going to be more retaliation and more targeted retaliation that can both increase the drag on the U.S. and the potential for disruptions. And I don't think we should underestimate what happens next week if we get broad-based tariff increases on the rest of the world.
When do you expect, Bruce, to see this in the data? What data is the most important to watch at a time where ostensibly we're all data dependent and yet pushing off all the data is not yet really tracking the current circumstance?
Well, the data is kind of funky right now because we're tracking a 0 or so on U.S. first quarter GDP, but without going into the details, I think that's a very misleading signal about where underlying growth is. We're also getting a front loading in global industry as producers, particularly coming out of Asia, are sending goods to the U.S. market. U.S. goods are shifting out in anticipation of tariffs. So there's a lot of difficulty in reading the data. I would emphasize the interaction here between what we get in terms of business behavior, household sentiment, and what we see in the labor market. In the end of the day, recessions are about labor market breaks. When you break down and you get private payroll growth sliding well below 100,000 a month, that's a signal we're in trouble. We don't think this is going to happen in the next few months. We don't think it's going to happen in next week's payroll report. But that's the heightened risk around where we might be as we move through the middle part of the year and later on.
Yeah, but Bruce, isn't the employment market a lagging indicator? Doesn't it usually crack well after the seeds of some sort of recession get sown?
No, I think employment is coincident. I think there are indicators of employment that may be lagging, including the job number. I think you pay attention to layoffs, you pay attention to surveys. But I think the labor market moves coincidentally with the economy. When the economy breaks, the labor market is breaking.
Bruce, what would you make if actually all of this uncertainty ended up being better deals for U.S. companies? The UK government right now trying to negotiate exemptions. Maybe they'll get some. India right now is looking at U.S. demands to cut the levies of imports of goods like agricultural products. What if this ends up with better trade deals?
Well, I think that comes back to my basic hypothesis, which is the call here is whether what's being implemented here, what's being discussed going forward, is designed to provide a support for the U.S. business sector, not over a 5 or 10 year horizon, but over a 6 to 18 month horizon. And I think your point is right, and it's one of the reasons we're not over 50% right now. It's still not clear how this is playing out in terms of the way tariffs are going to be applied. I felt coming into the new year that was a reasonable baseline to have. After we put tariffs on Canada and Mexico for 1 day, even though we took it off, and some of the other things we've been seeing on tariff and other policies, I'm no longer comfortable taking that view. You may be right. We haven't gone all the way to a recession call, but I don't feel confident that that's the way this is going to play out.
Of course, we're also waiting for the other pillars of the Trump agenda, which is more deregulation and the extension of tax cut, the TCJA, and maybe even more tax cuts. By the end of the year, if you have the composition of all these policies, do you think you're going to be over 50% or under 50% when you have recession risks?
Well, we're at 40% right now, which is to say we don't think we're going to get the magnification through sentiment. And part of it is what you're suggesting is that we extend TCJA, that the regulatory arrow is moving to reduce the burden. The question is whether that is going to balance what we see elsewhere here. I would just note that the fiscal debate should be understood right now to be tightening on the spending side. State and local is an important part of that. And TCJA extension, while it's a positive in the sense of not letting the tax cuts expire, doesn't add to demand in the economy. It's just an extension of current policies.
Bruce, what could you hear next week that makes you think that the market is truly shifting its view to look at this administration as business unfriendly, not business friendly?
Well, I think what we would be looking at in a constructive way would be limited retaliated tariffs and a focus on pretty much narrow sectoral tariffs, as we saw with the auto announcement yesterday. So if we see autos, pharmaceuticals, perhaps, as you were pointing out a couple of minutes ago, efforts on the retaliatory side to open up other markets to U.S. goods, I think that would be the comforting message. I think a broad-based tariff increase, a step towards having an outright trade war with the EU, those are the kind of things that would be worrisome. And of course, there's the question of whether or not we're kind of closing the door of this chapter of the tariff story, or whether we're simply kind of moving incrementally down the road towards a broader trade war.
Bruce, just to wrap things up, to finish on inflation, I'd love your view on where the labour market is. Do you believe it's tight enough to worry about second-round effects from the inflationary impact of tariffs?
I don't think the economy is positioned for 2% inflation, independent of what's been happening on policy here. I don't think the labor market is super tight, but I think the combination of the starting point on where labor costs are, where psychology is, and where labor demand is moving, of course, towards a weaker labor supply story as immigration cools. I don't think that, and incorporating what's happening globally in manufacturing and supply chains, is set to deliver inflation moving down to 2%. I think what we're getting now is a shock coming from tariffs that's going to raise the run rate on U.S. inflation probably above 4% for 3 or 6 months. That's going to make it almost impossible for the Fed to think about a preemptive easing. You're going to need to see the break in the labor market to get the Fed to ease. And that, of course, would be a concern, because it would mean that the economy could already be sliding into recession.
That's the problem. Bruce, it's got to catch up to get your thoughts. Appreciate your time. As always, Bruce Kasman there of JP Morgan. That right there would be a big problem for the Federal Reserve.
4% going out for the next 3 to 6 months. I will say the market is really pricing this in. If you take a look at two-year break-even rates, the market implied inflation expectation of the next 2 years, it averages 3.3%. We are looking at, if you round up, that is the highest level going back 2 years. A lot of people are getting on board with that type of view.
Gold, record high again. We talked about it a few times already this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Lululemon shares are plunging more than 12% in the pre-market after the retailer delivered a disappointing outlook for the year. The CEO citing a cautious consumer due to geopolitical uncertainty and high inflation, joining a growing list of companies sounding the alarm on the consumer. Meanwhile, U.S. Secretary of State Marco Rubio says the Trump administration has so far revoked over 300 visas as it pushes to expel foreign citizens who protested against Israel. Among them are several international students who expressed support for Palestine. Their lawyers say the actions violate constitutional rights to free speech and due process. And King Charles was briefly hospitalized after suffering side effects from his cancer treatment. That's according to Buckingham Palace. The symptoms led to the 76-year-old to cancel arrangements to meet ambassadors in Birmingham. He has since returned to his official duties at his residence and was said to be feeling better. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, retaliation.
We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada.
That conversation up next. Mike Zezas of Morgan Stanley joins us on the other side. Live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
A lot has been thrown at this equity market. We've had downgrades from Citi and HSBC, price target cuts on the S&P from Goldman, RBC and Barclays, and we're down again this morning by 0.1% on the S&P. On the Nasdaq 100, we're softer by 1/3 of 1%. Under surveillance this morning, retaliation.
We will fight the U.S. tariffs with retaliatory trade actions of our own that will have maximum impact in the United States and minimum impacts here in Canada. We will protect our workers and our industries during this difficult period.
So here's the latest this morning. Canadian Prime Minister Mark Carney vowing to retaliate against US tariffs. Carney telling reporters he and President Trump could speak as soon as today. Tyler Kendall joins us now for more from the White House. Tyler, are those two actually going to be speaking, and what about?
Well, John, maybe we'll get more of a readout on exactly what the agenda item will be, but it's definitely going to be about the future of tariff negotiations. This is going to be the first call between the two leaders since Mark Carney was sworn in as Prime Minister on March 14th amid what has been escalating rhetoric between the two leaders. And we have to keep in mind, Mark Carney really campaigned on countering President Trump. During his acceptance speech, he said that Canada was experiencing dark days brought on by a country they can no longer trust. He did appear to address those comments yesterday to reporters, saying that he does think that trust can be restored through what he called comprehensive negotiations, but that he doesn't think the relationship will ever get back to exactly what it was there. So still some, big questions going into this when it comes to Canada's retaliation to those reciprocal tariff plans. Carney did say that Ottawa is going to wait and hold off until they see the more comprehensive approach here that's tracking with what we're hearing from other allies, such as the European Union, which at this point has some fiery rhetoric, but is saying that it's still just too much uncertainty to know exactly how to respond. John, we did get a little bit of a preview, at least, to what to expect. Canada, under Justin Trudeau, had said that it was preparing retaliation to target Republican exports from Republican-held states moving forward.
Tyler, what's the sense of where negotiations are with all of these countries in terms of trying to get last-minute deals with the White House?
Right. Well, Amory, Bloomberg News actually had some pretty remarkable reporting after the EU trade chief was here in Washington earlier this week that said that the sense from EU officials was that they walked away from the conversation with senior administration officials that this White House didn't really want to negotiate until April 2nd had actually rolled around. And perhaps that's why we're seeing, even as some public concessions come forward, such as dropping tariffs on industrial goods or boosting U.S. LNG exports, we haven't really seen any tangible progress when it comes to what President Trump is going to end up putting on these countries come April 2nd. Now, President Trump this week did say that he plans to be fair and nice. He thinks a lot of people are going to be surprised by what he ends up implementing next week, but that really remains to be seen, particularly as we see some of these sector-specific tariffs, like the auto tariffs yesterday, really mark a real escalation in what has been this administration's approach.
Big time. Tyler, thank you. Tyler Kendall, down in the nation's capital in Washington, D.C. With us now, Michael Zezas of Morgan Stanley for an almost impossible conversation. Michael, good morning to you.
Hey, good morning.
Let's start with an almost impossible question. What are you expecting next week on April 2nd?
I'm not expecting a lot of clarity. I mean, I think really there's kind of two core questions to answer, or at least high-level questions. It's like, how much information are we actually going to get on April 2nd, and what level of kind of uncertainty comes with the answers to those questions, right? So on the one hand, if we were able to get some information that says, hey, here we're going to do reciprocal tariffs, here's the tariff differential we're applying to all different products across all different geographies, then that would be high level of certainty. And if it were just focused on the tariff differentials, not the VATs, not the non-tariff barriers, something that Trump's kind of hinted at, that's something that the market could probably latch onto in a positive way. Our economists have done work around that and said, hey, maybe this is actually, we're already at marked growth down substantially, but maybe this isn't that bad on top of that. If we get something that is a lot vaguer and sort of bigger in terms of big sort of product-specific tariffs, that's the scenario where we think you might have to start pricing in more significant growth downside into risk markets.
Tyler brought up a good point, which is that the Europeans came for a meeting and they were basically told, actually, let's start negotiations next week on April 2nd.
Yeah.
So is April 2nd actually, not to your point, you don't expect clarity. If it's the start of negotiations, how long is it going to take?
Yeah, I mean, that's part of the problem. Like, I think what we have seen with Mexico and Canada so far is potentially a preview of what now happens on a kind of much wider playing field with a much broader range of trading partners, right? So if you start from this, what might be a bit of a maximalist position, and then you have to kind of work back from there because you're putting other things on the table like exports, defense spending, and everything else, it could just be a long time before you kind of understand where the U.S. is willing to settle. And I think that uncertainty, there's already some of it baked into the market, but extending it further, obviously, this is part of the execution risk we talk about, whether or not you think the goals of what the administration is trying to achieve are kind of good goals or bad goals. There's a cost along the way, and there's execution risk that comes along with it, including the retaliation that we were just talking about. And we're going to just have to like live through that, I think, for an extended period of time.
But that execution risk, at least I've spoken to trade negotiators in the past, say that gives them a tremendous amount of leverage with other nations at the table.
Yeah.
We do know Trump wants auto tariffs. At the same time, he doesn't want autos to pass on the cost of said tariffs, according to the Wall Street Journal.
Yeah.
Do you think there's going to be carve-outs for the autos, especially those that are operating under USMCA?
It's possible. You're already starting to see them, as they're getting into the details, explore this a little bit, particularly with the country of origin rules around the different equipment that actually goes in the cars. So, yeah, I think carve-outs are entirely possible, and that is generally the history. You apply a tariff, and then there are lots of exemptions that can come into play after that. The specific nature of them and how quickly that comes about and how quickly you get that clarity, I don't know. I think that all takes time.
So if you said that there's an implementation cost, what I'm trying to game out is, if we don't get clarity next week, is that a sell sign to you for risk assets? Is that sort of going back to what we just heard from Bruce Kasman, the sense that maybe this is a business unfriendly administration?
Yeah, I think the context around that lack of clarity matters. If it's lack of clarity paired with really strong rhetoric around, hey, we're going to do tariffs with, you know, like double-digit numbers kind of across the board, focused on some really important products, that's the type of thing that might cause investors to have to say, okay, we really have to think about the growth outlook picture differently. If the lack of clarity is kind of what we have right now, which is, well, we might be lenient and we're going to still focus on reciprocal and we're going to start here and have a discussion, we might be able to kind of extend this sentiment of, well, this is just a negotiation. We don't know exactly how bad it's going to be. Let's just kind of keep having to like parse headlines and figure out what the heck is going on over the next few weeks.
How much time do you spend trying to understand the tariff headlines versus trying to understand the budget negotiations?
Well, I mean, a lot more in the tariff headlines right now because that's what clients are asking us about. The budget negotiations are extremely complicated, but I actually find them, because they're slower moving and because there are clear parameters around budget reconciliation, kind of much easier to work with, though the degree of difficulty is pretty high on both, in my view.
What's your timeline for the tax
budget? It's still end of year. We practice, so they're moving closer to kind of getting this budget resolution done. But even today, there was reporting that says, well, the way they're going to have to kind of hack it together for the Republicans in the House and the Senate to work is they're going to have different cost-cutting targets that are like literally $1 trillion away from each other. And so at some point, they're still going to have to, amongst themselves, have this battle about, are they actually willing to cut all of this entitlement spending or not? We think ultimately they won't be, but that they're just delaying that really tough discussion. The closer they get it to the deadline at the end of the year, the more likely that discussion is able to be productive because you've got the pressure of that deadline forcing compromise.
Well, what about the debt ceiling, though? Isn't that supposed to be the pressure point to get it done before September?
Yeah, I think that's a fair point, but there's always ways you could deal with it outside of that whole process. And so ultimately, our expectation is that they actually end up having to deal with it outside of that process.
You excited for next week?
Yeah.
Big day.
Sure thing, yeah.
Michael Stevenson, Morgan Stanley. I think we all are. April 2nd. Been waiting for this for a while, haven't we?
Absolutely. We've been waiting for it. I think I have been waiting for it since Donald Trump was announced the winner. When many people were talking about it's going to be tax cuts, deregulation, Trump trade. Well, the only thing he can do on his own is tariffs, and that might come first.
Liberation Day just around the corner, Bramo.
Okay. I mean, look, I think the problem is for a lot of people, they want to understand, just to Michael's point, what certainty can we ascribe to some of these tariff proposals? And if you cannot ascribe some certainty to what that structure is going to look like, what does that do to confidence that already has taken a hit from the lack of clarity, cloudy skies, in a dark room with a blindfold? And
complex macro environment.
Uncertainty.
What do they say? Macrodynamics.
Yeah, macrodynamics are complicated.
Holding back footfall.
Yeah.
Yeah, all of that stuff. Michael, thank you. It's good to see you.
Thank you.
As always, thank you. Up next on the program, Congressman French Hill of Arkansas, as Republicans work to pass President Trump's tax agenda.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Equities in a moment, negative by 0.1% on the S&P 500. 2 days of losses and just a little bit softer this morning on the Nasdaq 100. We are lower by 1/3%. With 2 hours until the cash open, here are your morning calls, your morning movers with Danny Berger. Hey, Danny.
Hey, John. Lulu continues to be one of the big underperformers this morning. In the pre-market session, down 12.33%, downgrading their outlook for the year. The CEO specifically pointed to consumers, noting the list of companies that say macro uncertainties are pinching them. They also pointed to tariffs, saying that it will have some margin impact for them. So that's Lulu. But to the upside, related to tariffs as well, is Ferrari. We learned that they were going to be able to raise prices by about 10% for their U.S. cars. Both Kepler and Barclays upgrading them, saying that they are in a rare position to be able to stay afloat and thrive under tariffs because of their customer base. So those shares up nearly 2%. Rounding things off this morning with some deal news, the deal that will not go away between U.S. Steel and Nippon Steel. Semaphore reporting that the talks have been revived. This time it is Nippon Steel going to the U.S. government, offering a bigger investment from $2.7 billion to as much as $7 billion. So there's some hope that this deal might actually happen, and because of that, U.S. Steel up nearly 5%, John.
Danny, thank you. Appreciate the update. Lisa, not impressed by that Ferrari news at all.
Oh, come on.
Customer base can just give a blank check.
I mean, honestly, wow, they actually have the power to raise prices. Who would have thunk it? This is not the demographic that we're talking about with potential price increases.
What demo are we talking to?
The people who are buying $30,000 cars, and whether they can absorb whether they can absorb a
Maybe the Ferrari tariffs should be higher, and $30,000 cars.
Now we're getting
Those
into
tariffs
it.
should be
Nice.
lower.
I'll let people who are above my pay grade decide that. I'm just saying, I'm not, it's not exactly a sob story.
The congressman from Arkansas nodding along as you make that policy proposal. We'll get to that in a moment. Okay. On our radar this morning, Elon Musk saying his Doge cost-cutting team is looking to slash $1 trillion in government spending by the end of May. Musk aiming to cut 15% of annual spending, which amounted to $6.75 trillion in fiscal 24.
So at this moment, they're nowhere really near close to that. If you look at the Doge website, they have a lot of overstatements of what they have, but they talk about $22 billion in contract savings. Then they claim there's another $130 billion overall cost reductions, but those cost reductions are not itemized. So I think it's pretty important that if they want to sell this to the American people, at some point, Elon Musk and the Doge team, and we got an introduction to more than just Musk yesterday. There's a handful of them trying to talk about exactly what they're doing, which I think that transparency is useful. We should see the itemization of these cuts.
Could be a busy day in Washington. This also on the radar. Canadian Prime Minister Mark Carney saying he will fight back against President Donald Trump's trade war, including fresh tariffs on the auto sector. The two are expected to speak potentially as soon as today.
That's going to be an important phone call, obviously, because Canada and the United States the rhetoric has been hot, and obviously with the tariffs, they're not going away. What I find interesting about this relationship now is Mark Carney talked about the future, and he said it's clear that the United States is no longer a reliable partner. Not now. He meant in the future, and obviously for these two countries, the trade integration is incredibly important. Can he potentially get a deal for Canada before Liberation Day?
Even if he could, I'm not sure he'd take one. Electoral politics. It is not in the Prime Minister's interest right now to get along with the President of the United States. Now, you might disagree about whether that should be the case, shouldn't be the case. That is the case. That is the case right now for Prime Minister Carney.
It is the reason why he is the Prime Minister, because otherwise the Conservative Party would have won. The reason why the rhetoric is so fiery, that the old relationship with the United States is over in terms of what it used to be, speaks to the increasing ire. Did you see that the bookings by Canadians to the United States for travel have fallen by 70% over the past couple of months? People don't want to come here.
At the same time, he's not just a prime minister, he's a former central banker. I think he understands that doing a deal would maybe be helpful, even if it's not politically as great, maybe to keep his prime minister role. He does know the repercussions on the Canadian economy is going to be worse than on the U.S. economy.
He's got someone to blame. I think he's got an election to win. The fact that we're not talking about Poilievre, the Conservative leader who had a 20-point lead a few months ago, where is he? Hardly being talked about. Had a huge lead. This tariff spat has completely upended that election.
Yeah, and it's sort of like a reversal of South Park, you know, blame Canada. Now it's like blame the United States. And so it really is a good rallying cry.
Nice, I like that. People are going to run with that, you know. Okay. Let's finish on this. The Trump administration pushing to control all major infrastructure and mineral investments in Ukraine. Bloomberg obtaining a document outlining a so-called right of first offer that would vastly expand America's influence compared to the European Union.
I'm not really surprised about this because obviously Zelensky left the White House without signing that mineral deal, and I think then the cost just went up for what the U.S. was willing to get from Ukraine, the extraction. What you hear from this administration is that they think that doing economic deals could potentially help foster the protection, the security that Ukraine is looking for.
Let's get to this story, and let's get to our guest. Senate Republicans working on changes to the House GOP tax plan, looking to require fewer cuts in Medicaid benefits for the poor and disabled. The move aiming to appease members of the party worried about public backlash. I'm pleased to say that a good friend of this program, a good friend of ours, the Congressman from Arkansas, French Hill, joins us now for more. Congressman, good to see you, sir.
Jonathan, great to be with you and Lisa and Anne-Marie. Always good to be back in New York.
Is it turning out to be as much fun as you thought it would be down in Washington?
Every day is a joy.
April 2nd, how much of a joy is that going to be?
I'm just glad it's not April 1st, because that would even increase the uncertainty even more. I mean, actually.
What are your constituents telling you about what's happening in Arkansas on the ground?
Yeah, look, on the relations to tariffs, about 30% of our output in Arkansas goes to Mexico or Canada. And that's food and manufactured goods and back and forth. And then you have the North American Free Trade Agreement, now under USMCA, that was crafted to make North America the destination for manufacturing. So for 30 years, it's been knitted together. And so I think the first thing that I'm hearing is certainty, and just lay out the plan on how you want to use tariffs to open up more markets for Americans, have reciprocity on fairness in certain markets that are highly disproportionate treatment, like India, for example. But when it comes to North America, let's renegotiate USMCA. If you want to limit certain inputs from China into Canada, Mexico, or the United States, you can do that in the agreement. Those countries can do that on an input basis. If you want to have the American manufactured content higher, you could negotiate to do that, as President Trump successfully did last time he was president on the North American auto content. He got more American content. So I think it's best to tackle this Canadian and Mexican issue inside a new and revised USMCA.
But USMCA was done under Trump. It replaced NAFTA.
Right.
So you want USMCA Part 2. Do you think that's what he's getting at, Donald Trump here, the president? He's getting at the start, bringing those 2026 talks up into the mid-2025?
Yeah, potentially. And I think that's not wrong thinking on his part. If you're concerned about Chinese dumping through transshipment of steel, for example, into Canada or Mexico, let's deal with that inside the agreement. Let's have Mexico deal with that in their own trade policy on inputs coming into the country. Because that's how I think you have a more robust, competitive international system where manufacturing is at the heart of America. I think President Trump strategically in trade diplomacy, I'd like to see more things made in America. That takes time to do. It's not overnight. We had steel and aluminum tariffs, for the past 5 or 6 years, and they haven't, been overnight changes across the board.
Walmart is headquartered in your state. They went to China and said, look, we're dealing with tariffs. You're going to have to eat some of this cost. And the Chinese are saying no. Are you concerned about the cost being passed on to consumers?
I am when I don't know what the strategy is. This is the whole point. You have trade diplomacy on using trade as a sanction potential, like you saw the president do on Colombia on repatriation of immigrants. You had trade used for reciprocity to bring down actual barriers that benefit actually both countries potentially over time. And we did that successfully for 40 years. We did it targeted. When I was in the White House working during the Bush administration, we used Section 301 to target bad activities by principally then Japan to open those markets doing this kind of tariff activity and limitation on imports to the U.S. So you can do that in a classic trade diplomacy situation. But when you have across the board and it's not clear on what the time frame is for the increased production in the U.S., I think that's the challenging part.
But is it your sense when you speak to the White House that April 2nd is the start of negotiations, that at the end of the day, the president is a deal maker and wants to get deals done?
Well, I hear from my colleagues on the House, they want clarity like the American business wants. So you tell us what components and what timeframes you want to do trade diplomacy, you want to use reciprocity, you want to protect certain industries in the U.S. where you want to have achievable gains in production here. But when it comes to autos, which is the most important topic of the day, I think that's best done through advancing changes to the USMCA that President Trump led successfully with the Mexicans and the Canadians in his first term.
The market's also looking for clarity on all of Trump's proposals, especially tax cuts. The Senate, the Republicans, Eric Wasson, our reporter in Washington, D.C., is talking about how they want fewer cuts to Medicaid health benefits for the poor, disabled, which would be different what the House is talking about. Do you think House Republicans, Senate Republicans can come to an agreement on how much can be cut?
I do. I think we'll come to an agreement. I think we can come to an agreement rather quickly on a joint House and Senate resolution for reconciliation so the committees can get to work. And I just referred to the Wall Street Journal story today talking about duplicate payments in Medicaid across the states and how large that number is. House Republicans are looking ways to improve Medicaid, focus Medicaid on the most vulnerable, the young, the poor, the disabled, and trying to wring costs out of the systems. Democrats, I think, in a political charge are, well, you're going to cut benefits for Medicaid. That's an assumption by Democrats politically.
Well, because the math doesn't work when you're talking about $880
And also, that's the charge for the whole committee.
Right, yeah. but most of that money goes to Medicare, no?
Right, but look at the numbers, and I think that's what the House and Senate want to do. Let's get to a Senate resolution, and let's let these committees work to mark those bills up to find the savings that we can produce.
Besides the extension of TCJ, what other tax cuts do you think are actually feasible? The president has talked about no tax on Social Security, no tax on tips. Just this week, no tax on auto loans apparently is being thrown out there and he's flirting with. What actually can get passed?
Well, this is the beauty of the reconciliation process because the president puts his plan out there, his best ideas, what he wants to try to accomplish, and then the House and Senate have to come together and figure out what we can do in the context of that budget resolution. Can we find the cuts? Can we find the offset? Do we agree in the House and Senate on the economic forecasts? And so I won't prejudge what the possibilities are. I just know how hard the work is going to be. I want to put an emphasis on things that grow the economy. So if we have to narrow the focus on what amount of tax cuts we're going to have, let's focus on ones that produce production, more jobs, faster economic growth.
Do tariffs increase revenues and turbocharge growth?
Again, this depends on the strategy, Lisa. You know, you can have an across-the-board modest tariff that might raise revenue and not impact growth economically. But what is your goal? Is it reciprocity? Is it market opening in new countries? Is it level of the playing field, or is it increasing production in the U.S.? Those things are sometimes in conflict.
What number are you penciling in for the tariff revenue to offset some of the cuts?
Right. So in Congress, we're actually not penciling in tariff revenue because it's not counted by this Congressional Budget Office as an offset, which doesn't mean we can't count it. Like if there was a strategy and it laid out, the two budget committees could agree. We will accept some revenue from projected tariffs in the revenue estimates in the reconciliation package. But we're not, as of now, counting that. That's a hypothetical that we're actually not counting on. Right?
Has Walmart been in touch? I imagine they must have reached out to you and other representatives of Arkansas. How upset are they about this?
Well, they want, I think so many businesses, and they report on your broadcast on a regular basis, they can live with certain things if they know what the plan is. And so Walmart's concerned about the number one thing they think about every single day, which is the American family they serve. And they want to make sure that that can be done in an affordable way. That's their goal in life. So this could interfere with that. But we need to wait and see what the ultimate goal is.
Do you think the White House appreciates that? Because we hear this every single day, and we've said on this program, confidence coming into 25 was sky high. We wanted to see that sky-high confidence translate into hiring, into investment. Right. And the lack of clarity, the lack of certainty, it's really held things back, and you see that in the sentiment surveys now. Does the White House, in your opinion, sort of understand that? The lack of certainty, the lack of clarity is holding this economy back.
I certainly think Treasury Secretary Bessent and National Economic Council leader Hassett know that. They're very experienced in economic policy making. And my view is you've got I think, clarity about right-sizing regulatory costs in the economy. You've got clarity about trying to reduce the bureaucracy in the government. You've got clarity on where we want to go on tax policy. We need an equal amount of clarity on the strategy in and around tariffs and increasing manufacturing here. President Trump's big picture point is a good one, but you've got to develop a workable strategy to do that. And I think that's what the role of the Treasury Secretary, the Commerce Secretary, and the National Economic Advisor, that's their principal mission.
Congresswoman Elise Stefanik is going to be staying put in Washington, D.C., not coming to New York to work at the UN. Do you think that's an admission by the White House that they're nervous about getting this tax bill done through Congress? They have the votes?
Well, it surprised me. I'll be candid. I think Elise was an outstanding member of our leadership team. We welcome her back to the Congress, but I also thought she was going to be an exceptionally well-trained and qualified ambassador for the president at the United Nations. It could signal that. I think President Trump's own quote says we need to make sure we have the votes in the House. So if you consider that an admission, we welcome her back. I think it says that maybe replacing her with a Republican they think might be tough in New York as a political strategy, which is that's been a red district, but you know that may indicate that. And we need every vote we have. We have the most narrow margin. Mike Johnson has the most narrow margin since World War I, and so we don't want to have a gap there. And when we passed Tax Cuts and Jobs Act back in President Trump's first term, I think some 20 Republicans voted no. So we don't have the luxury of that this time.
Congressman, we always appreciate your time. It's good to see you.
Great to be with all of you.
Thank you, sir. Congressman French Hill, and also the chair of the House Financial Services Committee. Equity futures right now in the S&P slightly softer. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. A 7.7 magnitude earthquake struck Myanmar, causing buildings to shake and triggering evacuations in Vietnam and Thailand. And in Bangkok, a 30-story building under construction collapsed, killing 3 people. The quake was the strongest worldwide since 2023. Meanwhile, yet another record for gold as concerns mount over President Trump's tariffs. Gold hit an all-time high of more than $3,085 an ounce today, though it has since weakened. This coming as Goldman Sachs raises its forecasting. It expects gold to hit $3,300 an ounce by year end. And in March Madness, unfortunately for the congressman, Arkansas's title run came to an end after a thrilling overtime loss to Texas Tech. Meanwhile, Florida beat Maryland and Duke took down Arizona behind a 30-point performance from Cooper Flagg. The action picks up tonight with Ole Miss versus Michigan State and number 1 seeds Houston and Auburn tip off against Purdue and Michigan. That's your Bloomberg brief. John?
Yahara, thank you. Didn't even get a mention there, French. Not even a shout it.
I was going to burst into tears on national television. I stayed up till 1 o'clock here, hoping my Hogs would pull it out. But congratulations to the Red Raiders.
Who's scheduling these games this late at night?
In California, late at night, it's just...
Can we legislate for that? Why have we got this California bias?
People debate about daylight savings time. Let me tell you something. Central time is God's time, and you just can't operate outside Central time.
You tell them. All right. It's good to see you, Congressman. Thank you. Up next, debating the T word.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory.
I try not to use that word anymore. I will just say that.
Up next on the program, Earl Davis of BMO from New York. This is Bloomberg.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We're going to solve this, addressing the Liberals' bias on sports scheduling.
You're going to lobby congressmen one at a time.
That's what we're doing.
Literally.
We're going to make it happen over time.
I don't agree with CET,
Because
though.
these studios are based on the West Coast, and they're making us stay up late to watch sport. Sunday night to watch March Madness. Unbelievable, unthinkable stuff.
Most people don't wake up at 3.
Can they stay up till 11 to watch the basketball?
It's not a problem. Yeah, because they wake up at 7, it's okay.
Silly.
The poor congressman was up till 1 a.m. He had to be on TV the next
Do you know I've enjoyed so much watching Premier League football in the UK at like 7:30 in the morning? It's perfect.
Good, I'm glad.
Wake up, put the sport on. All right, let's move on. Futures on the S&P, negative by 0.1%. Under surveillance this morning, we're debating the T word.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory.
I try not to use that word anymore. I will just say that.
Looks inevitable that tariffs are going to increase inflation in the near term.
I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary.
So let's get to the take from Earl Davis of BMO. This is what he's got to say. Transitory tariff inflation is true, but tight employment is where inflation will come from. This, ironically, has brought inflation expectations back to the forefront. Earl joins us now for more. Welcome to the program, sir. We've been debating this all week for the last 2 weeks, in fact, ever since we heard from the chairman of the Federal Reserve in that news conference. How fertile is this environment for second-round effects of inflationary impacts from tariffs?
It's extremely fertile, and the reason why it's extremely fertile, it's not necessarily about tariffs or actual inflation, it's about inflation expectations. And given that the Fed was unable to get inflation back to target during this downturn in inflation, let's call it 2%, you know what, it's easy for those expectations to become unanchored, and we are seeing a drift higher. They're still anchored, but it's easy for them to become unanchored. So for that reason, we think possible inflation and rise in inflation expectations, the ground is extremely fertile.
So do you think that this is a terrible time to buy long-term bonds at a time when just a couple months ago you thought it was actually a good time?
Actually, the opposite, and I'll walk you through. Right now, we're slightly underweight bonds. We believe we could go to 450. But once we hit 450 to 5%, we buy. And this is why you have to look at the mathematics of bonds. So if you look at the Bloomberg U.S. Aggregate Index, which is a bond index mix of treasuries and corporate bonds, the duration on that 6%, 6 years. The yield is 4.7%. So if you get an instantaneous 100 basis point rise in interest rates tomorrow, instantaneous, you will be down 6% market value, but you will make back all of your money in 1.1 years because your coupon will now be 5.7%. Above 4.5, you make back all your money in 1 year. and you're up. So if you tell me I could buy bonds and be protected for an instantaneous 100 basis point move, I'm buying. And that's what active managers do. Having said that, we're still aware of market movements and we want to outperform. So that's why we are slightly underweight now, but we have levels at which we buy.
Earl, this is the most bond conversation ever. Actually, check the math. I am curious, though, how much this is predicated on the idea that it is a better alternative than risk assets simply because there is this uncertainty that could weigh on growth.
I wouldn't say it's a better alternative. It's part of an overall diversified portfolio, and it provides. And so the reason why you want to own bonds is two reasons. One, the coupon, and as I said, in the aggregate, it's close to 5%, which is very attractive, much higher than it's been since the global financial crisis in general, or in the upper end of that range. And your flight to quality, as we've seen why bond yields have rallied now, in case you do get a severe sell-off in risk assets, which we're not anticipating, but you have it for those two reasons. So because of that, and because you're making more than inflation, you're getting a real return, it's an ideal thing to increase the allocation to in the overall portfolio.
Earl, equity investors just want to make it really simple. Can you tell them that if the economy gets in trouble, this Federal Reserve will be in a position to cut interest rates?
Oh, yeah, largely so. In regards to, we could go back to neutral, they call 3%. We could go easily into easing territory. I want to put a caveat on that, though. Although I think they've opened up the door to cutting rates, if they cut rates too early, let's call it the first half of the year, I think bond yields could actually go much higher. And the reason why they go much higher is because the market could say, we no longer have discipline on monetary policy if the data doesn't support the cuts. So the data has to support the cuts. We have to see a trend of weakening growth. We have to see a trend of higher unemployment. If they cut without those trends, they do risk the bond vigilantes taking over. So that's a big caveat there in regards to the timing of eases.
Earl, this was a clinic. It's good to hear from you. Earl Davis there of BMO. We got a flavour of that at the end of last year, didn't we?
Yeah, very much so. So they want to avoid that, and yet they're kind of between a rock and a hard place.
Up next on the programme, Kevin Gordon of Charles Schwab, Daniel Ruska of Bernstein, former St. Louis Fed President Jim Bullard, and Mike Kontopoulos of Richard Bernstein Advisors. The third hour of Bloomberg Surveillance, just around the corner.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow,
you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Trade and tariff cannot be taken lightly.
The administration is moving forward with fairly aggressive tariffs.
We have now the highest effective tariff rate since we've had since the 1940s.
What is the probability that beyond next week we're putting completely to rest the tariff issue? That probability is probably very, very low.
April 2nd is not the beginning of the end. It's the beginning, and there's a long way to go before the end.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores. Equity futures on the S&P 500, negative this morning by 1/10%. Through Thursday, just about poised for a second week of gains on the benchmark on the S&P 500. On the Nasdaq, we're down by 0.2%. Important data point later this hour, 8:30 Eastern Time, another read on inflation in America. Later on this morning at 10 a.m., another read on consumer confidence. And consumers haven't been too confident.
Certainly not in the surveys where it seems to be that everyone is expecting Armageddon. If you take a look at the actual data, it hasn't been as bad when you take a look at what they've been doing. That's the reason why the 1-2 punch of personal income and personal spending, and then the survey is going to be really important at a time when market-based inflation expectations have been creeping up. And that is the reason why maybe on the margins people will be paying that much more attention.
I'm with you. Spending. Retail sales. This is so important because there seems to be a spread, a difference between how people feel and what they're doing. But when you listen to the consumer-facing companies, they're telling you that they're not doing as much as they used to. Lulu's down this morning by close to 12%, and they're not alone. We've heard this from Delta Airlines. We've heard this from others.
And this is the reason why earnings are going to be so important as a gut check for that sentiment and how much is coming through. We do wonder about sandbagging. How much is Lulu realizing that not everybody wants to wear spandex around town and that maybe they need to loosen it up? At the same time, there has been a consistent trend across consumer-facing companies, and that is the reason why it's getting people's attention.
They're worried about tariffs without saying they're worried about tariffs. Coming up with this McKinsey-esque language to say we're worried about tariffs. Next week, a lot of you I know worried about what we might hear on the tariff front by the President of the United States. April 2nd, Liberation Day, is coming up fast.
It's coming up fast, and potentially we'll get some leaks of the president talking about tariffs ahead of next week, ahead of Wednesday. So you're going into the weekend really needing to be informed. When it comes to that McKinsey-esque jargon, there continues to be considerable uncertainty driven by macro and geopolitical circumstances. That being said, remain focused on what we can control, aka every single company is trying to understand and get clarity from what the tariff and trade policy is going to be in the United States next week. What do we hear from analysts? It's just the start.
When you don't have any control, it's hard to feel stable. It's hard to feel like you actually have a sense of what's going to happen.
When you talk about the economy, you do realize it sounds like a therapy session.
Well, that's what I was talking about with Tom Barkin coming out saying policy changes have created, quote, a sense of instability
you should charge
in the
for
business
this.
community and could quiet demand among consumers because when you feel unstable, you just go quiet.
How much is it for an hour? Sit down with Bramo, bit of therapy.
You can get it
work
for free.
it out.
Bloomberg Surveillance every morning.
Find some stability with Lisa. Equity futures on the S&P, negative by 0.1%. Coming up this hour, Kevin Gordon of Charles Schwab, as stocks look to recover from 2 days of declines. Daniel Rusker of Bernstein calling Tesla the clear auto tariff winner. And we'll speak to the former St. Louis Fed President Jim Bullard reacting to the latest economic data. That data, 26 minutes away. We begin this hour with stocks little changed as traders brace for President Trump's Liberation Day tariffs. Kevin Gordon of Charles Schwab writing, April 2nd is just a continuation of the beginning. The reality is no one knows what's going to happen. There is simply no conviction to be had on trade. Kevin joins us now for more. Kevin, good morning.
Good morning.
We'll get it together for you, don't worry. If you can't have conviction for next week, how much conviction can you have in markets?
I think it's tough. I mean, especially if your market call is tied to anything trade or tariff related, which it almost has to be, at this point of at this stage in the game. So, our sort of feeling around markets for this year, and I know we've talked about this a lot, our call being you're probably going to see a lot more index level volatility relative to last year, which has already been the case. We're almost, 3 months in. That's just one quarter, and you've already gone through a full-blown correction for the S&P, for the NASDAQ, almost for the Dow. So, the low conviction environment is one where you just want to cling to quality and make sure that you're not sacrificing anything, especially because, some of the earnings reports and transcripts that you guys are covering this morning, a lot more cracks are now forming within, the earnings picture, not at the overall aggregate level, but you do have to wonder at some point how much of this is just a collection of idiosyncratic risks for certain companies and then just that forming into and becoming a macro trend. That really becomes a dominant issue and why our kind of hideout and high quality theme has been so persistent for the past couple of years.
Is that a distinction without a difference, that final point?
It gets tough. I think that what was, and maybe I'll phrase it with some sort of data points around it, where if you think about what was so interesting to us for the fourth quarter earnings season, even though you went from a blended growth rate throughout that reporting season from around 8% at the beginning to 17, 18% by the end, as that was happening, every single quarter for 2025, all those estimates got cut. So you didn't have any pickup, and there was no almost relief on the estimate front, which is, typical of what you see at this point of the earnings cycle, but you would at least start to see maybe some context around, hey, even though, our earnings estimates are getting cut, guidance is still relatively strong, we're still going to see relatively strong revenue growth. That's not happening as much anymore. You layer on anything from a tariff standpoint, especially for a lot of industries like autos in particular that are operating with thin margins, it's a tough scenario.
Is the concept of quality changing? And I ask this because utilities were boosted by the AI trade, healthcare was boosted by a lot of government spending. You have all of these sectors that have traditionally been called quality that are coming under some pressure.
Yeah, what's tough about this is that sometimes, and especially in this cycle, quality and momentum go hand in hand, meaning, for a good chunk of this cycle, and I still would argue the case today, whether you're looking at the Mag 7, the 10 largest companies, even if you brought it out to sectors like tech or communication services, a lot of the fundamentals are still relatively strong. It's just unfortunate that, especially for a group like the Mag 7, they got caught up in the momentum trade. So when you get that unwind in momentum, it exacerbates the move to the downside, which is exactly what we've seen. I mean, the Mag 7 have gone into a technical bear market just this year, but there doesn't mean that the quality has just completely flipped overnight and they're now these, junk companies. So I think that is the tough part about, yes, still wanting to maintain exposure to quality, but understanding that if they get caught up as a momentum trade and if they dominate the momentum factor, then they're going to get caught up in a sell-off and get hit more to the downside relative to the rest of the market.
When you start describing this to clients who are concerned, their eyes glaze over and say, just put me in gold?
Well, I have gotten more questions on that now, especially with all the events that I've gone to, over the past few weeks. But no, there's still definitely, I think, a bias to stay in the equity market. But and I know we've talked about this a lot just this year, just discussing the idea of lengthening time horizons and making sure that you're not trying to make knee-jerk reactions and knee-jerk decisions based on what's going on a day-to-day basis, because as we all know, and as you pulled from the quote, nobody knows what's going to happen. I mean, really, everything it's such a low conviction environment, it's really hard to find another period that's similar to this in terms of conviction.
Is there a bias to leave the U.S. still?
I would say still not. That hasn't been the case in our client base. It's been a long, process of trying to, at least just kind of espouse the idea that diversification outside of the U.S. is a good way to go. And our international strategists and team have been, pounding the table on that for the past year. It's been a hard sell up until maybe January 20th of this year when things started to flip pretty quickly. But you're starting to see a little bit more interest, and that's actually started to, that's being reflected now in flow data, which I think is kind of that next step of the phase. Everything was sort of attitudinal at first. Now it's starting to filter over into the behavioral as well.
Reading through your notes, you start by talking about April 2nd and this uncertainty, and then you end on all roads lead to labor market. When will all of this hit the jobs market?
I think a lot of that is going to show up, well, what you have to wait to see if it happens is that mechanism, that connection between anything tariff-related raising prices and then leading to some sort of consumer backlash. Because you have to keep in mind, I mean, the consumer is in a very different spot today than it was a few years ago, even when we were going through that massive inflation spike in 21 into 22. That was happening at the same time that the labor market was rebounding and strengthening. Right now, the labor market is not strengthening. It's yes, in a relatively good spot, but it's also in a relatively fragile spot. You don't want to have to, take a sledgehammer to any parts of it and see if it's, working or to see how strong it is, because there are cracks that have formed. So I think that that's kind of the next big phase or the next big test for this, especially because basically all of the soft data has rolled over sharply, not just on the consumer side, but also on the business side. So if you start to see a hit to real disposable income growth, start to see a hit to spending, that brings revenues down even more for businesses. They're already in a tougher spot, so you can see how the domino effect happens from there.
John, Kevin was talking about how it's a hard sell to go to Europe as an investor, not as a tourist. But I am curious about how important it is to look at these flows. He mentioned flows. You saw the largest outflows coming from U.S. equity funds over the past week. $20.3 billion of withdrawals. Guess who saw inflows? The 7th consecutive week of inflows. It was the European equity funds, totaling around $3 billion. Again, we are starting to see it bleed into market performance.
Careful what you wish for. I go back to the note from Peter Schiff Academy from last weekend, and he raised a really important question regarding April 2nd. Careful what you wish for. We'll get certainty on April 2nd. Is that the kind of certainty that European investors will want to see? Are they whistling past the graveyard?
Well, you'll get certainty to some degree, but who's to say that April 3rd it doesn't all change? I mean, nobody knows that. And I think even with April 2nd, you look at the laundry list of what has to be done. For a small team, relatively small team at USTR to go country by country, maybe product by product, all through those lists, it's a heavy lift. If they come out with that, great. But at the same time, if you go through another wave of uncertainty, and if April 2nd becomes then May 5th or June 10th,
it's true,
or August 5th, I mean, it really is now the policy being uncertainty. Uncertainty is the policy to some extent.
This is what Max Kenner of HSBC said. He said uncertainty can persist, but I think as an investor, you have to think about the balance of risk. One market is up double digits this year. Yeah. The other market has fallen double digits this year. One market has started to internalize the risk associated with these policies. The other market, has it started to internalize the risk associated with these policies?
I will say to some extent you can see this actually at a sector level where there is some consistency and overlap. And one of our overweights, one of two that we have at the sector level in the U.S. is financials. And financials globally as a story of leadership has actually been pretty consistent. The double-digit declines and the majority of the declines here so far in magnitude and in mathematical terms when you look at the weightings in the index has been tech-driven, tech, communication services, consumer discretionary. If you start to look at the other parts of the market, whether it's financials or utilities that have maintained some kind of leadership status, especially if you look at the percentage of companies that are above their 200-day moving average, it's actually been relatively strong.
Don't you think that begs the question as to whether this has anything to do with tariffs at all? Well, the correction that we have seen on the S&P is dominated so much by U.S. tech firms.
Yeah, there's certainly a tie-in with tech that's tariff-related, but actually if you look at the correction that we had from February 19th to the March 13th low, at the industry levels, if you look at all, I think 74 industries, retail, autos, some leisure parts of the market, they were at the bottom of the leaderboard. So it is still a tariff story, but it's hard to see when, the tech and tech-adjacent parts of the market are just so large, and when that momentum unwind, and now the AI sort of theme and narrative is coming a little bit more into question.
It's been absolutely battered. Kevin, it's good to see you, sir.
Good to see you.
Appreciate your time. Thank you. Kevin Gordon there of Charles Schwab. Just getting a headline I wanted to share with you from CBC Radio Canada that Prime Minister Carney and President Donald Trump will take a call, and that call will take place later on this morning. So a bit of confirmation again on that front.
Right, that this was, they were talking about how they were going to set up this call. The Prime Minister coming out saying that they will retaliate against these tariffs. Obviously, I think this entire conversation is going to be about trade ahead of next week.
Without a doubt, you'd expect. Equity futures right now in the S&P down by about 0.2%. Not the congratulatory call from the President to the Prime Minister to say, Congratulations.
I don't know if there's going to be a congratulations on this one.
Let's get you an update on stories elsewhere. Tavia Flanawal, here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. The U.S. Defense Department says it will terminate a plan to use Oracle software to manage its civilian workforce. It's the Pentagon's latest move to cut costs. The announcement comes after Defense Secretary Pete Hegseth said the program and other contracts are 6 years behind schedule and more than $280 million over budget. Oracle shares are lower at 1.4%. Meanwhile, Elon Musk says he plans to slash $1 trillion in government spending by the end of May. Musk told Fox News he doesn't think the savings will affect critical government services. The Doge website so far lists about $22 billion in contract savings, while claiming $130 billion in unspecified cost reductions. And in sports, Novak Djokovic made history in Miami. His victory over Sebastian Korda in straight sets makes him the oldest player to reach an ATP Masters semifinal. The 37-year-old will now play for his 7th Miami Open title, with his semifinal match against Grigor Dimitrov getting underway later today. That's your Bloomberg Brief. John?
Yahara, thank you. Tough crowd this morning. Unhappy about the lack of baseball coverage?
It's opening day yesterday, and the Yankees won.
He's
Why are we doing tennis?
He gives us hope.
There you go. You've got some space. You want to talk about it some more? Is that it?
No, that's fine. We won
Yankees won.
4-2 versus the Brewers.
What happened to the
Mets,
Mets?
I believe, lost. Sorry,
Okay.
Lisa.
Is that why you wanted to talk about this?
Well,
Just some crosstown shade.
Multiple reasons. Multiple
Okay.
reasons.
We're running out of time.
For the people of Queens. Okay. Up next on the programme, the Morning Calls Plus, Daniel Ruska of Bernstein naming Tesla the clear auto tariff winner. That conversation up next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The opening about 1 hour and 13 minutes away. Equity futures here negative by close to 0.2% on the S&P, down by almost a third on the Nasdaq. That's the price action. Let's get to some morning calls. First up, Raymond James downgrading Lulu to market perform, citing the uncertain consumer. That stock is down by 11%. Your second call from Citi, raising its price target on Southwest to 30, citing moves to reduce seat mile costs. That stock still softer by 0.4. And finally, Deutsche Bank cutting its price target on Tesla to 345 ahead of the company's Q1 deliveries, citing weaker demand trends. That stock is bouncing back by 1.5%. Sticking with Tesla, Daniel Ruska of Bernstein writing this about auto tariffs. Tesla wins, Detroit bleeds. Tesla is the clear structural winner for everyone else. This is a margin reset. Daniel joins us around the table. Daniel, good morning. Good to see you. What a time for you and the team to try and work through this, eh?
Little sleep.
Do you know what is exempted and what isn't going into next week?
On vehicles that are imported, we have a pretty clear idea. On parts that are imported, we have not, because the Annex 1 hasn't been published yet.
So we don't even know what this means for individual companies in many ways.
On a high level, I think we can get a good sense, but in the detail, if you ask me, can you give me the cent value? The answer is no.
Do you think autos in the end that are USMCA compliant will get exemptions?
Yeah, I think the U.S. content will get exemptions, and I think that's where the big debate is right now, how much U.S. content actually is within the cars. It's one of the reasons we think Tesla, at least for their U.S. sales, has a leg up, because about 60% of their content is from the U.S.
So do you think the auto companies will actually, at least for the production of those parts, if they're paying tariffs on them, will they try to get U.S. suppliers? Will they try to move more back into America? Or do they just eat the cost and pay the tariff?
You need to try to get the supply chain back right now. So the incentive is very clear to maximize your U.S. content, but everybody's trying to do that. And it's not like the U.S. suppliers are just duplicating a number. I'm pretty sure that by 7 p.m. on Wednesday, the entire U.S. supplier capacity was bought up already. And so it's going to be really difficult to really change that percentage by a large degree.
The way that you frame this, I think, is important, that for the rest of the auto industry, it's a margin reset. And this comes at a time where President Trump, reportedly by the Wall Street Journal, threatened auto executives by saying, you're not going to pass this along to consumers or else. And there is this feeling, what do we do? Can they afford to absorb the margin differential and not just pass it along to the consumer?
No, let's put some numbers on this. So if what was announced on Wednesday gets rolled out without any changes to supply chains, the U.S. auto industry will have to pay $110 billion in tariffs. The entire gross profit of the U.S. market is $140. There is no way this is happening without raising prices.
So which prices go up the most? We were talking about Ferrari. We're all crying for Ferrari and the fact that they can raise their prices. There isn't the same kind of luxury in many ways in a lot of the other manufacturers. So what are we looking at in terms of who has the leverage and how much prices are likely to go up?
So on average, we think prices are going to go up by about 7%. That gives you a volume hit of about 5%. So it's a good equal balance. Half of the tariffs paid by the consumer, half of it paid by the companies, basically. And the ones that will bleed most, well, actually it's not Detroit, it's the foreign ones. So everybody who's making cars around the U.S., so Japan, Korea, Europe, that's really where you'll probably see the highest price rises and hence also the biggest volume decline. And probably into 26, that maybe gives you an opportunity for Detroit to actually capture some share.
So price up, demand down initially. Does that make it harder to invest in the way that the administration would like them to invest domestically?
I think it's impossible for them to invest in the way the administration would like to invest, because what the administration is saying, please build more factories in the U.S. One auto factory, $6 billion, short, quick check. That's not going to happen. And
do you think the White House reversed course the way we have seen Trump reverse prior?
I'm not certain on that, because what we're seeing in this executive order, it's a lot more detailed, and the way they've gone about it is much more structured than 6 weeks ago. And so there is much more purpose in this, which has led us to say, look, the likelihood that this stays is a lot higher than it was, and the market certainly is starting to agree. You saw the move on GM. GM's down another, I think, 150 bips this morning in pre-market. And so the sentiment of market that was, oh, this is only going to last 4 to 6 weeks, is shifting to this will stick around. I think the next straw investors are clinging to is maybe the Trump administration, as a trade-off for that price guarantee, will give more USMCA exclusions somehow and benefit the U.S.
When it comes to what does the auto companies do in terms of protect their margins, at some point, do you expect layoffs?
No, because remember, not in the U.S., right? Because every car you make in the U.S. has a fairly high or relatively higher domestic content than everything that's around the U.S. And so production is going to centralize to the U.S., so no layoffs. But, that doesn't mean you wouldn't see staff reductions in Mexico or Canada or other regions around the U.S. that sell into the U.S.
So let's go to the other part of this equation. You said Tesla wins, Detroit bleeds, as John was reading out. And I am curious about the Tesla winning part of this. Why are they winning? And putting aside conspiracy theories, because frankly, that was kind of put aside, at least by the president, and Tesla does have a big manufacturing base in the United States. How much does it actually benefit?
Yeah. So while we don't cover Tesla right now, we looked at the impact of the tariffs on their U.S. business. And Tesla makes 100% of the cars they sell in the U.S. And those cars have 60% U.S. domestic content. It's the highest share of U.S. domestic content in the U.S. auto manufacturing industry. And that means the tariffs they'll have to pay for the parts they import will be the lowest. And so if we expect that the overall sector rises prices by about 5%, we think Tesla's cost for US-built cars only goes up 4 to 5, which means they actually have a margin expansion. It's the only company in our analysis that has a margin expansion on the back of all of this. That's where the comment came from.
Have you made any assumptions on how others will retaliate? What this could mean for European markets, Chinese markets?
No, not yet. There, if I think of our Detroit 3, I'm a little bit more relaxed, right? Because they don't export to Europe. Nobody exports to Europe from the US. And so retaliation, at least on the auto sector, from a European point of view, would not be too detrimental.
Where does it leave that BMW factory in South Carolina? How much exporting do they do?
That's the only one, right?
Just that single one?
40%. You've got a little bit of a Volvo in South Carolina as well.
And Mercedes-Benz.
Well, Mercedes-Benz mainly manufactures for the U.S., so the Alabama factory is fairly low. The export percentage is fairly low. But the big challenge, of course, for these factories in the U.S. is the main thing they import is engines. They don't build engines in the U.S. And so they only have a U.S. content of about 15% on their locally manufactured cars.
Interesting.
That's going to be, you know, your Mercedes is about to get a lot more expensive.
Wow. Daniel, appreciate your time. A lot to think about, and I know you're going to be busy through next week as well. Daniel Ruska of Bernstein. Tesla wins and Detroit bleeds. Not a great headline.
You asked the key question, though. Can we game out the retaliation? And who is the most likely candidate for retaliation? And you have to imagine that Tesla might be the beneficiary in the United States. But how much does that increase the target on this company's back internationally at a time where you already have seen consumer pullback?
I thought you brought up a great point, too, about South Carolina. Mercedes-Benz is there.
Huge success story. Phenomenal.
BMW is there. Volvo is there. You have to imagine Governor McMaster is calling the Oval Office and saying, we have European companies headquartered here that are hiring Americans in South Carolina. Please be lenient, be flexible, is what the president has said he might do.
I think they'd like to see the parts story shift as well, which is where a lot of the employment is for that particular industry. Equities right now in the S&P, negative by 0.2%. Up next on the program, we'll get you some inflation data just around the corner and some reaction. We'll speak to the former St. Louis Fed President, Jim Bullard, in just a moment.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Equities at the moment just a little bit softer. The opening bow 60 minutes away, some economic data seconds away. We're down by 0.2% on the S&P, and the Nasdaq 100 down by a third. In the bond market, yields a little bit lower, down by 3 basis points at the moment. The 10-year 4.33, the 30-year down 4 basis points to about 4.68. Let's cross over to Mike McKee to get you another read on U.S. inflation. And Mike McKee joins us now. Good morning, Mike.
Good morning, John. We're just waiting for the numbers to drop here. Of course, we have a pretty good idea of what PCE inflation is going to be. It's coming, the numbers are dropping slowly, but here they come. The PCE on a month-over-month basis, the headline up 3%, 0.3%, which means a 2.5% year-over-year number, and that was totally as expected. That's unchanged from last month. We get a stronger core, though, up 0.4. The forecast was for up 0.3. That pushes us up two ticks to 2.8% for year over year on the core, up from 2.6%. So that is not particularly good news for anybody looking for rate cuts. Now, the number that everybody wanted to see was personal spending. And it is a relatively strong number, but not as strong as forecast, up 0.4% after a 0.2 decline last month. The forecast was for a 0.5% rise. Income comes up by 0.8% after a 0.9 the month of January. So incomes are still coming in relatively strong, gives people the ability to spend. The question is, do they want to spend, given the way consumer confidence has come down? I'll take a look at where the breakdowns are in terms of spending and wages, and you can tell us what the market's thinking of all
Yeah,
this.
Mike, thank you. All incremental stuff, fairly marginal, but you do see a slight move in the equity market. We're down by about 0.25% now on the S&P 500, just an additional 0.1% there. On the Nasdaq 100 now negative by 0.4. Bond yields were lower by 3 to 4 basis points across the curve at the long end on a 10-year and 30-year. Just about holding on to those levels at the moment at 4.33 on 10s, on 30s at 4.68. And just to cross over to the FX market briefly, euro-dollar essentially where it was, session lows, euro-dollar at the moment 107.75. The data points all incremental, marginal moves, but important moves, I think, Lisa, to get your hands around where this economy is going into big policy changes through the next few weeks.
Marginally, I don't want to say the S word because stagflation it is not when you're talking about personal income rising by 0.8%. But if you look at real personal spending coming in at simply 0.1% versus the expectation of 0.3% at the same time, the core PCE is coming in stronger, inflation up, and some of the spending that's been powering the economy just a touch lower.
Mike McKee, just to build on that, might speak to consumer confidence that has really sagged recently, and we'll get another read on that a little bit later this morning.
Yeah, we do get the University of Michigan final numbers. We'll see if they change a lot. They don't usually, but in this unusual time, we might see maybe a rise in the inflation numbers in particular. I can point out wages and salaries were up 0.5%. That's stronger than in January, so that is good news, but it looks like the biggest increase on the month was transfer receipts, government aid to people, up 2.2%. So the strength in overall compensation is a little bit boosted by the government.
Michael, thank you. Mike McKee there breaking down that economic data. To build on this conversation, I'm pleased to say that joining us now is the former St. Louis Fed President, Jim Bullard. Jim, welcome back to the program, sir. It's been a while. We haven't spoken to you, I believe, since Chairman Powell spoke in the news conference, so we've got to ask you. We need your reaction. The T word making a comeback at the Federal Reserve. What did you make of that?
It's not making a comeback with me. I'm not using that word. I think that I do think that the committee has, good reason to stick with the policy rate where it is. Inflation expectations for the next 2 years in the TIPS market have been rising. They're about 3.25 today. That's a CPI-based measure, but if you put that over to PCE-based measure, it'd be around 3% PC inflation over the next 2 years. That's what the market is thinking. That's too high for the committee. The committee's trying to get, especially core PC inflation, which came in a little bit hot here. You're trying to get core PC inflation down to 2%. So they're going to have to be higher for longer. And if it goes too much farther, they're going to have to raise the policy rate.
Wait, hold on a second, because Jim, this is exactly what people thought that Fed Chair Powell did last week when he said, transitory, the word that you will not go so far as to say, is that he would be willing on some level to look past tariff-related boosts to inflation in the short term, especially if growth was sagging, and that the Fed would have to or be open to responding to slowing growth. Are you saying that inflation, should it be above expectations because of tariffs or whatever else, it's going to be important to address?
The committee should be hitting their inflation target 2 years from now. And what the market is saying is, no, you're not going to hit it. You're going to hit 3%. That was my story here. So that doesn't sound very good to the committee. Now, maybe the market's wrong. They often have, and I'm talking about 2-year tips here, and they can move around, yes. But it's a good reason for the committee to stay where it is. I have argued that the committee's in good shape here. They didn't go as far as was previously expected on cutting the policy rate. So they stayed a little bit higher. I think that's turning out to be wise. The tariffs, when I say tariffs don't cause inflation, what I mean is that inflation's a product of monetary policy over the medium term, and it's not up to the trade representative to control inflation. It's up to the policymakers to control inflation, and they have to adjust policy appropriately given everything else that's going on in the economy. And so, and over a 2-year horizon, that's something you should be able to influence. But right now, markets are saying that the committee doesn't look tight enough to get down to 2% at the end of 2 years.
Jim, do you think that the Fed should open the possibility of hiking rates again?
Well, it's not my base case, but I think the probability on that is rising slightly here. And this wasn't that radical of a data release here, but I do think that possibility is rising. We really haven't made any progress on getting core PC inflation down, let's say over the last year. I think the man on the street would look at those numbers and say, no, it's basically been flat for the last year.
Jim, one thing we've heard repeatedly from some economists is this labour market's just not as tight as it was. And because it's not, that dampens down the potential for second-round effects from the inflationary kick-up that you get from tariffs. What would you say back to that? How fertile do you think this environment is for second-round effects?
I don't know. Come on. Unemployment insurance claims, ridiculously low. That's your best week-to-week indicator. Unemployment rates, if anything, is probably below the natural rate for the U.S. economy, but certainly low by historical standards. I just don't see it right now. Now, there's fear of the future and what might happen, and we know that the last tariff war in 2018 2019 did cause a slowdown in the economy, and that the Fed did react to that by lowering the policy rate. So we'll see if that history repeats itself here. So that it's the expectation that people might be thinking about. But as far as where the labor market is right now and whether that's disinflationary pressure coming from there, I don't think so.
Jim, can we have a best guess from you? Next move, cut or hike? What would your best guess be right now?
I still think the committee can stick to its baseline that there will be further cuts, but they're being pushed farther and farther out into the future. And now with a hotter core PCE year-over-year number, you might start pushing those out into 2026 instead of 2025. We'll see what the market does in the days ahead.
Hey, Jim, before you go, Boilermakers play tonight, don't they? Sweet 16?
Yes. And
you feeling good about that?
The victory for the Boilers here. We're playing in Indianapolis. I think they don't lose at home very often, so I think they've got a good shot.
Boiler up. I do that because you know the manager who does my reviews, Purdue. Appreciate it. Thank you, sir. Former St. Louis Fed President Jim Fullard. Jim, thank you.
It's why I picked Purdue as well.
Right?
I just
Boiler
say,
up. Yes,
anyone who wonders, exactly what this recipe is, John coming out saying you need to ask for raises.
Yes,
you still have the leverage.
And make sure you
up.
support the team that your manager went to school
What's going on? Put it together. I don't know what's going on.
Pretty obvious stuff there, Bramo. Michael McKee joins us now, Bloomberg Economics and Policy Correspondent. He's back with us. Mike, you've got more detail. What do you got?
Well, we like narrative economics, as Bob Schiller likes to say. We like a story about what's happening, and you can construct a story in today's data about people pulling forward their spending. Goods spending rose by 0.9%, while services fell during the month, and the good purchases were largely in durable goods, up 1.4%. So it is possible that people looked at the idea of tariffs coming and went out and bought things like refrigerators and cars that might be more expensive going forward. You can also look at the wages and salaries paid, and while wages overall were up 0.5%, manufacturing wages were up 1%, suggesting that perhaps more hours were worked there and people were putting in more time building those durable goods. So if you want to construct a story about maybe this something that would rhyme with consumer sentiment numbers, this could be it.
I think that would resonate with people, Mike. Appreciate it. Michael McKee breaking down the spending numbers, some front-loading, Lisa. Not surprising.
Yeah, which again dampens the other spending, which explains Lululemon pants. I mean, this basically is confirmation in the numbers of what we're hearing from a number of different, particularly retail companies or consumer discretionaries. I also want to point out that the revisions were more negative in the prior month with respect to spending. Watch this space, because this might be the fastest moving indicator to confirm some of the rhetoric we're hearing.
Watch this market too. We're down by 0.4% on the S&P, down by about 0.5% on the Nasdaq 100. Joining us now to discuss is Mike Kontopoulos of Richard Bernstein Advisors. Mike, welcome to the program, sir. It's been a while. Let's talk about what Jim Bullard just said just moments ago. How constrained do you think this Federal Reserve is if this economy starts to weaken?
Well, I think they're a bit constrained. I mean, the number one thing that they need to pay attention to is inflation at the moment, which thereby constrains them. I think Jim hit the nail on the head. You've got a really resilient labor market. As a small business owner myself, I don't know if you know, but I own a coffee shop, two of them actually, and labor is incredibly tough. It is very, very tight. If you're trying to fight the difference between now and 2018, which Jim brought up, is that you didn't have inflationary pressures in 2018. And so the Fed's going to be, quite constrained if growth falls on the margins. I mean, obviously, if there's a recession, that changes things a bit. But if you just have a slowdown in growth, I think they're incredibly constrained in what they can do with respect to the policy rate.
Do you write people's names on the sides of the cups when you hand it out to people?
We just call them out.
Well, I'm just curious. Actually, using your experience as a small business owner and a longtime credit analyst, I wonder how much you think consumers are able to absorb some of these costs. We're hearing conflicting things. Some people saying not so much. Others saying yes, indeed, they will, and growth won't slow that much. And that's the reason why the likes of Jim Bullard just said that maybe on the margins, the chance of the Fed having to hike rates is going up.
Yeah, I think that's right. We've actually been talking about that for quite some time. I mean, dating all the way back to September prior to the first cut, when a lot of our peers were saying you should be increasing duration, for example, because rates tend to fall when the Fed cuts rates, we said just the opposite. We actually said the Fed cutting at a time of strong earnings and economic growth should actually warrant selling duration, being underweight duration. And I think that's sort of where we are today as well. If anything, I think, the risk, I'm not saying this is the baseline, but the risk is certainly a hold through all of 2025. And yeah, I think the probability of a hike at least has to be considered at this particular point in time. Not saying they'll do that. But for our perspective as macro investors, what you really care about is what does this mean versus expectations? How does that affect, bonds, credit, equities, et cetera, going forward? And the fact of the matter is, if it's still because of a strong economy, right, if that consumer continues to spend, and you are seeing that, yes, we missed by 1/10 today, but you still have a pretty strong consumer. I don't know if that's terribly a bad thing either for markets generally.
You talk about the potential for 10-year yields to rise to the 4.75 to 5% range this year. What kind of probability would you assign that type of scenario?
Well, I think it's quite high, certainly north of 50%. I think that you had a growth scare, obviously, in the first quarter of this year related to tariffs and uncertainty. And that caused yields to fall a bit. But notice yields haven't gotten back down to that 3.6 level, which is where you were in September. The hard data hasn't been nearly as bad as what it was in July and August of 2024. The hard data actually looks pretty good. Earnings data is strong. So I almost see no reason why you won't get back up north of 4.5. Certainly, that's not a big statement maybe from where we are today. But yeah, I think 4.75 to 5% definitely has greater than 50% odds. Now, how much higher you go from there, I think things start to get hard, right? You really need to be at the beginning of another, economic cycle to the upside, I think, to go much north of 5. So that 4 3/4 to 5 would probably be a good entry place for duration in our view.
Mike, just to finish where we started on the Federal Reserve, I think this is a really important conversation about their ability to reduce interest rates in the face of economic threats. So you mentioned last year, the end of last year, through the summer, you could feel that anxiety build around the labour market. It was clear, it was in the hard data, unemployment was starting to pick up, and they went on to reduce interest rates by 100 basis points. There are some people who believe they'll still be able to do that right now. How different do you think this moment is, the one we're in at the moment, compared to where we were late summer in 24?
So I think certainly the hard data is better today, and that's a positive with regard to the economy, a negative if you are wishing for the Fed to ease liquidity and cut interest rates. What's different today more than anything else, though, is just the amount of uncertainty out there. And I do think that there's a scarcity of certainty. And so, investors really need to be thinking about that as being just as big of a change as the hard data. And it's why we're a bit cautious and getting a little bit more cautious despite our feelings of reasonably strong growth and profits and all the sort of good stuff that comes along with that. We still think that level of uncertainty is going to be a defining feature of the next several months or several quarters. And that does warrant a bit of defensiveness and quality in the portfolios.
Mike, just before we go, we're big supporters of small business. Next time we're in Larchmont, what is it? Sunshine Coffee Roasters, is that right?
You hit the nail on the head, and we also have we celebrate our 1-year anniversary in Rye, New York as well.
Congratulations. Beautiful parts of New York. Thank you, sir. Thank you so much. Mike Kontopoulou there of Richard Bernstein Advisors. You've been to Larchmont, beautiful part of the world.
It's absolutely beautiful, and evidently it's a cappuccino. I actually was looking
just on the water. You've been looking at the menu.
Yeah, I was looking at that. You can call my name out.
I've been looking at prices. In February, the average price of ground roast coffee actually hit a record. So I imagine he's dealing with some
He's passing that on. Yeah, this is important stuff. Thanks for that, Anne-Marie. All right, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with a recap on that economic data. The Fed's preferred measure of inflation rose in February. Core PCE increased 0.4% from January, slightly higher than estimates, calling for 0.3%. At the same time, household demand came in weaker than expected, signaling a more cautious consumer. And staying on that, Lululemon shares are plunging more than 11% in the pre-market after the company delivered a disappointing outlook for the year. The CEO saying U.S. shoppers are keeping their wallets tight and visiting stores less often due to what they say is geopolitical strife and high inflation. The retailer joins a growing list of companies raising consumer concerns. And CoreWeave raised $1.5 billion in its initial public offering, selling 37.5 million shares at $40 a piece. All those metrics fell short of expectations, which were to sell 49 million shares at $47 to $55 each, which could have raised as much as $2.7 billion. So a miss there. CoreWeave shares will begin trading today on the NASDAQ under the ticker CRWV. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. I know Matt Miller and the team will pick up on that story in about 15 minutes' time, so look out for that. Up next on the program, we'll set you up for the day ahead. We'll head down to the nation's capital and catch up with Tyler in Washington, D.C. From New York, this is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening bound's about 39 minutes away, so here's the price action for you. Just a little bit softer. We're down by 0.4% on the S&P. The Nasdaq 100's down by 0.5%, and the data, Lisa, of the last 20 minutes or so, not exactly supportive of the bull thesis.
You have essentially an increase in the expected core PCE, so that came in hotter than expected, just slightly on the margins, and slightly weaker spending on the margins, but just confirming that trend.
Encouraging the bears out there. We're negative by 0.25% on a Russell. As we we count you down to the opening bell, your trading diary, the next week or so looks like this. Later on today, you will get UMich consumer sentiment. We will also get JOLTS and ISM manufacturing. Look ahead to next week. On Wednesday, President Trump's Liberation Day, plus ADP and durable goods. On Thursday, another round of jobless claims and ISM services data. And on Friday, next Friday, this time next week, payrolls, the major data point. Joining us now, Tyler Kendall from Washington, D.C., from the nation's capital. Tyler, can we confirm that call is taking place between those two leaders this morning?
Well, John, there are reports that it is currently going to happen later this morning. We have to keep in mind that this would be the first call between the two leaders since Carney was sworn in as prime minister amid what has been escalating rhetoric between the two of them. Carney, of course, largely campaigning on countering President Trump. He told reporters yesterday that it was the White House who reached out to him to schedule this call. Now, we normally get confirmation and a readout about what happened on a post on Truth Social, so we'll be paying close attention to that. I just want to quickly add one more thing to your radar today in Washington. U.S. mayors meeting with Canadian mayors about tariffs. I bring that up, John, because just yesterday a new report from Canada's Chamber of Commerce says that U.S. cities that are expected to be hit the most by Canadian export tariffs are in states that President Trump won, like Detroit, Michigan, and San Antonio, Texas. Both of those mayors will be here in Washington today.
Tyler, thank you. Looking forward to your coverage through today. Bloomberg's Tyler Kendall, just outside of the White House in the nation's capital in Washington, D.C. Can we negotiate some of these issues away?
This is the tricky part. Can you put the genie back in the bottle at a time where there is public opinion that's moving very quickly? And for whom can you put this genie back in the bottle? I go back to what Torsten Slok pointed out yesterday, that future flights between Canada and the U.S. have fallen 70% since all of this has gone on. So you have to imagine people vote with their feet, and it's hard to really reverse all of this in short order.
They're going to try. The United Kingdom's going to try. We know India is currently trying. Interesting, CCTV is coming out right now, giving a bit of a readout on Jamieson Greer, USTR ambassador, the trade representative of the United States, who had a call earlier this week with the Chinese vice premier. And China apparently told Jamieson Greer it will retaliate versus the reciprocal tariffs that are expected to come out next week. So this is just going to be the start, as many people have been telling us, of a tit-for-tat trade war.
I realize I do this every single Monday morning, look down the barrel of the camera and say, huge week coming up. Next week, the amount of economic data that we get on the job side for the labour market, ADP, JOLTS, jobless claims, payrolls, and then this really pivotal week potentially for trade as well. We've been anticipating this April 2nd day now for weeks.
I remember when you used to say huge week ahead, and I'd think, oh, that's going to be fun. That's going to be exciting. And now it's like another one. I mean, there's so many different things, and every week is turning into a month. Next week, though, could be pivotal. Do we get certainty around the trade story? And if we don't, that feature of uncertainty starts to get priced in a different kind of way.
Or does that uncertainty just persist? Next week, I'm going to do it right now. Huge week coming up next week. Payrolls this time next week. Lots of economic data. And April 2nd is Liberation Day in America. How will this market react to that? What a lineup we've got for you to kick off Monday morning. Lori Calvasina of RBC, Mike Wilson of Morgan Stanley, Daryl Cronk of Wells Fargo, Neil Dutter of Renmac. From New York City, get some rest this weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Novak Djokovic is into the Final Four after he took out American Sebastian Korda in straight sets. The 24-time major champion fought back from a set down in the second set, closing it out in the breaker after just over an hour on court. And don't forget, you can watch all the action live daily on Tennis Channel.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure, So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready?
Go.
All right, equity futures dropping right now on this Friday morning after PCE comes in hot. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Danny Berger. Matt Miller and Shonali Bastick are off. Open interest starts right now.
Coming up, CoreWeave's IPO on deck. The heavily downsized offering debuts on Wall Street today. We'll follow all the moves. Meanwhile, consumers are overstretched, and that's not a good look for Lululemon. We'll have the latest on the company's disappointing forecasts. And more cracks in the consumer. A key inflation gauge picks up as spending barely rises. All of that and more coming up. But let's take a closer look at Lululemon right now. It's one of the biggest movers in the pre-market to the downside. The athletic wear brand warning about consumer spending in the U.S., and you can see that warning coming through in shares right now, Danny, currently off about 11%.
Yeah, one of the latest consumer companies really to do this. Katie, tariffs and autos still in focus today. Tesla, though, trading to the upside in the pre-market. It's outperforming the others and outperforming the Mag 7, I should say. So perhaps we are in a situation where Tesla is less exposed with more factories in the U.S. That compares to a GM, to a Stellantis, Katie. Those have been crushed over the past day.
Yeah, we'll keep a close eye on those auto stocks for Matt Miller in absentia. But let's get back to one of the big stories of the day, and that is CoreWeave. Begins trading on the NASDAQ today after significantly reducing the size of its IPO. Let's bring in Bloomberg's Bailey Lipschultz for more. So, Bailey, once upon a time, CoreWeave was looking to raise $4 billion in this IPO. That would have given it a valuation of about $35 billion. Those ambitions have been dashed just a little bit.
Just a bit outside, Katie. They even launched a week ago. Not much has fundamentally changed, if anything at all. Targeting up to $2.7 billion. They ultimately printed last night at $1.5 billion, with NVIDIA shoring up the book, taking about 17% of that IPO. So right now, looking at that on a fully diluted basis, about $23 billion, which is in line with their last private round. Investors had been pushing back on the last week.
Why? Why have they been pushing back, Bailey?
Debt load a small moat. We saw some results from an RBC anonymous buy-side survey that really called out concerns around its need to spend. It's going to have to sell either equity or debt to continue to fund these ambitions. There are also overlying questions of concentration around customers. More than 3/4 of it is driven by Microsoft and NVIDIA. We've seen the headlines from Cowen saying that Microsoft is pulling back that spending. That caused some jitters, and really just the overall kind of math that they use with depreciating some of these chips. If NVIDIA is coming out with a new chip every other year, what does that mean for a company that essentially buys GPUs and just rents them out?
Yeah, it really feels like there's two issues here that could be spooking investors right now. You have just the overall market environment, all the volatility that we're seeing around tariffs, but then as you mentioned, I mean, it's just fundamentals concerns that there's maybe a bubble of sorts forming in AI infrastructure, which of course is CoreWeave's bread and butter.
Yeah, and it's poorly timed for Joe Tsai to come out and say exactly that, that this is a time where you should be concerned.
He's shorting it.
Your words, not mine. But it is an interesting time. Again, people are pointing to April 2nd, that Liberation Day, as Donald Trump puts it. What does that mean for risk appetite? And more importantly, what does that mean for investors who don't want to go out on the risk spectrum with a new company with these kind of underlying concerns about the business model, again, in a market that seemingly is pulling back from AI investment?
Yeah, probably some people unhappy with Joe Tsai, maybe getting some phone calls, maybe even more phone calls now, Katie, because of you.
That was a joke. Let me just put that out, full disclosure.
Good clarification, Bailey. Thank you so much for joining us. That is Bloomberg's Bailey Lipschultz. Now, elsewhere in tech, the EU is considering hitting back at big U.S. tech companies in retaliation for 25% on the auto industry. That, according to the FT. Joining us for more in Washington is Bloomberg's Michael Shepard. Shep, just how much are they really hitting back? Or is there a sense that these fines aren't going to be as punitive in order to avoid the ire of Trump?
Well, it's a good question. The companies certainly have been pushing for perhaps more lenient treatment from the bloc since even before Trump took office. They have been pressing Brussels to maybe take it a little bit easier in enforcement of the Digital Markets Act and also in the application of the Digital Services Act there, both of which have imposed some costs on the companies in terms of taxes on the services that they provide and also regulations that increase their costs for doing business in the region. And of course, these are two sticking points that the Trump administration has brought up. Perhaps most visibly, we heard that from Vice President J.D. Vance during his visit to Europe last month. He took part in an AI summit where he raised this issue, and also at the Munich Security Conference, where he really hectored officials over regulation and over this posture that he viewed as very heavy-handed in their view. And this is part of the trade conversation that the U.S. is having here when it comes to Europe and tech.
Yeah, absolutely. Just one of these negotiating chips on the table right now. But let's zoom out a little bit and talk about the stakes for the industry. Shep, give us some context here.
Well, the context is that a number of these companies do quite a bit of business in the EU, in the European region. If you look at Apple, it's about $100 billion of business last year, roughly the same for Alphabet. So the stakes are not small. And there are other companies, too. When you think of Meta, they don't have nearly the same footprint as they do perhaps in the U.S. or maybe in Brazil. But the EU is nonetheless a significant market. And we've even heard from Mark Zuckerberg complaints about how the Digital Markets Act and some of its enforcement and content moderation requirements have really been a drag on the company. And those are things that he has pushed back against here in the U.S. Now, flipping it back to tariffs, what the EU is considering in terms of reprisal, not just over autos, but whatever we might see on April 2nd, they are looking at going beyond just tariffs as a countermeasure. They may go after intellectual property of big tech companies. This would be under the anti-coercion instrument that was established during Trump's first term by the EU during Trump's first term as a way of countering the first trade war. And another way they could get back at them, of course, is via Elon Musk, perhaps banning his company Starlink from gaining government contracts in the region. And that would be over his role in the Trump administration these days.
Yeah, that would certainly send a message. Great reporting, as always. That is Bloomberg's Mike Shepard joining us from D.C. Let's keep this conversation going now because it's a rough ending to what's been a challenging week for the tech sector. As we were talking about, Alibaba's Joe Tsai warning about a potential bubble in AI infrastructure on Tuesday. Now, that was followed by a Cowen report saying that Microsoft is canceling new data center projects due to oversupply. Bloomberg's Caroline Hyde joins us now with a closer look at how it's impacted big tech this week. So, Caroline, what's the damage?
Well, a continued pressure on some of the key AI players, a continued concern over CoreWeave in particular, and what that signals about NVIDIA, about Microsoft, about Amazon. But I think what's interesting is we've got a tale of two cities here. Yes, you are worried about data center compute, whether we've got an overcapacity, whether Microsoft was withdrawing from its overall leases, and that's something that you were signaling that TD Cowen's been writing about time and time again, and Joe Tsai's warning. But on the flip side, you've got Sam Altman going on to X saying, our GPUs are melting at the moment because everyone is in such a frenzy to generate a fun image of themselves that they can't cope with it.
Though, wouldn't he?
Well, I mean, he's not in the game of giving compute. He's in the game of giving you absolute demand and ability to use generative AI. What's interesting with CoreWeave is, yes, we've had worries about them being too exposed to Microsoft, but they recently inked a massive deal with OpenAI. And so I think here is the test case. Are we using generative AI in our enterprise world, in our personal world, enough to vindicate the $80 billion being used by Microsoft to spend on it, the CapEx being promised by Amazon, and the overall, even China? I mean, Joe Tsai can say that there's some sort of bubble going on, but you've seen more than $50 billion being allocated to GPU rollout, to capital expenditure on compute by Alibaba itself. I mean, everyone wants in. Issue is we need to start seeing the use cases, and we're finally getting them.
Yeah, and I'm looking forward. Katie and I are going to be speaking with EQT's head of U.S. infrastructure, who also just raised a big fund in part to do what you're talking about. So this slowdown necessarily hasn't happened, but how much of this also, the tech damage we've seen, is just also about China catching up? It feels like over the past 5 days, we've had story after story of new AI model and some advancement that's been happening in China.
You're so right. And I feel as though it's suddenly the solar moment, the EV moment for generative AI. China's coming out and saying, we could do what you do, but more efficiently, more cheaply. And boy, are we going to start making all those generative AI bots and chatbots even more accessible. Most people I speak to will say that is nothing but good for the overall ecosystem. The fact that you and I can start to have personal assistants at a cheaper price point is going to mean explosive growth for generative AI and mean that we use inference yet further, and that's, of course, what Jensen Huang's been trying to convince us of. But I do think that there is this moment of reckoning that China is able to compete in a phenomenal way versus the United States. We've meanwhile got the pressure coming on big tech because we're worried about tariffs. We're worried about AI diffusion model. We've got a great guest coming on, Robert Oxman, a little bit later to discuss, really, is that going to be imposed into the United States? Are we going to have a limitation on selling into our allies as well? There is so much reason to take risk off the table at the moment rather than pile in.
Absolutely, and you're seeing that in the markets right now. Caroline Hyde, great context as always. And speaking of tariffs, we do want to bring you some breaking news, and that is that the EU plans concessions for Trump after reciprocal tariffs hit. To bring you a little bit more detail there, specifically, EU officials were told that new auto and reciprocal tariffs will be launched next week, and discussions began on what a potential deal to reduce them would look like. And as such, the EU is working on a, quote, term sheet for a potential agreement which would set out areas for negotiations on punitive trade measures. This coming from our Bloomberg News team. Danny, you see the reaction in markets right now. S&P 500 futures not moving too much on this news, but you take a look at the currency market, specifically in the Euro-USD pair, and you do see the pair climbing higher right now.
I think there is maybe a hesitancy, at least in equity markets, and what we're seeing on this idea of if they come up with a term sheet, if they actually do things to placate the Trump administration, will it work? Donald Trump himself has said that these are permanent tariffs. They aren't really we've had this question of what are tariffs for? Are they a negotiating tactic? Is it to get deals done? Trump has been speaking in a way that suggests it is to fix a wrong, to fix a trade balance. So will this really go far enough when he is saying there will be no exemptions, or at least few exemptions?
Yeah, and it's interesting to see investors try to parse that. I mean, I was in Las Vegas at the start of this week. I was speaking to DoubleLine's Jeff Sherman, who was saying you have to take Trump literally, not just seriously, literally. But you take a look at the market reaction to tariffs, it still feels a little bit muted. You do get these moves in the currency market, for example, where more of the direct impacts would flow through. But it does feel like there's still this sort of skepticism as to whether these are permanent.
Well, part of the problem is that companies themselves, when they're giving updates for their earnings, they're not including tariffs in their outlook. Sure, you get the one-off comment from Lululemon saying that we'll have slightly worse margins because of tariffs, but S&P did this really interesting study where they looked at the calls so far from companies, and people aren't talking about tariffs, so it is maybe not priced in yet.
Yeah, absolutely. We'll have to continue to watch this story, but just to bring you the headline again, the EU is identifying concessions to make to the Trump administration to secure a partial remover of U.S. tariffs that have already started hitting EU exports. We'll continue to watch that and the market reaction. But coming up, as we mentioned, things not so calm at Lululemon. Shares plunging right now after the CEO issues a warning about a consumer slowdown. Details next. This is Open Interest.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Now to high interest, let's get you a look at what is making headlines around the world. Eli Lilly's Alzheimer's disease drug failed to get the backing of European regulators, who said its benefits don't outweigh the risk of potential fatal bleeding in the brain. The committee noted 3 deaths of people treated with the medicine. Eli Lilly now has another 15 days to ask for review. Those shares down about 0.5%. And PCE, the Fed's preferred inflation metric, it's rising at a stubborn pace in February. The data suggests that weakening household demand and a more guarded consumer. Now, speaking of a guarded consumer, Lululemon getting crushed in the pre-market, down more than 11.5%. It was a disappointing outlook, but perhaps more notable than that, the company saying that shoppers are pulling back because of geopolitical uncertainties and rising inflation, Katie.
Well, to that point, Danny, Lululemon is joining a growing list of retailers really sounding that alarm. Target, Best Buy, Nike, all voicing similar concerns this month. The latest warning from Lululemon CEO Calvin McDonald saying, quote, "We're operating within a dynamic macro environment that's really contributed to a cautious consumer. We've seen a material impact to traffic across the industry. Let's unpack all of that now with Andrea Felstead of Bloomberg Opinion. Andrea, so you take a look at Lululemon's plan. They want to expand into categories like golf, tennis, more deeply into running. Is that going to actually boost demand, or do we just have to get through this period?
Well, it should do. I mean, they have looked through the noise, and they have taken some really, welcome steps. Really, last year they said they didn't have enough colour in stores. Well, they've brought sort of lots more colour into stores. There's been concerns that tight-fitting leggings are out of fashion, where everyone's going for a wider leg pants. They're introducing wider leg pants. They're doing all the right things. The trouble is, they're saying this has come up against a much more cautious consumer.
Andrea, thank you so much. Andrea Felstead of Bloomberg Opinion. Those shares down about 10.8% in the pre-market. Let's get back now to a Bloomberg scoop. The EU identifying concessions that it's willing to make to Donald Trump's administration to secure the partial removal of U.S. tariffs that have already started to hit the bloc's exports and are set to increase after April 2nd. Let's go straight to the White House, where Bloomberg's Tyler Kendall is standing by. Tyler, what did we learn that the EU's plans are?
Yeah, hey, Danny. Well, importantly, we are also learning that this came after the EU trade chief was here in Washington earlier this week, and sources familiar are telling Bloomberg News that the officials left that meeting with the understanding that the U.S. didn't really want to negotiate ahead of April 2nd, and that helped to put together this so-called term sheet. It does include lowering duties, mutual investments, and easing some regulations. We know, of course, that the EU has already floated, for example, that it would lower its trade barriers when it comes to industrial goods, as well as boost some imports of U.S. LNG. That had already been on the table. But we have to keep in mind that these reciprocal tariff plans on April 2nd also include those non-tariff barriers. Think of the VAT and also DST, digital services taxes, and that those had been really a big part of the discussion here in Washington this week. Unclear how far they will go on that. I was here at the White House earlier when Kevin Hassett briefed reporters and said, when he was asked if the U.S. is really asking the EU to dismantle some of its key tax priorities, he said the U.S. would be realistic in that regard. The other factor of this, of course, are those sector-specific tariffs that we are expecting later down the road and how the EU could be positioning ahead of that. Of course, the auto tariffs this week, but other key industries to the European Union, such as pharmaceuticals, are also expected soon.
All right, Tyler, appreciate you keeping on top of this story for us. That is Tyler Kendall joining us from outside the White House on that Bloomberg News scoop that the European Commission is planning a term sheet of concessions to bring to the Trump administration in these tariff talks. That headline breaking just a few minutes ago. Let's take a look at how it's rippling through the markets. You actually have the S&P 500 paring losses a little bit ahead of the opening bell. We had been down about 0.4% earlier after we got hotter than expected PCE rather, but you can see coming back a little bit. The NASDAQ 100 still down on the session. The Russell 2000 fighting to go green. We'll see if the small caps get there. Now, with less than 12 minutes until the opening bell, we're joined by Lisa Shallett. Coming up next, that is Morgan Stanley's Wealth Management Chief Investment Officer. Don't go anywhere. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
The pullback in growth is quite substantial. They're trying to level the playing field to some extent. And ultimately, the goal is to improve the competitiveness of the U.S. economy and U.S. Corporate sector.
What is the probability that beyond next week, beyond April the 2nd, we're putting completely to rest the tariff issue? We're no longer talking about tariffs at all. I think, that probability is probably very, very low. I have a very, very low confidence myself in calling what the actual measures are going to be.
HSBC and Barclays earlier this week, both of whom are getting more bearish on U.S. equities due to looming tariffs and weakening data. Joining Katie and me now, I'm pleased to say, is Lisa Shallett, Morgan Stanley Wealth Management Chief Investment Officer. Lisa, so great to see you. Look, the bears are starting to emerge. And the companies are starting to get more dour. Lululemon today, we've already seen the likes of Best Buy, Delta, Nike, Walmart warn on consumers, and PCE showed a slight less spending by consumers than we expected. Can we call a bottom in this market yet, or are things just starting to deteriorate?
Well, look, I think we need to have some context here. We've had an uncertainty shock. We've seen that manifest itself in consumer confidence getting hit pretty hard. And I think that most folks who are just, being completely data-driven are taking down GDP estimates and are taking down some of their estimates of consumption. Now, that having been said, we're moving from an economy that's probably growing GDP at about 2.5% to one that's growing at about 1.5%. That's not a recession, and it's really important, to remember that. So our view is, yes, do we have to recalibrate? Do some expectations need to be reset? We came into the year with, very rich markets and very high expectations. Do we need to recalibrate? Yes. Some of that has been done with some of the market damage in this 10% correction.
Well, the flip side to some of these growth concerns are fears about inflation. We got PCE this morning coming in higher than expected when it comes to the core reading, both on the annualized and the monthly basis. I mean, how do you position around that when you consider also the fact that, a lot of these tariffs haven't even kicked in yet?
Yeah, so our solution to this potentially, quote unquote, stagflationary environment, one where growth is slowing and inflation is quite sticky, is to be extraordinarily selective, to look for growth at a reasonable price, look for those companies who are navigating and can navigate around some of the headlines, who are the domestic, more branded-oriented manufacturers who are out of the line of fire of tariffs, and look for opportunities there. It's one of the reasons why, if you're a passive investor, we've been recommending an equal weighted S&P 500 index. If you can, put your money with an active manager, that's our preference. Pick some solid, good quality, cash flow oriented companies who are positioned to navigate despite these tariff headlines.
All right, Lisa, we're just getting started. We're going to take a quick break and come back for the market open. That is Lisa Shallett of Morgan Stanley Wealth Management. A quick check on futures. You can see we're looking to start Friday on a down note. A lot of cross currents in this market. We'll bring you all the action at the opening bell next. This is Open Interest.
asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We are moments away from the start of trading on this Friday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see we're down pretty enough in the pre-market to make you worried about the weekly gain on the S&P 500. We're up just about 0.4% for the week, and we'll have to see what happens once the day really gets going. But if that gain holds, it would be the second consecutive weekly gain on the S&P 500. It's been a very trying time, so we'll just have to see. But in any case, you can see that the bell's ringing both at the New York Stock Exchange and the NASDAQ. You have CoreWeave ringing the bell right now, debuting today on the NASDAQ. This was an IPO, a company that was looking to raise $4 billion. That's since been downsized to about $1.5 billion. We'll continue to watch when trading begins, but let's get to some of the biggest movers at the opening bell, and we start with Lululemon plunging after a disappointing outlook was delivered for the year. Also, the company voicing concerns about consumer spending in the U.S. You add it all together, you can see shares currently off by about 12.6%, really deepening those losses that we saw in the pre-market days.
Because everyone's buying Fiori, right? Is
exactly.
That's
At
what's
least
behind
my
it.
mom is, yes.
And she is the most important gauge for consumers, I think, Katie. I'm looking to Tesla barely holding on to gains. It was up remarkably more in the pre-market, up some 1%. Now we're just up about 1/3% in some change. Investors are having a really difficult time pricing in what tariffs and what auto tariffs will mean, especially now. We have this news that the EU, a Bloomberg scoop, the EU looking for concessions to give Donald Trump to try to lessen some of the tariffs. So does Tesla remain a winner, or do we see maybe some of the U.S. auto manufacturers try to come back with that latest news, Katie?
Yeah, and speaking of tariffs, of course, we have Apollo's Torsten Slok writing this morning that tariffs have at least 2 negative short-term effects. In his latest newsletter, he wrote that elevated uncertainty has a negative impact on household and corporate spending decisions, and also that tariffs have a negative impact on corporate earnings as companies